spend on? I would guess advertising budgets are maybe one of the first things to get chopped for those companies and industries that have been hit hard. You did mention that there are some industries that have done very well, but as a whole, is there more or less money floating around in this industry right now?
Well, through 2020, it was down. Obviously, it was down because, as you point out, a lot of industries were hit very. I think if you look at the total media spend, I think it was down about 14 or 15% across the year. But within that, there were very significant movements. Obviously, digital media actually grew all the way through 2020 because of a significant shift in the way consumers were not only consuming information, but also shopping. There was a huge rise, or has been a huge rise in online shopping. We've all experienced it, but it's up by 20%.
Yeah. How long do you think it'll take before things normalize, or will it? Is this a change that becomes permanent?
No, I don't think they'll normalize. I think we're moving forward into a new chapter rather than going back to where we were. A lot of those habits that consumers have developed aren't going to change. If you've got used to spending much more of doing much more of your shopping online, just because we can suddenly go back to all the stores doesn't mean we necessarily will. Certainly not for everything. So I think some things will change and have changed for good. One of the interesting side effects of all of that, though, is that some research we've done is that where people are going into stores, they're what we're calling mission shopping. They want to go in, get what they need, and get out again. And what that means is the whole concept of a shopping list, which had frankly disappeared over the last 15 years, is actually back on the table again. People are going to the store knowing what they want to buy rather than just browsing through aisles for hours and hours. And that actually increases the importance of brand salience and top of mind of awareness, which creates a greater need for advertising.
Interesting thoughts. Andrew, it's always good to see you. This is kind of a habit that we talk to you every year around the Super Bowl. It's really good to see you. We'll talk to you again soon.
I hope so, Becky. Thanks very much. Take care.
You too. Joe?
Oh, thanks, Beck. Coming up, Intel chairman and former chairman and CEO of Medtronic, Omar Ishrak, joins us to talk the SPAC craze, including his own, making its debut later today. Plus, we're expecting the January jobs report in the next hour, and we have a lineup of guests to break down the numbers as soon as they cross. Squawk Box coming right back.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive, and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
Futures green across the board as we make our way closer to the opening bell this morning. The Dow, S&P, and NASDAQ all on pace for their best week in 3 months. And the Senate taking a big step towards passage of President Biden's nearly $2 trillion COVID relief plan. The early morning vote today coming after nearly 15 hours of debate. And it's Jobs Friday in America. January payrolls are due out in just 30 minutes. We've got the data, analysis, and investment insight you need as the final hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC. I'm Joe Kernan, along with Becky Quick, who would also like to welcome you back. Andrew, you too, right? Andrew, welcome back, everyone.
Welcome back. Welcome back.
Welcome
back.
And that guy, God. U.S. equity futures at this hour are indicated up about 126. I think these are all records, most of these things you're looking at there. 124, NASDAQ indicated up 35.61. The markets are smiling at all the good tunes today, and the S&P up 15. That was not Bruce, obviously, Becky. That was some scary guy that looks like the clown from It, which is actually a band, but that was Springsteen style. Springsteen style. Awesome.
Yes, and awesome. It was a combination cover of Friday I'm in Love and a Springsteen song that kind of melded together. That was good and interesting.
Sung by a scary-looking clown. It clown. Not me.
Yeah. Yeah.
All right, go ahead.
All right, let's get you caught up on some of the stories that investors are going to be watching today. Oh, somebody yelled Thunder Road in my ear. Yes. President Biden's $1.9 trillion COVID relief bill clearing a key hurdle in the Senate. The chamber voting early this morning to approve a budget blueprint that would allow Democrats to enact the final measure without Republican support if they choose to do so. Today's vote was 50-50, a 50-50 split. Vice President Kamala Harris broke that tie in favor of the Democrats. Trading app Robinhood removing all temporary stock trading restrictions. Those had been in place since volatility spiked in names that were favored by the Reddit users. The poster child, of course, GameStop, is now down more than 90% this week. But when we checked it earlier this morning, those shares were trading higher after these limits were removed. Shares of movie theater chain AMC for the week down more than 40%. And then there's Clover Health. The Medicare Advantage insurer backed by investor Chamath Palihapitiya says that it has received a notice of investigation from the SEC and that it intends to cooperate. But it's pushing back on a critical report by noted short seller Hindenburg Research, calling some claims completely untrue. Yesterday, Hindenburg published a piece calling Clover a broken business that sent Clover shares down by double digits. Hindenburg also said that Clover was under investigation by the Department of Justice and that it had not disclosed that to investors. In its response today, Clover said that it has received inquiries from the Department of Justice, but said they were standard practice and that it did not believe they were material to its investors. By the way, contacted by CNBC this morning, the SEC declined to comment on its investigation. Clover Health, again, after being down double-digit percentages yesterday, up by about 2.6% this morning. Andrew?
You know, I'm looking in to try to find out who are the law firms that were advising Clover Health, as well as the law firms advising Chamath Palihapitiya, as well as some of the early underwriters who they're saying didn't believe this needed to be disclosed. There are going to be lawsuits about this. There's no question. And it raises all sorts of questions about why this wasn't disclosed and whether this would have been disclosed in an IPO, whether there would have been a distinction there. I'm not sure. You know, we're going to have to see, but this story is not going anywhere. Meantime, two other things that we're watching very closely this hour, the markets and the fight against COVID-19. Mike Santoli is going to join us in just a moment on the embrace by investors of riskier assets. But first, I want to get to Meg Terrell on the news that Johnson & Johnson has now filed for emergency use authorization of its coronavirus vaccine. Meg.
Hey, Andrew. Well, that filing news came yesterday from J&J. They say that, if and when they get the FDA's green light, they'll start shipping immediately, and we'll have 100 million doses ready for the U.S. government in the first half of 2021. Now, in terms of, so the FDA has actually already said, coming out last night, the advisory committee meeting for this vaccine, that will be February 26th. And that's so important as part of this process. Its outside group of advisors meets, looks over all of the data, including an independent analysis from the FDA. And we'll hear from the company, the FDA. We often hear from the CDC. We hear from the public. This is a big meeting. And that is 22 days after they applied. We will get the documents from the FDA likely on February 24th, which will have tons of information about this vaccine. So that's always a very big day. Now, how does that 22-day timeline compare with what we saw with Pfizer and Moderna? It's actually slightly longer. For Pfizer, they filed on November 20th. Their advisory committee meeting was December 10th. That was 20 days. For Moderna, it was slightly shorter. Filed November 30th, advisory meeting December 17th, 17 days. So you're already seeing a lot of people coming out this morning saying, why is the FDA scheduling this meeting for J&J, 22 days after they filed for emergency use authorization? But guys, we have seen the FDA move with unprecedented speed to clear these vaccines after a positive vote just the day after. This is on a Friday for J&J, so we'll see if the FDA does this over the weekend and we start seeing the first shots maybe that following Monday, March 1st, guys.
Hey, Meg, before you go, what is the timeline on the studies being done for a booster shot on the J&J and whether that would change the efficacy?
Well, they have an ongoing clinical trial testing 2 doses. So we don't know exactly when we should get those data. This, of course, is just for 1 dose, and they showed 72% efficacy with that against disease and 85% efficacy against severe disease, and kept everybody out of the hospital after 28 days after getting the shot. So health experts think that this is a pretty strong vaccine on its own, but we will be getting data on that 2-dose regimen at some point over the coming months.
Okay, also, we're seeing some new data coming in from Oxford. What do you have on that this morning?
Yeah, so Oxford coming out with a press release saying that their vaccine that's partnered with AstraZeneca has now shown efficacy against that B117 strain of the coronavirus that's dominant in the UK. We haven't seen the data. This is a preprint, and we haven't even seen the preprint itself. It's just a press release. But they say despite lower neutralizing antibody levels against that variant, the efficacy was similar against symptomatic disease. And that's interesting because, with the Novavax data that we saw last week, still very strong efficacy, but about 86% they said toward that variant versus 96% they said toward wild type or more, the older forms of the virus. So it would be encouraging if vaccines still work as well against that, since the CDC has predicted that will be the predominant strain here in the U.S. by March.
Okay. All right, Meg, thinking through that, all that info. Thank you. Let's get over now to senior markets commentator Mike Santoli on the higher growth that asset markets seem to be pricing in. Yep. And whether it's long in the tooth, because that's what we have been pricing in for about a year.
Well, we have, Joe, and there's no doubt about it. And, it's interesting. I think the stock market is feeding off of the overlap of the stay-at-home story where tech earnings have been just dominant and social media and everything else. So that's in play. Plus, everybody's expecting the economic numbers to get better, and they are, in fact, improving. So I do think you have a little bit of a sweet spot here for stocks. We had about a 9-day round trip. The old high right there, about a 4% dip. A little bit of a stress test, a little bit of a sentiment check. And I think that yesterday we did surmount those former highs, now attempting to break out. A lot of people who have been bullish for a while have been looking at this 3,900 to 4,000 area. So on the SPDR ETF, it'd be 390 to 400, where it seems as if it could be more like the culmination of this phase of the rally for various reasons. Just one way to think about it, the highest earnings forecast for 2021 that I know of out there, people saying $200 a share. Well, 4,000 is 20 times 200. It's still a little bit rich. Look at long-term treasuries and gold over the last 6 months. It doesn't always work out this perfectly. Look at the synchronicity there. Both have lost about the same amount. People are not interested in hiding in things that appear safe. The steepening of the yield curve is really a big story right now, and that's obviously weakening the prices of long-term treasuries. You got the 30-year pushing 2% right now, Joe.
We'll get some data points a day on all that, Mike Santoli. An important data point, obviously. See what kind of jobs numbers that we have before I think you'd have to say that the vaccine is really having any positive effect that we're all hoping for.
Yeah.
Maybe next month. You think that's too soon, Santoli?
Well, I don't know if it's too soon because you are seeing case counts plunge already, right, alongside the vaccine rollout. I do think that today's jobs number, maybe not the highest stakes in terms of a make or break for the market, but right now we've been feeding on this trend of better and better economic numbers, and the bond yields up and stocks up. Pattern has been so strong that you wonder if it's disappointing. Perhaps you get a moderation of that trend, at least in the short term. Whereas if it's a strong number, it probably just confirms the way people have already been leaning for a while.
Okay, Mike. Thank you.
Yeah.
Beck?
Thanks, Joe. When we come back, we're going to wrap up a big week for the SPACs with yet another news-making interview. Intel's chairman will join us to lay out the kind of deals that he is looking for in the healthcare technology sector. Stay tuned. You're watching Squawk Box, and this is CNBC.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
You say it a lot. Welcome back to Squawk Box. The futures right now are up 119 points. NASDAQ indicated up just under 30 points, and the S&P up 13.5. In corporate news, Ford reported a surprise profit of 34 cents a share versus an expected loss of 7 cents, although revenue fell short. Ford's CFO warned that the 2021 outlook was uncertain because of that global shortage in semiconductor chips that could lower earnings by $1 to $2.5 billion this year. Ford also outlined plans to invest $22 billion in electric vehicles and $7 billion in self-driving vehicles through 2022. Big piece in the Journal talking about all the stuff Phil was saying yesterday, and you, Becky, about the chips and the 150, and they had no idea, they didn't order enough, and now there aren't enough.
Yeah, because they've been taken by other manufacturers, not car manufacturers,
People at
but other
home.
manufacturers for
Right.
all the demand for these laptops and iPads and iPhones, everything you've got. It's going to take a while to catch up.
You know what? Hey, you know what
happens
someone
that way.
wrote in yesterday? You got Andrew. This was for you because we don't have to say Hyundai. If it is Kia and it is an Apple car, would you call it the IKEA?
That is really clever. Good one.
I got to
Yes,
tell
I
you,
think I
I've said
would.
this before on the air.
Yeah.
The Kia vehicles these days are such
great.
good quality.
They are.
It's
They are.
unbelievable. Have you seen
Yeah.
the Kia Telluride? A
Couple years ago
very
they
well
were.
be.
For a few
I mean,
years.
some of these magazines
years
are calling
ago
it the
they
best
were.
car of the year.
The IKEA. Someone wrote in on Twitter. That was someone I haven't blocked that wrote that in. So, but we'll see. There's still
One
time.
of the three.
Yeah.
Right.
My son showed me how to
When
look
we
that
come
up.
back.
How many people you've blocked, Becky? He showed me. You can look up how many people you've blocked. I mean, it's like 5,000 or 6,000.
How many
I'm
have
not
you
kidding. Like 5,000 or 6,000. I swear. I'm not kidding.
That doesn't surprise me at all. People literally beg me to ask you to reinstate them.
No. They get
When
one
we-
shot,
Yeah.
one chance.
Yep. When we come back, the first jobs report looking at 2021. We're just a few short minutes away from that report. Stay tuned. You're watching Squawk Box. This is CNBC. Consensus estimate is for a gain of 50,000. We'll see.
As we cover COVID-19, our business is business. Stocks are telling us that the economy is going to come back and resurrect itself relatively more quickly than some of the economic numbers say. Making sense of the disconnect is what we're trying to do every day for our viewers. The way we socialize, the way we travel, it's all going to be changed for many, many years. This is seismic, it is historic, it is the story of our lifetime.
Welcome back. SPACs are booming on Wall Street. We talk about them virtually every day. Backers of just a few of the most recent ones include Richard Branson, former Boeing CEO Dennis Muhlenberg, former Commerce Secretary Wilbur Rawlston, now A-Rod. We've got another one to bring you this morning, and it is a big one. Omar Ishrak is the chairman of Intel, former chairman and CEO of Medtronic. He joins us now to talk about his SPAC and his aspirations in the healthcare tech sector. The SPAC begins trading today on the New York Stock Exchange. And welcome to the program. We're thrilled to have you. Omar, I should tell you, I'm particularly fascinated by your SPAC, and I've been skeptical in some cases of SPACs broadly, but I'm particularly fascinated by yours, in part because it looks like one of the first I've seen that may be backed by a corporation, which is to say that Medtronic has disclosed, or in the disclosure, appears to be one of your investors. And that appears to me to potentially be a new model for how these even work. Tell us about it.
Well, yeah, I'm very thankful that Medtronic is, in fact, an investor, and there are other long-term investors in it, too. But the key to the SPAC that we're looking at is that the SPAC here is a means to an end. And the end here is to impact healthcare. It's a long-term thought process. That's why a company like Medtronic is interested in this, to explore areas where Medtronic is peripheral to and perhaps gain some benefit from. And the company that we identify can also perhaps go into a partnership with Medtronic potentially at some point. But also other investors, too, are interested in this because of the long-term nature of this. And I've said often that, my goal in this and my partner's goal is really to create a platform in healthcare. And the de-SPACing process is actually the start of our journey, not our end. We want to make a difference in healthcare, to see how computational technology can directly impact healthcare and have the same benefits at the same rate in healthcare that computational technology has in the consumer world. So it is a long-term effort that we're after here, and we found the SPAC to be a very useful vehicle for that.
But in terms of this model and its connection to Medtronic, and I appreciate there are lots of other investors in this, do you see this as a new model where corporations use SPACs, find people like you that they've had relationships with, and almost leverage the SPAC as a form of venture capital or an opportunity to invest in companies that they might not otherwise invest in? And what kind of help may they providing to you in terms of being able to find new companies?
Well, I think that is right. Look, the model has to be proven out. I mean, so far, we're just starting this, but the way you lay it out is actually a potential benefit, and one that could easily be translated into other such models with other companies in other industries potentially. But the help that we will get from them, in many ways, is they have a very big M&A department, which obviously I'm familiar with, but they have a very big M&A department, and they have access and knowledge to many companies out there, and we intend to get some help from there. So that's a pretty big effort. And then the other is, whatever we do, it'll be complementary to Medtronic. And because of that, it may well help Medtronic. It may help us as we try to scale the company, because one of my biggest goals here is to find a scaled company. And Medtronic can indeed help doing that. But their M&A effort, their back office, their diligence process, all of those things we can get some assistance from, and I'm looking forward to that. And the partnership with them in the thought process. Yeah, go ahead.
Tell me how this came about, though, because I know that one of the architects of putting this together was Josh Fink, son, I should say, of Larry Fink.
Yeah. Well, the way it came together was this. Look, I retired from Medtronic in April of last year. And I was looking at what I wanted to do, and I had a deep interest in computation technology. I've got a background in engineering, and I've always maintained an interest there. And I've also obviously an interest in healthcare. And I've noted, like I pointed out before, the potential opening there in the sense that connecting computational technology with a clear line of sight to improvement in healthcare at the level of a patient is one that is really missing. There's a connection there, but the improvement doesn't happen at the same pace as the growth in computational technology. So that was an area I wanted to really work on. And one of the last acquisitions that we did in Medtronic was the acquisition of Digital Surgery, which was an AI and AI company in the surgical space. And through that, I met Jean, who was one of the founders of Digital Surgery. And he's an entrepreneur as well. He's a surgeon. And Jean introduced me to Josh. And Josh had helped Digital Surgery grow by introducing SoftBank to Digital Surgery. And then I soon learned that John was a highly accomplished investor himself. He had connections with the venture capital world, with long-term investors, which I had peripherally, but Josh was really connected to that. And so Josh came up with the idea of the SPAC, and I really didn't know too much about it until I learned. And what brought me to that through the interaction with Josh and John was that the SPAC for me is a long-term investment and where I can take a scaled opportunity and attack it quickly and make it benefit quickly.
Right.
And so Josh has been assembling the SPAC for us. He's been doing the work on it. Yeah.
Right. Speak to this if you could, because there's some news this morning that potentially raises questions about the SPAC model in terms of disclosure and just the kind of scrutiny that are on companies that are de-SPACed as opposed to going public. We've been looking at this Clover SPAC that went public through Chamath Palihapitiya's SPAC, and now there's questions from short sellers and others about investigations and whatnot. Do you think the diligence process is different?
No, I mean, it shouldn't be different, especially if you have a goal of making whatever you de-SPAC into a successful enterprise and are committed to it. You have to do all that right. Because if you're committed to it and you're in the long term, you can't have flaws in the diligence process because it's going to come out over time. So the important thing here, at least for me and for us, is that we are committed to this in the long term. It's a platform for the future. It's a platform for the next decade. And so whatever platform we come up with, it's got to have the right, background to it. It's got to have the right diligence done associated with it. And if there are flaws, we've got to identify them up front and deal with it. This is not something that we're doing to turn and leave. It's something that we're committed to the long term.
Right. Omar, we want to thank you for joining us. It's a longer conversation. I actually want to talk to you a little bit about Intel and the world of chips at some point, so I hope you'll come on back. We've got the jobs number coming up in just a moment, but we do thank you and look forward to following your progress.
That's great. Thank you very much, and it was great talking to you.
Absolutely. Great to talk to you. Joe?
Thanks, Andrew. Coming up, the January employment report, big number of the day. Predictions from our jobs panel and the number of the morning are next. We stole Goolsbee from Fox. It's a miracle. Stay tuned. You're watching Squawk Box on CNBC.
The countdown to the open of the US markets is sponsored by IG.
CNBC.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
The news is coming so fast right now. The pandemic has brought on a mortgage crisis. People are unable to pay their home loans because they've lost their jobs. Overnight, more than 4 million homeowners were asking for a mortgage bailout. The other story of the pandemic is this surprising housing demand. People want a backyard. They want home fitness. They want high-tech homes where they can homeschool and work from home. The home is the most important thing right now. At CNBC, we cover your financial health. That's what we do best.
Welcome back to Squawk Box on CNBC. Ahead of the January jobs numbers, let's get to our jobs panel. And I love these days because we get to do it in Zoom format over here, and we do it just like it's a Zoom meeting. Kate Moore, Austin Goolsbee, Nada Issa, and Seth Carpenter. Steve Leisman is going to be with us as well. And Steve, we understand that you do this on the fly, so we are going to give you a couple of seconds to make sure that we have the right number. We like breaking news. We just don't like to break things and then have to correct them. Anyway, Steve, are you ready? It's time for the January jobs report. Steve, do you have the number? Please.
I have some numbers in front of me here, Joe. I have, hang on, they just all flew across right here. Let's see, participation rate 61.4. Let's see if we have the actual number here. Unemployment rate, the U6 is 11.1. Jobless rate 6.3, down from 6.7. And payrolls 49,000, which is within 1,000 of the estimate, which is pretty good. It looks like December was revised down even further, down to 227,000. Let's see if I've got some sectoral stuff here. Let's see. Construction was down 10,000. Service providing, goods producing jobs down 4,000, construction down 3,000, private sector, private service providing jobs up 10,000, retail taking another hit, Joe, down 37,000. Let's see, government jobs up 43,000. I said the U6 was 11. That's about it for now, Joe. I'll come back, get you some more detail, but real close to the estimate of 50,000, up 49,000, a little worse for December, which doesn't surprise me. And I think no matter what the number is, even if it was the high side, I saw some estimates of 200 or 300,000. It wouldn't matter. We have a very long way to go. My estimate before this number came out was we were off 9.8 million jobs compared to where we were back in February. Back to you, Joe. I'll get you some more details as we go along.
Okay, thanks, Steve. Let's see if technically everything is working here. Let's bring in our jobs panel for some instant reaction. See if the Zoom thing is actually going to work. We have Kate. Is that okay? Kate, Austin.
Yeah, Joe, I'm here.
Hey, Joe. Hi, Nada, and Seth.
Hey, Joe.
Seth, and it's okay. We're good. We're good. Kate, what do you on first blush? What about the numbers?
Yeah, look, it's a slightly disappointing number. I have to tell you, it's incredibly difficult to forecast the January numbers, given some seasonal adjustments and the fact that we knew that there were lots and lots of shutdowns as a result of virus spikes across different areas of the country. So it was pretty difficult to come up with a number. A little bit disappointing. I think the December downward revisions, are not that surprising given the activity that we now know, or the slowdown in activity that we know now happened in December. But I have to tell you, the equity market is focused on three things at this point. Number one, the fiscal stimulus, what's coming down the pike and the impact that's going to have on the consumer. Number two, how successful vaccine rollout is going to be and additional efficacy data on the vaccines for the new variants. And number three, on earnings. So I think they're going to look past the noise of today's number.
Austin, we're going to go across, but Austin, your comments, and the day is coming, Austin, where we all have vaccines and we can do our lunch. The day is coming.
Oh, I thought, yeah, exactly.
The day
lunch,
is coming.
Or else send me the gift card. I mean, what is the deal?
The day is coming. Just hold. You're champing at the bit. We're going to do it. How about these numbers?
Well, look, the private sector number is pretty close to zero. And we've been doing this for a lot of years, Joe, and we always say, don't put too much on any single month. We now got 3 disappointing months in a row, and I think we basically have to admit we've stalled out. There's a danger of double-dip recession, and I think we need to be extremely mindful.
So are you, I'm going to get to Nada quickly, but just a follow-up, Austin. You think 1.9, as an economist and from at the greatest school, one of them anyway, for that dismal,
I appreciate that.
That dismal science. Do you think 1.9 is okay? Should we do it? Should we add that to the tab?
I think 1.9 is okay. I'm more concerned about what the money make sure the money goes to who needs it, because I don't think this is stimulus. I think this is relief. The arguing about 1.9 is really about thinking of it as if it were stimulus, and I'm just trying to prevent permanent damage.
Okay, Nada?
So I agree. I'm not surprised with the number. I expected stagnation, and I agree that the issue now is what we do on the fiscal side. 1.9. I'm not sure how I feel about that. I agree with Austin that it's more important what's in the number or what's in the bill. I agree also that it should be about relief. Stimulus at this point doesn't really make sense when we're closed down because of the virus. So until we take care of the virus, I don't see a point for stimulus.
And Seth, still at UBS? I figured you might be changing addresses. Is that in the cards anytime soon, or what? You know what? It's too personal. You don't need to disclose. Do you have anything to tell us?
I'm happily still at UBS. I mean, for the jobs report, it was a little bit disappointing for me. I was expecting, just on a technical note, the seasonal factors to boost things a bit. The downward revision to December, I think, is telling. That spike that we saw from the latter part of the year in COVID cases really had an effect. That might have a little bit, very small bit of a silver lining, in that now we're seeing COVID cases coming down. We're seeing governors starting to relax mobility restrictions. The fall in cases, though, hopefully will encourage people's confidence. The rollout of the vaccine will hopefully encourage people's confidence. And so even though January was a month where we stalled, February probably not going to be great, but we are looking for a bit of a pickup, hopefully coming probably as soon as March.
Steve, they give out those Nobel Prizes in economics like a dime a dozen. Your work on the seasonal factors that go into these numbers is seminal. People call it seminal. They do. And we were actually talking about it earlier. Do you see any of the effects of that groundbreaking study that you've done? Do you see it here in these numbers? Because it skews them every year.
Yeah, the problem, Joe, is that the Nobel, they don't award the Nobel posthumously, which the problem is that we won't know for many years. They were trying to change it.
You're going to live a long time. What are you saying? Years. You're healthy? That's a horrible thing to say.
Maybe another 5 or 10 years, Joe, before we know if they fix the first quarter issue of weakness. But I do want to give you a few more details here. They don't give Nobels for reporting data on the fly, unfortunately. But there was a pretty big seasonal number, maybe not as much as Seth and others expected. I will point out that I think the high-frequency data that we follow, the UKG and the home-based data, which showed declines, did a little bit better job of forecasting where we're going to be. But there's two sectors we want to focus on. The first is the retail trade sector, down 37,000, 38,000 almost, and the leisure and hospitality down 61,000. Those are the two sectors that are most supremely sensitive to what's going on with lockdowns. And they showed, again, that they had an impact both in December and again in January. And those are big issues for the economy. The private sector, Austin, absolutely right. Just about a stall speed, up just 10,000. One sector that is perhaps a good sign, and we're going to watch this to see how employers act, is the temporary help sector, up more than 80,000. That may be a way that employers bring workers on, at least initially, while they're unsure about what's happening with demand, Joe. So we'll watch that. And then I like the idea of what Seth was talking about. Well, when do we start to see the vaccination in the economic numbers, in the jobs numbers? It may be there's another tough month to come here in February, and not until March do we start to see the economy start to react to more and more people being vaccinated.
Well, I'll just throw this out to anyone who wants to answer it. We're down 10 million jobs or something still, which is not good. And do we ever get 10 million back? Or too many people staying at home? Too many things have changed. Is that something to shoot for, do you think? And what's it going to take? Just stimulus or structural reform in some way, Kate?
Joe, I think we have to have some big structural reform as well. We know that a significant portion of the people that have lost their jobs since the pandemic are women. And a lot of that is because they're primary caregivers for their family. So, we need to get back to a place where people are vaccinated, where we can gather together in groups, where kids can go to school and everyone can go back to work in a regular way, I think, before we can see a big step change. But, Steve stole my fire a moment ago in mentioning some of the temporary hiring and what signal that may be giving us. I've highlighted for some time that companies are really focused on cost control and cost management with uncertainty in terms of the path of economic recovery. I think this temporary hiring may be something that is going to be very popular across a variety of different industries until there is full visibility into revenue growth in the future. Nevertheless, that kind of temporary hiring and that cost management is quite good for margins, and it's one of the things that's coming out in fourth quarter earnings reports.
All right, the floor is open, and I will recognize whomever wants to.
Joe, first of all, do you not spend enough time on Zoom meetings? You can't open up the floor and say everybody just start speaking. That's a disaster. But look, the thing is, I don't think we should set our sights too low. Yes, we got to, not only do we need to get back the 10 million that were down from what it was in February, we're supposed to have been adding 175,000 a month since then. So we should be aiming for 12 million jobs, something like that. If we get control of the virus, absolutely we could go back to that. And unlike normal business cycles, where much of the effort is you're trying to convince people to get off the sidelines, this is a case where the economy wants to come back. It's just we've got to finally get control and take the public health side of it seriously.
You know,
Joe,
go ahead, Seth. Go ahead, Seth.
Yeah. I mean, I completely agree with Austin. I think the other key point here is how many people have left the labor force along the lines of what Kate was talking about, but also just in business cycles, more and more, we see people leaving the labor market when things are tough, and it takes years to come back. So the last business cycle, prime age labor force fell from 2008 until 2015, and it took until the beginning of 2020 to recover that. So not only should we aim to get everyone back who is out of work from this particular slowdown, but I think there's a lot more we can do to push the economy. And this is where the Fed aiming to just plumb the depths of how low you can push the unemployment rate, I think will be key for this expansion.
Hey, Joe, do you mind if I put some quick numbers on what Seth was talking about?
Yeah, go ahead.
Yeah, just sorry to interrupt. That's an important point here because you have two separate sets, sort of overlapping data. There's the 9.8 or 9.6 million, 7 million jobs that we have fewer than we had in February. But there's also 4.3 million people who have left the workforce since February. And that's been pretty much growing month to month here. And that's another issue. I think that Larry Summers' piece in the Post this morning raises some interesting questions about, first, whether the stimulus is too much, whether it's well targeted, but to the extent to which we're fighting the last war when it comes to this recession. Getting people back to work is quick, but a lot of it's going to come back, I think, with the reopening of the economy and the vaccination. So we'll have to wait and see on that.
Nada, what I was going to say, Nada, is I don't want to do a percentage down for things that just never get normal again, but there is some real number for businesses that say, nope, you're not going there. You're doing it through a conference call or conventions that don't go to some. I just think there is a real number down. I don't know. What do you think it is? 5%? There's 5% we're never getting back, don't you think?
That's a really hard question to answer, but I do think that some of the points that have been brought up about the long-term decline in labor force participation is something we've got to pay attention to. Look, I think there's two separate sets of issues. One is kind of what's going to happen in the short term. And I think that Austin is right. And Kate also brought up an important point about women leaving the labor force because their kids are home and schools are closed. So when we do get control of the virus, we'll see quite a bit of recovery on the jobs on the employment side. But there is this medium to longer term issue of what's happening in the labor force. And there are a lot of dynamics here that we need to start paying attention to. How do we get people who left the labor force in their prime age to come back in? I'm not sure we have a solid understanding of those trends and what's happening to really do something, to propose something at this point, but it's something we've got to start paying attention to. And it speaks to the bill as well, because to the extent that we're just giving out cash, I think it creates a problem. If down the line we want to invest in infrastructure, invest in things that actually increase long-term productivity, we have to be careful about taking on too much debt at this point. So I worry about how we're actually thinking about the short term versus the long term as we move forward on the policy side.
Okay, thank you. Thanks to our jobs panel. Does everyone feel like this was fair? That everyone, Kate, Austin, Nada, Seth, Steve, do you all feel like, Austin, are you all right with the way this was done? You got enough time?
That you were fair and balanced?
Yes.
Yeah, I feel
you
like
would know. You would know. And you also, you know what I've learned, Austin? You made a joke about Zoom meetings. I'm not going to make any jokes about Zoom meetings. I just can't. Not after, you know what I'm saying. I'm not going to do it. Not going to do it. Anyway, thank you all. Thank you one and all. I like the, we worked on that whenever anyone talks. But you're right, Austin. I will not toss it open next time. I will assign people to answer specific questions. Thank you. Thank you one and all. Becky.
Very orderly. Well done.
Thanks.
When we come back, we're going to tell you what you want, what you really want to watch on the final day of another wild week on Wall Street. The Dow, the S&P, and the NASDAQ are all tracking for their best week in 3 months. In fact, the NASDAQ, the S&P 500, and the Russell 2000 all closed at record highs yesterday. We'll see how we end this week. Right now, green arrows across the board. Stay tuned. Squawk Box will be right back.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market. As you say, the increased retail activity in the market and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
Safe here, it comes out there. Anyway, joining us now to talk about the markets is Jason Trennert. He's chairman at Strategas Research Partners. And Jason, I have so many things I'd like to kind of put together and figure out what you're thinking about the markets right now. We had started the earnings season and said that companies were performing pretty well, but not getting credit for it. Now you're looking at these markets and they're sitting at new highs. Do you think that this is fair valuation? Do you worry about high valuations? What are you thinking today?
Well, I think, Becky, right now, if you look at trailing multiples and forward multiples, we're actually not too far away from where we were in March of 2000. The difference, of course, is in March of 2000, the 10-year Treasury yield was 6%, and now the 10-year Treasury yield's 1 and change, right? So it's the multiples are a little bit scary, but I think given where long-term interest rates are for the time being, it's sustainable. And I think the earnings have clearly been quite good. And there's no question in my mind you're going to have a very, very strong economy in the second half of the year, just given the amount of stimulus that's in the system. So the earnings expectations, in my opinion, are going to continue to be driven higher. This is nosebleed stuff, but I wouldn't get too worried, to answer your question directly, until 10-year Treasury yields get meaningfully higher. And by meaningfully higher, I mean, something above, well above 2%, probably 3%.
All right, that could be a while, because we just got above 1% very recently after being below that for quite a while. Let's talk about the jobs number. We did get a jobs report that was right about in line with expectations, a gain of 49,000 jobs for the month. That was below what you were anticipating, and there is a lot of question about how deep the scarring is that goes into this. Where are you on the economy, and what do you think we need to see from Washington?
Well, listen, I think, Joe just said it. We're still 10 million people short of where we were a year ago. We had, I think it was 153 million people on non-firm payrolls. We're now about, 143, something along those lines. And so it seems to me there's going to be some structural unemployment problems after this is over. Now, by the same token, travel and leisure, other things, as the economy reopens, that's going to be the best jobs program you can get. My own opinion, and maybe echoing what Steve was saying about Larry Summers, is that, we may be overdoing it here, because there's still $1 trillion we haven't spent from the last round of stimulus. We're talking about another 1.9 trillion perhaps, and personal savings is $1.5 trillion higher today than it was a year ago. And so, and then you add into that opening up the economy, and I would think, my hope is that a lot of the people that are unemployed will get jobs, pretty quickly in the second half of the year. Then you may have other issues like inflation and other structural issues that I think people are willing to worry about that when it comes. But there is a chance, in my opinion, from Washington perspective, we're very close, if not past the point of overdoing it.
Jason, even what you said before, that you're not going to worry about where stocks are, where valuations are, until you get past 2 or even 3% on the 10-year. I mean, that still sounds like such a historically low number. What is it that starts to worry you at that point? Is it how quickly we get to those levels, or how quickly we get to levels beyond that?
It's Becky. It's really it's a good question, because I think it's really the pace at which we get there as opposed to the levels. Because normally what happens when a market peaks is that for a while at least interest rates go up at the same time the stock market goes up, and people are willing to deal with the fact that you have higher interest rates because the economy is growing, and so you have nominal interest rates that move up as a reflection of that. The problem is, again, you're trying to get a fair value between the bond market and the stock market. I mentioned March of 2000 earlier today, or earlier before, and the 10-year Treasury yield was 6, but the earnings yield was only 3, and so you were, stock market was very expensive. Here, again, you have a lot more to work with, because the equity risk premiums we talk about is positive by 200 or 300 basis points. So it's going to take 200 or 300 basis points for people to really start getting worried about equity valuations, but the pace matters. So if you get there, again, if we get there by the end of the second quarter, I have a feeling multiples are going to come in. Even though the earnings may be good, multiples are going to be quite a bit less.
Jace, it's great to see you. Have a good weekend, okay?
You too. Thanks for having me on.
See ya.
Meantime, let's get over to Jim Cramer. He joins us live. We can talk the jobs numbers, but I wanted to actually just ask you a SPAC question, because you've been talking and tweeting a lot about it recently. We've been watching this Clover Health situation that Chamath Palihapitiya brought public through a SPAC. We talked to the chairman of Intel about his own SPAC this morning, but you wrote this, or said this rather: these newer SPACs increasingly feel like an inside joke for the super rich and a way for celebrities to monetize their reputations. How concerned should investors be one way or the other?
I think they have to be very concerned. I think we're getting to a point where these are happening so quickly that you can't keep track of them. And yes, everyone's made money so far, and that's terrific. But when I read through the Hindenburg report yesterday, I've got to tell you that Clover, to me, that was very stinging. Of course, what you should do, Clover should come on immediately on Squawk Box and say, you know what, these are just not true. I didn't hear that. I went to the Clover site yesterday. It's almost like the Hindenburg bomb did not occur. It did. And I think also when I see these people just taking money, what I say to myself is, as much as I like Omar Ishrak and I liked him at Medtronic, chairman of Intel, but, you know, time is hard to come by, Andrew. And I don't want to see a celebrity. I want to see a worker. I don't want to see a promoter. I want to see an operator. Omar's he is not a promoter. But at the same time, how many minutes a day are people going to devote to these things? If they don't go full time with these SPACs, then what we're going to do is we're going to end up with a lot of empty suits telling us that we did pretty well. I don't like it. That's not the way it's supposed to be, Andrew. These are full-time jobs. I want to see full-time people.
Jim, quick view of the jobs number. They're playing us out. I'm already getting in trouble. What do you think in terms of which way the market goes as a result?
Job number's fine. Job number's fine. We're back.
Okay.
We're really focused on earnings again. It's nice. No GameStop today, okay?
Okay, Jim, see you. Have a great weekend. Enjoy Sunday night. We'll see you in a few minutes. Squawk returns after this.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Well, it's my last opportunity to say welcome back this week. So welcome back, everybody.
Welcome
Joe,
back.
Andrew, I wanted to tell you guys, welcome back. I wanted to tell you guys about a rumor that I heard. And normally we wouldn't trade on rumors or secrets, but this one is pretty harmless. So I'm going to share a little bit of it with you. I don't want to give too much away, but I did hear a rumor about a Super Bowl surprise ad that's going to be on during the game this week. I'm not going to give it away because I hate spoilers, but I will say it involves a singer that we have talked about today. So I'm going to just leave that with you and let you think about it.
Not that scary clown, the It clown, but he was doing a Boss song. He was doing a Boss song, so maybe that's who you mean, which for anyone
and
who
I mentioned the Spice Girls.
Oh, you did? You mentioned Spice Girls.
I'm not going to, we've got a lot of, we talked about The Cure. I'm not going to tell you who, but.
Did you see yesterday Brady, they came out that Brady was yelling at someone after the game who had tears in their eyes because they made it to the Super Bowl, and he was yelling at them and cursing them out, saying, We haven't made it yet. There's no crying at the championship game. We don't cry until we get done. What a gamer against the best, some people think the best player in the league right now in Mahomes. It's going to be a great game. I'm not even going to be here Monday. Usually we're at the AT&T, Becky, right? We're out there or on our way or something. That's not happening for amateur. Right, yeah. But I'm going to stay up and watch it, and it should be pretty good. Should be pretty good. And we wore red. That wasn't for the Chiefs, was it? That we're not sending any subliminal messages. But it's neat. The GOAT, the greatest of all time versus maybe the best current player, should be a fun game.
Yeah. It's a real match. It's not always the case with the Super Bowl, but hopefully this time it really is.
Hopefully we have
anyway, guys, have a great weekend.
Yep.
Yeah. And we will welcome you back here on Monday morning. Right now it's time for Squawk on the Street.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber. Stocks are taking aim for 5 straight gains today, something we've not done since August. J&J submits the vaccine. The Senate clears a way for stimulus. Jobs number has some personality at 49K, but the unemployment rate is the lowest since March. Our roadmap begins with the return of job growth. We'll get the first reaction from the White House later on this hour.
Plus, the retail trader rebellion, perhaps not so. New data suggests that institutional investors, and we've talked about this, were key drivers of the recent GameStop volatility. And how about that competition in the electric vehicle industry? An Apple electric car on the horizon? Well, we're going to get the outlook for the industry with the CEO of Lucid Motors, Carl, in just a few minutes.
All right, guys. Let's kick this off, Jim. You know, it's been said that the market really is relying on 3 pillars: stimulus, vaccine, and earnings. And with the VIX this morning below 22, it does appear that all 3 pots are boiling.
Yes. Look, Carl, I hate to say that it's paying loss. Because obviously that's chimerical. But this really is a moment where we had a lot of people get negative. If you recall on Monday, we even had some chief strategists saying, look, what happened last week is really a top. It clearly wasn't a top. We're focused front and center on some great numbers. The backdrop of the employment number makes it so that we really don't have to worry about Fed Chief Powell, what he says. Obviously, Secretary Yellen going to try to hammer out a stimulus deal. I'm very gratified by the AstraZeneca news just this morning that perhaps a vaccine that works against the new strain, because we have so many people coming out and saying new strains can't be stopped. I'd like to put that I don't put it in a box. Let's just say that a lot of the drug companies are working very hard to make it so that we are able to have a normal life within 3, 4, maybe 5 months. David, will it not be something when we all get together, we're vaccinated, and we say to ourselves, okay, I'm feeling pretty good. What should I do now?
Yeah, and hopefully there'll be plenty of things to choose from. I think the one thing a lot of us will do is just choose to be together, which will be nice, and congregate and eat and celebrate. So we all look forward to that. Hey, Jim, by the way, do you have an estimate? I mean, I know you're going to be getting round 2 pretty soon, but when do you think, and in light of the jobs number and the overall conversation, of course, they've been having for the last hour on Squawk Box about the economy, when is your expectation that we will have widespread vaccination and therefore that ability to start to really resume?
Sure. After the J&J last night, I really think that we're talking about Cinco de Mayo. Why do I say that? Because that's the day I intend to open Bar San Miguel again. Look, David, I think that there's going to be this moment. We seem to be able to have finally getting the vaccine to places where people are able to access it. And I think when J&J, even though I know it wasn't perfect, it does say, look, no deaths, no hospitalization. We're getting to the point where people say, you know what, this is going to happen. It's inevitable. Let me go book a cruise. Let me go take a trip. In December, I want to be somewhere else. Will it be roaring 20s? It could be like the end of the pandemic, the Spanish flu. So I think we're talking 4 months, David. I don't think we're talking 6 months anymore. There's just too much in the pipeline. J&J up 3 ahead of this is a little odd, since I think this is one of the more predictable things that could happen. But this government that we have now seems like it's not fighting the tape of the disease. And that's very important. Let's everybody remember, you got to still wear masks. I am worried about super spreader events. Carl, you know that when people get together and their voices are loud and they are even outside, you're going to have another level again of infection. So let's not get depressed. It's going to happen. But the cavalry is here. The cavalry is here, and some of it's J&J, some of it's Pfizer, some of it's Moderna, some of it's AstraZeneca. I'm going to be talking to Sanofi. They did not deliver, but they might have something in the pipe. I like what I'm seeing, and by the way, let's give the Russians credit, Carl. Sputnik 5 is a big, big win.
Yep, and that has big implications for Russia and Europe, obviously. Dr. Gottlieb on Squawk this morning, Jim, suggested if you get the emergency use for J&J at the beginning of March, really by the end of March is when availability starts to explode, and then you're looking at a situation where, as you said, by May, June, you're looking at most adults having gotten it. That leads you to what Treasuries are doing this morning, 10-year now, 118. 30-year, Jim, 198. We've been talking about this increasingly. Is the spread now, is it a 6-year high?
Well, look, I know the bank stocks have been strong. That's one of the groups that you want to buy in this moment. We're still seeing incredible housing numbers. We're still seeing exodus from the inner cities. We're seeing so much economic activity. I had Rockwell Automation on last night. They were talking about just gigantic growth in orders. Gigantic. We're going to have Ford on later. I mean, geez, these numbers are good. So I see a lot that's good. What's bad? Obviously, people are still getting sick. And people are still at Clorox last night, and people still don't have enough wipes. So I think that there is it's a cross moment where there are a lot of people, Carl, who believe that you still want to own some companies that do well when you're hunkering down. Nesting is the term. But when I see all the different recommendations today for mall stores, for people who go out, I'm talking about the Kohl's, the L Brands, or Tapestry, Ralph Lauren, Foot Locker. If someone posits that maybe Nike buys them, I don't know about that. But what I say to myself is the street is prepared to open up, and that Peloton may be the one sticking point. Peloton is not an open-up stock. Peloton is a stay-closed stock. I think that's going to be the fulcrum. Carl, I got to tell you, I think that's the fulcrum for what's going to occur today, because if you think that Peloton goes higher, what you're saying is, wow, you know what, we're locked down. But, David, if you think that when we get situations like I have Brunswick on tonight, which is considered to be a company you buy boats because there's no place to hang out that's safe, well, I don't know. I mean, that's another one that's a fulcrum name. We are at a moment, David, where I'm really not quite sure how quickly we can open, but I do know that once we open, you're not going to do the same things that you've been doing.
Oh, gosh, I hope not. I really, please. I need to change, some change. But yes, you're right.
Well, you've never shopped anyway.
Yeah, no, I never shopped, and I've been able to keep swimming, thankfully, so no Peloton for me. But, you know, you mentioned it, Jim. We did see it was down. There is a downgrade this morning to market perform on valuation, as you might expect. Of course, they had a very strong quarter, Peloton, to your point. But we'll keep an eye on the stock because Raymond James talking, of course, as you'd expect, tough second half comparisons. Not the only company that has been a beneficiary, of course, of the lockdown or of, it's not a lockdown anymore, but certainly of people staying home, Jim. We had this conversation yesterday with Jamie Iannone from eBay as well. There are any number of these companies that were part of that Kramer index. I mean, at what point do you start to say, all right, forget it, don't own them and don't buy them?
Now.
Okay.
There's a lot of different situations where I really question whether we had a tough conversation with Linda Rendell yesterday from Clorox. I'm searching for something that tells me why I want to buy a company that's going to have a radical decline in the organic growth. When you look at Peloton, David, you will absolutely love this. Okay, so BMO comes out today and says it has a market cap that is 22% of Netflix. All right, that's another software-derived business, but it's less than 1% of its subs. Now, they also came in last night and they said, listen, we got to spend $100 million to be sure that you actually get our machines because of port issues. I don't know. I don't know, David. I mean, Peloton's been terrific. It is heavily shorted. 46. Reddit. It's $46 billion market cap.
Yes.
But in the end, do I want to own Peloton, David? I think I want to own a company that does incredibly well when we open up. And I'm not quite sure whether Peloton's going to do as well as some of the companies that are actually in the mall, which I know are the mall's hated, but they could actually still go higher.
Really?
Not kidding.
But not GameStop. GameStop's in the mall, but it's not going higher. Or is it?
No, but Activision Blizzard shows you why it doesn't. Activision Blizzard, Bobby Kotick with just a tour de force number. By the way, Candy Crush still incredibly popular, raises the dividend. Does he mention GameStop? No, why? Because you don't get your stuff from GameStop or Activision Blizzard. Boy, Activision Blizzard, I don't know, David, how much time you spend on Call of Duty or the World of Warcraft. Candy, but my wife plays Candy every night, particularly when I'm trying to talk to her about anything seriously. She doesn't watch the show, so I'm okay.
Yeah, you are.
And she watches Candy. Anytime there's a scary movie, she takes out Candy. I don't know. I can't multitask like that. When I'm watching a scary movie, I actually watch the scary movie. But clearly, Carl, Activision Blizzard has the pulse, and EA didn't. Remember, EA did not do the number. There are, in industries, we're seeing people who know how to do it and people who don't.
Yeah, glad you mentioned.
ATVI guiding above, as many companies have been doing this week, at least on March quarter revenues. So, Jim, if you are looking for reopening plays, I mean, Kohl's has gone from 20 to almost 50 in a matter of 90 days. Or maybe it's travel, although I've been wanting to ask you whether or not the airline recovery play is going to get a little fuzzy, given that oil is now the highest in a year.
I think it is a little fuzzy. You want a reopening play, you have to go with who reopened first. Well, it was Asia, and who was able to handle that and capitalize off of it was Estee Lauder, EL. That's Fabrizio Freda. I've got Fabrizio on tonight. Fabrizio put up numbers that are double-digit for different kinds of. Some of us aren't that aware of what really costs a lot of money when it comes to cosmetics, but La Mer, double-digit. Online sales growth in every single region, 873 million this year versus 557 last year. Skincare, very strong. Hero brands, when I speak to them tonight, those are the brands that people just love. And this is dew-free. It's Asia. I think EL is going to become the primary name that people talk about when they go out. Remember, it was good when it was a selfie generation, and then it was good when it was a zoomy generation. Now you've got both. You got to keep your skincare, and you got to look great. This is an Asian story coming to the United States. There's your open story, Estee Lauder.
Yeah, it's interesting. You've come back to that. They seem to have been not particularly hurt, though, from people staying home. What about Ulta, Jim? Another name that you've focused on that is much more on the retail side there in terms of at least getting people to come in and put makeup on.
I like Ulta very much. Remember, they had a good deal with Target. The one that you mentioned, Kohl's. David, do you know that during this period of great morass that Kohl's latched on to Sephora, which, remember, was a JCPenney outfit, and that's a lot of the growth that Kohl's is happening. Congratulations to Kohl's. That was a total coup to get Sephora because people love Sephora. They just love it. Carl, it's one of everybody's favorite brands.
Yeah, Goose as well. Canada Goose is going to open at more than a one-year high once again today. 2 upgrades on Goose, largely an Asian story, as David mentions. We'll take a break here. Man, there's a lot coming up this hour on this Friday morning. We're going to talk to the CEO of Ford, Jim Farley, about the quarter, the chip shortage, obviously the huge bet on EVs. And then speaking of EVs, an exclusive with the CEO of luxury startup Lucid Motors is coming up after the break.
I'm Jemana Versace, and these are the stories you should be checking out on CNBC.com. U.S. President Joe Biden has filled his foreign policy team with several advisors on Asia. Analysts say the move signals the new administration is preparing to respond to China's growing global influence. That story's on the website now. Australia's competition watchdog says Google must decide if it wants to pull its services from the country or not. The U.S. tech giant has threatened to leave Australia over a bill requiring it to pay local media and publishers to link to their content. Head online for the full story. And Chinese short video platform Kuaishou has delivered a blockbuster debut, having been over 1,000 times oversubscribed on the retail side. Kuaishou shares almost tripled in value on their first day of trade in Hong Kong. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
really want to
As the competition in the electric vehicle industry heats up with a possible entry by Apple, Lucid Motors, well, it's one of the EV startups that has garnered a great deal of attention. We're very happy to have Lucid CEO Peter Rawlinson join us now to discuss the industry overall. Peter, good to have you. You know, where is Lucid's place going to be in this industry, given a potential entrant from Apple years from now, but more specifically, Tesla, obviously, GM committing so much to the industry, Ford, and even the luxury automakers in Europe as well starting to ramp things up. Where does your company fit in?
Well, you see our very first vehicle, the Lucid Air, in the background behind me, and we're aiming initially, unashamedly, at the luxury space. Luxury cars are dominated by the grande marques, Mercedes, Audi, BMW, Porsche, and they all have one thing in common. They're all gasoline. So there isn't an electric luxury car available in the market. That's our first position. But progressively, we'll make cars more affordable and we'll increase our volume accordingly.
You are going to start rather small, of course. I think it's what, annual capacity, the first phase of 34,000 units. You expect to produce 6,000 to 7,000 units this year. Is that correct? And we're talking about where? A starting price for that vehicle around $70,000?
That's absolutely right. The Air starts at around 70,000, goes right up to 161,500 for the Dream Edition, the model we're going to start with. A fantastic car. And we've already built our first phase of our factory in Arizona, which is good for 34,000 units. But that site ultimately will be capable of producing 400,000 cars a year when we implement phase 4 with our 6-year plan.
When is phase 4 coming?
Mid-2000s and 20s.
Mid-2020. So it's a 6-year plan. Yeah. Costs a lot of money to do that. We had Yasser Al-Rumayyan on from the PIF last week discussing, of course, in part their investment, one of your significant holders. Do you have access to capital that you need in order to actually pull off all those phases?
We do indeed, and the Public Investment Fund of Saudi Arabia have been great strategic partners. This is much more than a financial arrangement. This is a long-term strategic partnership. You're absolutely right. This is a capital-intensive business, but we've taken the approach we need to be vertically integrated. There is no substitute for having in-house manufacturing and an in-house retail experience. So we're having our manufacturing in-house and all our studios, our retail studios, and we've already opened 6 of those right across the US.
Peter, Jim Cramer, as we talk, I'm exploring the idea of reserving with a credit card the Air Dream Edition, $161,000. Why am I doing that? Because it's available summer of 2021. How many other people are reserving their various Lucid Airs right now? And can you give me a sense of the demand each day?
Well, it's overwhelming, Jim, and I'm really glad you have impeccable taste, sir. We have a bulging order book. It's growing daily as people are becoming much more aware of us as a company, as a brand. We were pretty silent. We were in almost stealth mode until our global reveal just last September. I like the car to do the talking, and, you know, it's going to be an amazing product when it comes out this year.
But what do we do? I know you work with Elon Musk. You've got a cordial relationship with him. This is 517 miles projected range, 800 horsepower. Obviously, that's 0 to 60, I don't know, in 2 seconds. What makes me want to pay this much more than a Tesla? Everybody loves Tesla, don't they? I mean, high consumer satisfaction, that kind of thing.
Yeah, absolutely right. I mean, Tesla's done an amazing job, and that's what's placed it in its preeminent position. But Tesla recognizes this is a technology play. This is a technology race. That's why Tesla enjoys such a high market cap. And I'm really disappointed that the traditional auto industry hasn't really taken up that baton and really compete with Tesla at the top table. Now, our car is competing overtly in the luxury space against the likes of Mercedes-Benz. So I don't really see us as a direct competitor as Tesla in the product. But it is a very valid comparison to compare us with Tesla in terms of our technology. And in a sense, Lucid is very similar position to where Tesla was 10 years ago. Tesla had the tech. The other entries didn't. And we see today a whole phalanx of startups in the EV space. They don't have the in-house technology. That's what differentiates Lucid. In-house technology, world-class electric vehicle tech.
Right. Well, all right, just give me a quick example of what that means. What is that?
Well, the core metric is efficiency. It's not range per se, because anyone can stuff a whole load of batteries in a car and achieve great range. I could double the size of the battery pack, double the range of the car, couldn't I? And that's pretty dumb. I call that dumb range. What really matters, the most telling metric of where any electric car company is today, there's a single metric, and that is efficiency. How far can I go per kilowatt hour? And we can go well over 4 miles per kilowatt hour. This is world-class technology here in the US. Lucid's going to take the tech to the next level. That is our mission.
All right. Well, Peter, if I want to get a sense for how investors view your company, I need look no further than shares of CCIV. That's the symbol for Churchill Capital 4. It's a SPAC. And I'm sure you're aware of the fact that the speculation around it has been that you will merge with it to go public. Is that the case?
Well, you know I can't comment on any such matters. I can neither confirm nor deny any such thing.
Well, let me ask it in a different way, though. Given that we've watched that go up since there was, I think it was originally a Bloomberg report saying you were in talks with them. I mean, if you're at one value in terms of the way you're thinking about the company prior to this, and then you watch this stock triple based on the expectation that you will be merging into it, does that change your own prospects, or I should say your own view of the value of Lucid right now in the public markets?
Look, I think Lucid value will be truly realized when we've got this car into production. I say every day that until we've made a production car and we start selling to customers, you know, we haven't achieved a damn thing. And the team back at base is working flat out now to industrialize this car as we transition from primarily an engineering, a tech, an R&D company to a phase of our growth where we become a manufacturing entity.
But are you going to become a public company, either through IPO or a SPAC?
I really cannot comment on that right now, as you know.
Peter, quickly, I think you're dead right about EV. I think the oil companies are thinking this is something that's going to be 2035, a lot of time. Can't you just, honestly, can't this industry double, triple even by 2030? People don't want combustion engines. They don't want them, Peter. That's not the future.
You're so right. You're so right. I couldn't agree more. Absolutely. Electric cars are inherently so superior to their gasoline counterpart. And I want us to be making, you know, lots of cars as soon as possible. We start with a high-end product that defines the brand. And the technology that we're developing for Lucid Air, because we're developing high efficiency, will bring the cost of mass-produced EVs down. Because the most expensive component in that car is the battery pack. And if you can go further, go more miles for a given battery size, that's akin to bringing the cost down. And my passion is to be making lots and lots of cars using our advanced technology as soon as possible. It can't happen soon enough.
All right. Well, Peter, we're going to be watching closely as we continue to watch so many of the names that we just had up there that already are public companies, of course, and both making the vehicles and the batteries. Peter Rawlinson, thank you.
Thank you.
Still to come this morning, first White House reaction to the jobs number this morning and the road ahead for COVID relief. We'll check in with our friend Jared Bernstein, member of the President's Council of Economic Advisors. Don't go anywhere.
Daybreak in the U.S.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
But look at the occupancy rate of our retail properties was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
Feeding the world whilst protecting the planet. Protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
What a week it's been for stocks. Futures are green this morning as we are on pace for our best weekly gain in 3 months. And we're coming off record closes for the NAS, the S&P, and the Russell, going for 5 straight today. We're back in a moment.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
Missed the show? Don't sweat it. The Halftime Report now has a podcast, market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
Welcome back. We'll get straight to the opening bell at the NYSE and the NASDAQ and a look at the S&P at the bottom of your screen. As we said, shooting for our best weekly gain for most of the major averages in about 3 months. And the Dow and the S&P going for 5 straight gains, something we haven't done since August. Jim, it's going to be a great day of interviews. We're going to talk to Jim Farley of Ford and Evan Spiegel of Snap, which had a good number, but some are honing in on this soft EBITDA guidance.
Well, look, it was a great call until the company basically lowered the boom, said the first 2 weeks of ads weren't that good because of the capital issue, because of the rebellion. And they also talked about how working with Apple, but some of the Apple privacy issues would matter. But 5 billion pictures a day tell the story here. I think that this is a stock and this is a company that is really on a breakout. They're doing so many things that are right. They were the ones who kept their stock down. I think it would be roaring had Evan just said, look, we've had some momentary problems at the beginning of January, but things are really turning out. I'm very proud of these guys. I remember how skeptical I was, but this is a strong demand product. It does not have the, let's say, the sweetheart image of Pinterest, but that's another one. This is where the money's going. Carl, people are going, Ralph Lauren is using the emoji product from Snap for people to dress up 500 million times. People love the product. Younger people love the product. They own the demo. Congratulations to Evan. He's pulled it off. Congratulations to Ben Silberman for creating a site that is sweeter and gentler. David, we know that the web can be a brutal place. You know, for instance, Twitter, sometimes you see people actually somewhat hammered, right? But when you go into Pinterest, it's just like, it's like a lovey blanket.
Is it?
It's a lovey blanket.
That's good to hear, because I think my daughter uses it and enjoys it. I'm not a participant, so I know more about the brutal place that Twitter can be, certainly, that you well know, not to mention Reddit, of course, Jim.
Well, look, sticks and stones may break my bones, which is why I carry thermonuclear weapons.
Is that pocket-sized? I thought you just had a space laser.
You know, this is one of those days. I keep going back to last Friday. Carl, last Friday, the revolution was on, right? I mean, they were storming the Winter Palace. It was to the Finland station. It was about Lenin, Lenin and Trotsky versus the kulaks and the czars. I don't know. Today it's about Activision Blizzard and Corteva doing well, the seed company and wind resorts coming back, and some of the oil's doing well. I mean, it's kind of like business as usual. I know that there are a lot of people who don't want that because business as usual is really boring, Carl. But you know what? Business as usual is an attempt to make money. That also should play a role, Carl, in the process of what we do.
Yeah. But, Jim, you know, we're coming off 10 days or so where, you know, GameStop going from 2.5 to 450 in the course of a year indicated to some that market structure was broken. So are we done with that conversation?
Well, I think that there'll be, if volume picks up, I don't know whether Robinhood has the controls yet. We don't know. We still don't know who gets best price. We don't know whether commission-free is really commission-free. Here's what we know is last Friday when I was pulling out that catheter, and that's a nasty thing. We don't really have to go too much into it because there's a lot of information.
Thank you.
GameStop was at 300, and I called in and said that I thought it was too high. And what I got back, the blowback on Twitter was so horrendous that my wife actually took away my PC, which was okay because when you have the stitches and the doctors and the nurses and they're probing you, Twitter's just another distraction. But Carl, in the end, GameStop itself, I searched for words about how stupid, about how ill-advised they've been. They had a chance to reinvent the company. They still have a chance to reinvent the company. This talks back to where it was when it was a really good company. But they said nothing. They hired a technical guy. You know, Carl, I laugh sometimes because there's some people at GameStop right now, right? And they're thinking, what have we done? Almost like Alec Guinness, by the way, right? Bridge over the River Kwai. What have I done? And because I know you're a cultural aficionado. But these guys at GameStop, I think they're funny. I mean, I don't know. I had this image. It's like Mo Shemp. I don't know. I mean, maybe it's Abbott. Maybe it's Navin Johnson, right? Remember Navin? I always thought that the cans. I mean, right now at GameStop, Navin Johnson is sitting down with Mo, Larry, and Curly and saying, should we offer stuff? No, they're like, so So anyway, that's my image of what's going on at the board level of GameStop. By the way, David, I want to make one thing clear.
There was a lot of references there. You went from the jerk, from the river, the bridge over the river Kwai, to the jerk, to the
I try to
Three
bring
Stooges.
In
I know.
culture to be able to. Reference,
what's the last point? Because we're gonna get to Jared Bernstein in a minute.
They've been ill-advised.
Yeah. Well, listen, I understand the heat you get. I can't even imagine how you deal with it, given the bit that I got on Twitter as a result of just having the audacity to suggest that sometimes deals aren't done till they're done. And that, of course, the case in CCIV, for example,
David,
which is, by the way, up. And we asked Peter Rawlinson about it. You know, you do tend to wonder how you get a deal done when you initially were negotiating at one valuation for a company, for example, but then you watch the stock of said SPAC skyrocket, reflecting the view of investors that the company is obviously worth potentially a lot more when it's been rumored that that's going to be the merger you're going to do. So then do you say, well, you know, if you're $15 billion originally, are you at $45 billion now if you're Rawlinson? Obviously, he wouldn't answer anything, Jim. But we all know SPACs continue to be another area of key speculation. I heard you talking with Andrew about it on your tease there on Squawk Box as well. Omar Ishrak out with his. A-Rod, of course, pricing his $500 million SPAC, Carl, as well. And then we got other ones coming. We got flying cars. We got electric planes. We got all sorts of stuff coming for SPAC land. Just can't wait.
You know, we're going to have Jared Bernstein in a second, but, you know, Larry Kudlow has a SPAC.
Yes, with Wilbur Ross. He's on the board of the Wilbur Ross SPAC. I pointed that out that day. I think it was Monday this week, yeah.
Do you have to be involved with the SPAC if you do the SPAC? Do
you have to be involved with it? Yeah. In some way.
You have to be involved.
You got to be involved in the process of picking the target. Yes. Not in running the company, but in picking the target company. Yes.
In taking the money. Oh, I'm sorry, target. You're absolutely right. Well, you know, we got to go back to Carl. I'm just a little confused about the time that people have to spend on their SPAC.
Yeah, Jim, we're in a new period. We'll talk about that in a minute. As David said, we want to get to the jobs number and bring in Jared Bernstein, of course, new member of the Council of Economic Advisors. By the way, Jared, congratulations. Good to have you.
My pleasure.
So the first read on the number is, given the weakness in hotels and restaurants and bars, that the print sort of reflects a period last month when things were closing and that we're already back to a reopening phase. Is the number stale?
I don't think so. I think today's jobs report shows that the U.S. job creation machine stalled over the past few months, and this underscores the urgent need for the President's American Rescue Plan. 49,000 jobs is far too low, but if you look at the private sector, it's only 6,000 in January. That's essentially zero. When you factor in the negative revisions, which are important, and about 160,000, that's a negative, over the past 3 months, payroll job gains have been 29,000. Now, back that up to the prior 3 months, it was over 1 million. That is a massive downshift in job gains, and it just shows you the extent to which the air pocket has really significantly dampened the employment creation function. And so the necessity, the urgency, the steep costs of inaction around the American Rescue Plan are very much, I think, amplified by this jobs report.
Does the argument for more stimulus, or at least a high number on the stimulus package, Jared, get more complicated when you've got the savings rate in double digits, ISM services 2-year high, a return to job growth, tepid though it may be?
Yeah, that's a very important and a fair question. The reason why the answer is that none of those statistics push anywhere near against the urgency of the plan is because we are deeply into a K-shaped recovery. You know, we can talk about GDP, we can talk about the stock market, but we also need to talk about rising poverty. We need to talk about 24 million people facing hunger, evictions, foreclosures. You know, there are still, even with the unemployment rate today, there are still 10 million people unemployed. Black and Hispanic unemployment rates are highly elevated, around 9%. 40%, this is a very high number, of the 10 million unemployed are long-term unemployed persons. That means they're stuck in joblessness for at least 6 months. So if you look at the people who are suffering the brunt of the virus and its economic impact, it's folks on the bottom leg of the K, the folks who are targeted by this American Rescue Plan.
All right, Jared, this is what's so disturbing to me. So many people got money who have jobs. So many people got money who, frankly, are doing well. And then the people who aren't got the same amount of money. Isn't it time to recognize, just as you just talked about the K economy, let's flood the zone of people who aren't doing well. Let's flood the zone of minority businesses that have been hurt more than businesses for people who actually we know are doing better. Why can't we just make it so that the people who need it get the money and the rest of the people just continue to lead their lives?
Yeah, so first of all, let me underscore, elevate, and amplify one thing you just talked about, minority businesses. We know for a fact that persons of color, entrepreneurs of color, communities of color were tremendously underserved by the business relief, the Paycheck Act. Now, the president, when he was campaigning, was always leading with this point when he talked to us on the phone about the problems that were ongoing. And so in the American Rescue Plan, the business relief is acutely targeted at businesses of persons of color. So that I think is a real advance. On your other point, again, if you listen to President Biden, he does talk about people who are in the middle class who are struggling, and he is 100% correct about that. You can still have a job, but you've lost hours, you've lost wages, you haven't been able necessarily to make your rent. You might be in mortgage forbearance, which means at the end of this period, you're going to be faced with a big bill. So I think some of these elevated savings rates among middle class families who often have zero or negative saving rates, to me, that's a feature, not a bug.
All right, so Jared, let's talk about certain industries that have been decimated. The restaurant industry's been decimated. The people going out, travel. Is there anything more that should be done there? Can we make it so that there are grants, maybe new, you have such great small business people in the administration, where there can be applications targeted to be able to say, you know what, when we're vaccinated, we want to reopen. Could you give us a no-interest loan, a low-interest loan? Get people back in the cities. Because, again, the minority businesses were the ones that were struggling, and they were doing great, and then they just got crushed, and we got to reopen them.
You are so right about this. And, you know, even with low borrowing rates, there are many businesses for whom a grant just makes tons of sense, and a loan is a very heavy lift. So I share that. And in the American Rescue Plan, trust me, we dig deep into precisely that problem. I think what all of this does, and today's jobs report is just, I think, such a powerful data point in this argument. It just underscores the cost of inaction. I mean, when you're adding 29,000 jobs a month on average over the past 3 months, that is a labor market stall. We have in the wings a plan that can finally get American businesses and families to the other side of this crisis and finally control the virus and distribute the vaccine to launch a robust recovery, one that's inclusively and racially equitable in precisely the way, Jim, you're calling for. So this report underscores the urgency of the American Rescue Plan.
Hey, Jared, it's David. An advantage for us, perhaps a disadvantage for you, is that we've been talking to you for years and having a conversation that's been ongoing. So I happen to know how important you have viewed infrastructure spending for many years. And I wonder, if you guys push through a $1.9 trillion plan under budget reconciliation, what does that mean for your hopes of getting infrastructure done as your next thing? Or why not have sort of incorporated infrastructure in some way in the current bill and try and get it all done at once?
My hopes couldn't be higher about getting an infrastructure bill down the road. But who cares about my hopes? It's the president's hopes that matter most. And trust me, he shares my view on this, or I should say I share his view. And here's why. You know, I used to testify in Congress in the Trump years. And after that testimony, I remember vividly once a couple of Republicans, I won't name the members of Congress, pulled me over and said, "Psst, Democrat, come here." And what they wanted to talk about was they wanted to do an infrastructure plan, but President Trump never gave them anything. I mean, his plan wasn't even an asterisk. It was just fluff. President Biden and our economic team, our Department of Transportation, we are already working on a robust infrastructure plan. And you don't make any guarantees in politics, so I'm not going to guarantee you. But I believe that that plan will get bipartisan support. And I'll be happy to come back here and evaluate
more than 60
that.
votes, Jared? More than 60 votes? Or you're going to have to do it again I'm not going to count noses, but I am confident
that Republicans have a real interest in doing more on infrastructure and investment in public goods, given how deeply we have ignored that. And that is at the core of a Biden Building Back Better agenda. First, we have to enact the American Rescue Plan, the fiscal relief to get to the other side of that crisis, and then it's Build Back Better time, when we start to focus not just on recovery, but on a much more robust, resilient, and racially inclusive recovery.
Hey, finally, Jared, two quick ones from me. One is there's a headline that Pelosi's under pressure to separate vaccine funding from broader COVID relief. Is that getting any oxygen?
I haven't heard anything about it. Look, to me, that strikes of kind of the wait and see problem, which is exactly why we're looking at a jobs report that has 6,000 jobs in the private sector, 29,000 jobs over the past three months. That's a job stall. That is the result of an air pocket caused by inaction and wait and see. We can't afford to do that again. And the American Rescue Plan is calibrated to reverse that damaging trend.
Okay. And then finally, any readout at all from Yellen's meeting with regulators on market volatility?
I have no readout on that. Others might.
All right. Jared, it's great to have you. Appreciate the guidance coming out of the number. Have a good weekend.
Thank you. You too.
All right, Jared Bernstein. We'll take a break here. Obviously, markets coming off the initial highs. Big morning of interviews. Jim Farley of Ford, Eric Nordstrom, first interview since becoming CEO, Evan Spiegel of Snap, and John Foley of Peloton. Don't go away.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us. Shaped by technology and human ingenuity. We can make it work for you and your business.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
shares of Exxon, they were up sharply, of course. In part, we discussed it, guys. You know, oil has been quite strong. But this also because of this continuing thing that I've been focused on, of course. Bloomberg reported this. I can confirm it as well. Jeff Ubben, somebody, of course, some of our viewers may know well, somebody I know well. Last associated with Nikola, you may recall, of course, but also having a very large fund. Remember, he's been the founder of Value Act. He left. He's got Inclusive Capital, a large ESG-focused fund. And they are in talks about at least considering bringing him on the board of directors. That would be quite a move for Exxon, one would have to say. Given Ubben's view of the industry and what needs to be done there to position it properly for the future. We talk about it quite often, Jim. I mean, not that Darren Woods hasn't given voice to many of these things, not that they aren't focused to a certain extent on carbon capture. They're way ahead of everybody in terms of certain technological breakthroughs, although they continue to invest in that. But, you know, there is a lot of tension still about their capital spending plan. As I pointed out, it's not just Engine 1 and CalSTRS, it's also D.E. Shaw that's been a part of this conversation. They didn't go after nominating anybody for the board, but they certainly are behind this idea of having Mr. Ubben join and making a large investment potentially as well. So that may be contributing to Exxon's move up, although to be fair, Chevron is also up nicely this morning. Exxon, though, has been, Jim, outperforming Chevron for a bit of time now as well, perhaps on the hopes that things are changing.
I'm beginning to get very impressed with the things that Darren Woods is doing. Darren Woods, the CEO. Got a hand that was just okay. Mike Wirth's hand's a little bit better. Mike Wirth's got a lot of growth at Chevron. David, Jeffrey Ubben would come in and he could say, listen, in order to get Exxon right, we have to do this carbon capture. We've got to be able to be the leader. We have to lower our emissions, our methane, more than we even think we do. I don't know, David. You gotta. Can people change stripes? David, this is a different Exxon. I'm liking what I hear. They put Ubben on, and suddenly what you have is a company that says, "Wow, we're going to change. I want change. They're going to give it to you."
Be interesting to see that boardroom with him in there as well. I don't know. We'll see if they can get there. I could imagine reasons they might be somewhat resistant to it, but you're right. Jim, it is a company. Listen, there's so many different things here that are wrapped up in Exxon in terms of the growth, of course, of EV, although even when you look at the projections, it's still not as though 50% of the energy mix, even by 2040, is not going to be gas. There's a lot of different components here, depletion curves and all sorts of other things you need to look at in terms of how they try to figure out how they're going about, Carl, choosing to spend their money right now and preserve their dividend, which of course they continue to do. It's quite a significant yield, though far less than it had been when the stock was at its lows not that long ago. Over to you.
Yeah. What a week of spend for Exxon developments. I got record highs this morning on the S&P, the NASDAQ, the Russell. Dow needs about another 100 points to get one of its own. We're back in just a moment.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Next on set, rapper Post Malone, also Mary Steenburgen, plus a closer look. And New York will soon permit weddings up to 150 people.
So now you can catch the bouquet and 2 variants.
This weekend.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say fall to September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
Some volatility in GameStop this morning. Bounced right off an early morning low of 51, up 37%, currently halted at 73.40. Got something to watch this morning on this Friday. Don't go anywhere.
Let's go.
Let me show you something.
What is this?
Every time we bought timber, I paid a little extra to regrow trees with my own money.
But why?
Why do you think?
On the next Managing Asia, Sim Wong Hu, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hu on the next Managing Asia.
Keep up with the crisis. Squawk on the Street on CNBC.
Let's get to Jim and stop trading.
We talk about electric vehicles all the time. Well, how about hydrogen? If you like hydrogen and ultimately think there'll be green hydrogen, the stock to buy is Linde, L-I-N. A remarkable quarter last night. Steve Angel doing terrifically. They're crushing Air Products in terms of their competitors. This is the way to play it and not have as much risk. And I know a lot of people like risk. That's plug power. If you don't want risk, you buy Linde.
All right, Jim, I know you got EL tonight, which I believe was helping to lead the S&P a moment ago.
Yeah, it should be Fabrizio Freda. Fabrizio's a genius, okay? First time on CNBC. Sanofi, well, you know, they've got vaccines. They're a very broad pharmaceutical company. And then Brunswick, are people still going to boat after we get jabbed? I think the answer is yes. Look at that stock. Guys, what a fabulous week. Thank you so much for letting me come from my home, but you know you can't keep me away next week.
Yeah, well, you're going to come back, I think, right? We'll talk Ford later on this morning.
Yeah, oh, absolutely. I'm going to rip the stitches out and then do Ford because it's time to play the game. All right? No more. No more hurt. I'm not on IR, for heaven's sake. Not on the pup list. I love you guys.
Jim, we'll see you in a little bit. Obviously, Mad Money's tonight, 6 p.m. Eastern Time. Good Friday morning, everybody. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Leslie Picker. Morgan Brennan has the morning off. Got some early record highs on the S&P, NASDAQ, Russell coming off just a touch, shooting for our best weekly performance since November. A big show ahead this morning. We'll talk with the CEOs of Ford, Nordstrom, Snap, Peloton, as well as Goldman's Jan Hatzius on this morning's jobs number. But we'll begin, Leslie, with more stories regarding GameStop and, of course, the Reddit trade.
That's right, Carl. Janet Yellen meeting with top financial regulators yesterday to discuss the ongoing volatility in names like GameStop and AMC today. Those stocks moving sharply higher. GameStop briefly halted, although it's since resumed trading, up 55%. AMC up 11%, trying to pare back some losses from earlier this week. So joining us now is Harvey Pitt, who's the chairman and CEO of Kalorama Partners, former SEC chairman. Harvey, thank you so much for being here on such an important week in the markets with regard to regulation. As we mentioned, there was that meeting of the minds, meeting of the regulators that took place yesterday. They released a statement where they said that the core infrastructure was resilient during the high volatility and heavy trading volume. They agree on the importance of the SEC releasing a timely study of the events. But I want to start by asking you, kind of beyond a study, beyond even enforcement perhaps, what do you make of the current security laws on the books right now? Do you think they need to be changed or altered in any way to account for this era of social media, commission-free trading, hedge fund participation, algorithms, all of that? Do they need to be modernized?
I don't think there's a need for a change in the rules or statutes that govern the trading. I think the difficulty is figuring out how this new environment of social media can or should be regulated. We've seen market volatility. I think the regulators are taking a look at it, and they're going to examine whether there was any improper activity. But at the end of the day, the real question is, can you prevent people from posting on social media what they think should be done with a particular stock? I think that gets into very difficult questions, and I think it makes it very hard to come up with new rules or regulations.
So you believe you can't prevent people from posting on social media, which would then leave the SEC to seek more of an enforcement mechanism. There have been reports that the SEC is reviewing social media for signs of potential market manipulation, fraud, and so forth. Supposedly, this is being done in conjunction with an examination of the trading data. What might the SEC even be looking for here? And how heavy of a lift is it to really comb through all of that data to find something that could indicate to them that there's manipulation or fraud?
Well, the technology that the SEC has at its disposal now is quite robust, and it's pretty much state of the art for purposes of checking into market patterns and transactions. I think the SEC is going to look behind the scenes at emails and communications. Who was putting the postings on Reddit and other places? What was their motivation? Are there any indications that what was intended was to manipulate or artificially influence the price of the securities? That's the key test here in a manipulation case. Did anyone post false information? Another key issue. Those are things that the commission is very well equipped to look for, and they will go through these materials and come up with an analysis that tells us what they have found.
You know, another area that's gotten at least a bit of focus, Harvey, is just clearance and settlement. It still takes a couple of days at least to get that done. In this digital age, one would imagine things might move faster. What are your thoughts?
My thoughts are that this has been a recurrent problem since I first started in this industry in the late 60s. And I think it is problematic that we don't have same day or next day settlements and look at transactions and know what the state of each trade is at the time the trade is occurring, so you can check on what is taking place. There's a lack of information, parity between people who buy and sell long and people who sell short. There probably needs to be more disclosure of short positions so that people are aware of market activity. But in general, I think we need to be able to move digitally to a same day or next day settlement process.
Yeah, it would seem that that is something that's possible. When you talk about more transparency on the short side, what do you think would be worth doing? I mean, people point to Europe, but I'll also say in Europe, they don't have nearly the liquidity in their markets that we do.
That's right, and that's why a lot of the attacks we've been hearing on short sellers are, if you'll forgive the pun, short-sighted. It seems to me that short selling enhances the marketplace. The real question is, do people know what the status of a particular security is in terms of who holds longs and who has shorted it? At present, when people purchase over 5% of an equity security, they have to report that. The short selling rules are not as robust, and I think what we need are better disclosures of short positions so that people are aware of who has what at what time.
Harvey, what do you make of the way that Robinhood has been handling things? The brokerage announcing yesterday that it removed some temporary trading restrictions. There was a bit of confusion when those limitations were first put on and all of the various changes surrounding those. Do you think that the company and its CEO took the right steps, made the right disclosures in compliance with securities laws?
Well, I haven't looked at everything that the company has said and done, but I would start with the proposition that Robinhood is clearly a victim of its own success. They came up with a novel way of getting millennials and others interested in securities trading. And they became so popular and so successful that when they met the social media push on GameStop and then AMC, the amount of trading required it to post higher security against potential defaults. Those requirements are necessary to keep the stability of the system and the financial stability in place and keep them intact. So Robinhood had no choice. It either had to eliminate some of the trading, or it was going to have to put itself at risk for a greater amount of money. Whether they made proper disclosure, I think, is something that the SEC and others will look at. But the point simply is you can't keep allowing people to trade unless you can post enough security and cash, and that's what Robinhood was trying to do.
Well, there is not a Robinhood restriction, but the exchange has halted GameStop once again this morning. So far, twice by my count, that stock up 48% right now. But thank you so much, Harvey Pitt, former SEC chairman, for your insights on this ever-evolving story. We really appreciate it.
My pleasure.
Meanwhile, we're watching J&J, as you know by now, requesting emergency use authorization from the FDA for their COVID-19 vaccine. Our Meg Terrell's with us, talk about what the timeline may look like for the coming weeks. Hey, Meg.
Hey, Carl. Well, that application from J&J for its one-shot vaccine going into the FDA last night, the company says that upon authorization, if and when it receives that, it will start shipping immediately and have 100 million doses ready by the end of June. And of course, this being one shot, that's enough for 100 million people. Now, how does this timeline? So we've also heard from the FDA last night that they set an advisory meeting of February 26th. That is when it's outside group of advisors meets to discuss all of these data. And in the previous instances with Pfizer and Moderna, the FDA cleared the vaccines the next day. So check out these differences in timelines. The blue dots there are when they submitted for FDA review. And then you can see how long between the review was submitted and the FDA advisory meeting. For Pfizer, it was 20 days, Moderna 17, and J&J is a bit longer at 22 days. You can see there that the FDA acted very quickly after that meeting the next day, clearing the vaccines, and then a few days later, they started hitting the market, guys. So there's already criticism this morning why the FDA is taking slightly longer for the J&J vaccine for the others, and others hoping that they would even go faster than those vaccines. Experts remind us that the FDA does its own extremely thorough review of these vaccines, and we'll get to see the fruits of that just a few days before that meeting on February 24th. So we're waiting for it, but after that, you know, J&J will start shipping. We don't expect tremendous supply immediately, less than 10 million doses probably at first, but that will build up over the course of the first half of this year. Guys.
Meg, thank you. Meg Terrell. Coming up, shares of Ford are reacting positively to earnings. They came in above street estimates, although, as you see, let's call it flat on the day. CEO Jim Farley is going to join the show next. Stay there. Don't want to miss that.
The countdown to the close of the European markets is sponsored by IG.
But you look at the occupancy rate of our retail properties, was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Welcome back to Squawk on the Street. Take a look at shares of GameStop, up over 40%. Still not enough gains to pare back some of the losses for the week, but clearly up quite substantially today after being halted twice so far this morning in just 45 minutes of trading so far. The day is young. Still ahead, though, Goldman's chief economist, Jan Hatzius, on this morning's jobs number. We're back in 2.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
Looks like GameStop's back in action, now up 35% after being up 48% prior to the second halt of the morning. Jim Cramer's back with us. He's going to join us to talk with Ford CEO in a couple moments. Jim, I'm curious to know whether or not you're buying this sort of vague notion that's been posited the last couple days that there's some sort of inverse relationship between GME and the broader market, that it's somehow replaced the VIX, or whether that's stale at this point.
Well, I like it just because it's obvious that it's captured the attention of America. But the one thing I have to point out is that unlike the VIX, which is actually just an algorithm, there's a real company at GameStop. There's real people who work there. There are people on the board. They have advisors. They have accountants. There's a man by the name of George Sherman, okay? He is the CEO. They have not made themselves available. They are incredibly ill-advised. They think somehow that this is that they have the right to remain silent. There is no Miranda warning here, Carl. This is a company that should be at the SEC saying this is what we need to say. We have to put this in perspective, but they're not doing that. They're hiding. And when you hide Matt Francis, new chief technology officer, when you hide your board of directors, what happens is we get a very unfair situation. And I think it's so unfair that it's time for Gary Gensler to make a phone call.
Huh. I know you tweeted a moment ago, just looking at the things they could do with a fresh raise of capital. You said they could buy a gaming company. They did make some leadership announcements this week. They created a new CTO. They hired someone from AWS. They're clearly not ignorant of what's going on.
No, but I've invited them on many times from Mad Money. Sunlight is the best disinfectant. They are obviously, I guess, traumatized. I don't know, paralyzed. They made those announcements, but the material nature of the stock, I know that I believe they don't think the balance sheet's that bad. There was a note. It isn't. They actually bought back a lot of stock. I was very close to this company when Paul Raines ran it, late Paul Raines, and I'm kind of embarrassed for them. I mean, this is a $5 billion company that has captured America. Yeah. They could very easily call a press conference, but the SEC, Gary Gensler, it's time for the Division of Enforcement to call them. The clock is ticking. The Division of Enforcement should call GameStop in. They should come on TV, and they should end this charade. Because it's time to stop hiding.
It's not like they're going to say anything. I don't understand. What are you expecting them to say? I mean, because they'll just say that we don't have anything to do with this. We're just trying to run our company.
Do they not have something to do with it?
Well, I don't know. I mean, obviously a lot of these people went in after Ryan Cohen, what's his name, the Chewy guy, came in. By the way, why isn't he collared his stock? I have no idea. And not to mention, Leslie Picker, have there been inside sales here at GameStop? I know Robert Frank was following costs yesterday, where you had the stock that was $4 forever, or $2, whatever it was, and then suddenly people have this windfall that they never could have imagined. Yeah. And they've been selling like crazy.
From what I could tell, they didn't have a shelf
Gensler
filed on that.
Right.
Gary
Gensler's the head of the SEC. Leslie, I would just kind of pay him a call or get their lawyers in, because there's so many people who are thinking about what GameStop's doing. David, GameStop may be doing something. There may be something material, but their silence to me has become deadly, frankly.
Well, they can just put out a statement that says we have nothing and can't understand the activity in our stock. But I don't know what beyond that. What you pointed out is they haven't decided to sell stock. And it's, a lot of people have different theories as to why they've chosen not to. It may have something to do with the gentleman I just mentioned as well. I'm amazed we haven't seen more insider sales there. I don't know.
Well, Adam Aaron took advantage of the buy in AMC. Look, these guys need to reinvent themselves. I mean, Zynga, David, you and I often talk about that. Maybe that's something they should be looking at. They have enough capital to be able to become something that they're not. Right now, they're a chain that has leases and does they're very lucky. There's a shortage of PlayStations. There's a shortage of Xboxes. But in the end, I'd like to see a plan. Now, David, maybe they have no plan whatsoever. Maybe it's just a colossal joke being played on everyone. But I like to think, David, that in the end, they're thinking people, they should be talking about what they're going to do. If they're selling stock, that's material.
All right,
and that is
by the way,
very
I don't know what you say. I mean, you had a business model, you were following it, you got an investment from a guy a lot of people think is quite credible. He went on your board. That was a positive, Leslie. And then this happened. I don't know what you really can expect them to actually do or say that's going to make any difference, Jim, in terms of the view of it. You seem to be trying to indicate somehow that the company's worth $70 a share. I mean, what?
No, I think okay, listen, I'm going to be really, let's just cut to the chase. I want them to sell 25 million shares right now, okay? Just sell it at the money. So therefore, we take off the idea that GameStop doesn't have a plan. Maybe raise money. It's crazy. They are getting an opportunity to become another company. They are getting an opportunity and they're completely blowing it, David.
I think use of proceeds are the biggest question here, because in these secondary offerings, you have to be super, super specific on what you plan to use them for. And I was talking around with a bunch of capital markets bankers about, why haven't they sold shares? What are they doing? What's kind of driving this? And one person joked to me that they should sell a bunch of stock and put it in Bitcoin and, help prop up the value of their company for a while. Although I don't think that would help their cause in terms of volatility.
Leslie, you just mentioned that you're going to double the stock.
It's a joke. Just to be clear, everybody, it is a joke.
It is a joke?
It is a joke.
They could get... Okay, because I thought you might... The stock's going to double with the Bitcoin.
But to the source's points, they don't have that much debt to pay down. Sure.
No, but they can use general corporate purposes. I mean, you can just sell stock and say it's for general corporate purposes.
You can, although for these secondaries, especially with what's going on.
Yeah, well, it's not a secondary; it's a primary offering, right? It's not it's not a sale by existing shareholders. I don't know.
Meanwhile, look at Activision Blizzard.
Yeah.
Look at Activision Blizzard.
No, right. Well, okay. Yeah. Bobby Kotick. Love that Bobby Kotick.
I'm thinking, boy, you got me spinning, Leslie. You got me spinning. I remember when Square did Bitcoin. PayPal mentioned Bitcoin. You got me going now. I may have to pay a courtesy call to George Sherman. By the way, if Sherman's nominated for Bitcoin, he probably will not run. I do think that it's literally become a kind of a comedy down there. I mean, it's something for, maybe, it's coming to me. The producers.
What, springtime for Hitler?
Springtime, yeah, there you go.
No, not that. Well, I'm just more comfortable with Bialystok. Put him on the board.
That's actually a great analogy.
Leslie, you are so darn smart. Leslie has the plan.
Great.
Leslie knows capital markets and Broadway, I can tell you that. By the way, Activision Blizzard is leading the S&P. We'll take a short break here, and we'll talk to the CEO of Ford in a minute.
CNBC's Healthy Returns Conference is all about the biggest developments going on in medicine and the things that investors can use to make decisions about where to put their money.
The majority of innovation in the last 10 years has not come from the top 10 pharma.
We've got FDA Commissioner Scott Gottlieb.
There are things that we can do to make it easier for the generic companies.
Craig Venter, he's a genetics pioneer.
Preventative health care could save the economy trillions of dollars.
At CNBC, what we do is we follow the money. Healthcare is 18% of the U.S. economy, so it's a huge business story, but it's also deeply, deeply personal.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Herrera, here's your CNBC COVID update at this hour. The United States recorded more than 5,000 COVID deaths on Thursday. That is the biggest one-day toll of the pandemic, topping the previous high mark by more than 600. Those numbers, according to Johns Hopkins. New cases, however, remain near the levels that we were seeing before Thanksgiving. UK researchers say the AstraZeneca vaccine is about as effective against the Kent variant circulating there as it is against previous versions. That study has not yet been peer-reviewed. And AstraZeneca says it expects results from its U.S. testing in the next 4 to 6 weeks. Hotel groups in Great Britain are complaining that they have not had enough time to prepare for the government's new plan to quarantine some travelers for 10 days in an approved hotel room. And in the Netherlands, testing facilities will be using a machine that can detect the coronavirus in a person's breath. A positive result would be followed up by a nasal swab test. You are up to date, Carl. I will send it back to you.
All right, Sue, thank you very much, Sue Herrera. Ford, of course, with numbers last night talking about the chip shortage, the economy, their commitment to EV. Our Phil LeBeau joins us this morning with a special guest. Hey, Phil.
Hey, Carl, let's bring in Jim Farley, CEO of the Ford Motor Company. Jim, lots to talk about. Let's start first off with the chip shortage, and then we'll talk about your EV commitment. But with regard to the chip shortage, look, you guys are cutting 10 to 20% of your production in the first quarter. You may suffer an impact from the chip shortage of $1 billion to $2.5 billion this year. How bad is it, and how long do you expect it to last?
Well, we're really seeing visibility, Phil, high in the first quarter. We think it's a first half issue. In fact, we're planning on increasing and recovering some of that with production in the second half. We have about a 26-week supply chain from wafers until we get our control modules to go in our vehicles. And, it's too early to tell. It's a shortage across the industry. It'll affect everyone. It's early days. We're doing a lot. Ford knows how to scramble. And we're adjusting yield management, moving the chips that we do have to the most profitable vehicles, our electric vehicles, protecting production of strategically important vehicles. We're working through it right now, early days.
Let's talk about, you mentioned electric vehicles. Let's talk about the commitment you guys announced last night. $22 billion that will be going into electric vehicles through 2025. Doubling your commitment, essentially. You said on the call last night, this is it. We need to become the player in electric vehicles, not just a player, but a leader in electric vehicles. Does this get you there, or do you think that this is simply the latest commitment and there's going to have to be more down the road?
Well, first of all, we're not going to cede the future to anyone. And our electric strategy is very specific. We're going to invest in segments where we're the dominant player and we have scale, like the F-150, the Transit van, or Mustang. And today, this is a year. We're not talking about aspirations. The Mach-E is out now. We think it's a credible competitor to the Model Y. We have the E-Transit coming later this year, the F-150 electric. We're building a plant right now in Dearborn, almost $1 billion investment in that plant, and that comes out in the middle of next year. We're going to really invest in commercial and performance vehicles. We're really excited about this change, but our strategy is very specific. And, it's happening now. 1 out of 10 vehicles in Western Europe in December that were sold were a pure electric.
Jim, how worried are you about a potential battery shortage for the industry? Specifically, we're talking about battery cells. Adam Jonas from Morgan Stanley out with a note today saying that he's increasingly hearing this from their clients saying, look, everybody and their uncle wants to come up with a battery electric vehicle right now, as you were indicating. There's not enough supply right now, so the question becomes, are we hearing aspirational goals from you and other automakers that you really won't be able to meet to the full capacity because there's just not enough battery cells out there?
I can't talk about other people. In the first inning, a lot of companies like us, we bought our cells. There was actually an oversupply situation, and but now with these ramp up in production, these plants going in place, we have to secure supplies so we don't get in a situation like we are in chips. And that's going to come down to every manufacturer making the commitment. We have our own decisions to make on vertical integration. Our $22 billion does not even include that. More news from us. You could expect more news from us on that vertical integration. It's also really important for our labor strategy to move that chip production in the United States. Those are bad shippers. They need to be near our plants. And that's really important for our country.
Guys, Jim,
if I can speak to
yes,
Jim, I think you came out swinging. Jim, you came out swinging on this call, and you mentioned something, and you talked about Model Y. I got to go right to it because I think that this is something that our viewers really want to know. You said our first all-electric, and I am reading, our first all-electric Mustang Mach-E, which we, and more importantly, others believe is the first credible mass marketing competitor to Tesla. Tesla doesn't do any advertising. Tesla doesn't have to. People love Tesla. Isn't that hubris, Mr. Farley?
No, I don't think so. I mean, look, we're a humble company. It's Ford Motor Company, but we're ambitious. We spent a lot of time on this vehicle. It's got Detroit swagger. It's got great technology, a fantastic range. We still have 127,000 benefits of the 7,500 tax credits, so the price is in the mid-30s. It's a fully competitive vehicle with the access to the best charging network in the U.S.
Okay, but let's talk about the notion of who Ford is. That when I spent 10 years ago, I went to Ford, to the River Rouge plant, which was just kind of very old-fashioned metal bender place. And what did we talk about? We talked about Ford making the best cars everywhere in the world. The Ford that I'm listening to, the Jim Farley Ford, is about making profitable vehicles everywhere in the world. And if they're not profitable, I don't know, Jim. You're breaking the tradition. It sounds like you don't want to lose money on cars.
Correct. Yeah, we took the tough actions in Europe. We just announced the manufacturing withdrawal from Brazil. Look, we don't have that luxury. We have to make money. If we don't have products or even regions that aren't profitable, we're dealing with those. Why? Because that funds our whole modernization of the company and ultimately our disruption of ourselves. We have to have profitable business. Not only is it good for shareholders, and that's what they expect for us as leaders, but also it is the lifeblood of our investment to modernize the company.
Jim, it's Phil again. Yesterday, we reported that Apple is close to finalizing a deal with Hyundai Kia to manufacture an Apple car, potentially at the Kia plant in Georgia. Now, it may not come out until 2024, and that's even if they can hit that target that's out there. But there's no doubt that they are moving down this path. They've had conversations with a number of automakers. Two-part question for you. First of all, what kind of conversations have you had with Apple in the past about their aspirations when it comes to an Apple car? And more importantly, what does this mean if there is an Apple car come 2024, 2025? What does it do to your planning?
Well, first of all, I'm not going to go into rumors. I don't know much about all that. All I can say is we've had a great relationship with Apple. We're really focused on CarPlay. We made a big announcement on Google, but we really want that CarPlay experience in the Ford cars to be the best Apple experience out there. And we'll keep working with Apple until that happens. And they're very ambitious. They want that experience to be better and to be fully competitive. As far as, new competitors, we're going to see lots of new competitors in our industry. That's great. But Ford is focused on the segments that we dominate already. We're 50% of the commercial business in the U.S. That is who Ford is. Super Duties, transit vans, police interceptors. And that's where we're electrifying because we have large scale. We sold more than 780,000 F-Series last year. Some of them have duty cycles that are perfect for electric because the population is so big. They're asking us for electric E-Transits. And so that's our strategy. And it's not, and it's simple. Focus on what we do best.
But do you expect Apple to ultimately have an Apple car?
I can't talk about other companies and their ambition, but we should expect in our industry all sorts of new competitors. I don't know who they're going to be. Rivian's making a van for Amazon for their delivery business. We shouldn't be surprised by that. It's a great industry, a lot of customer engagement. But in the end of the day, Ford's strategy is to focus on what we do really well, which is commercial and performance.
Jim Farley, CEO of the Ford Motor Company, joining us today. Thank you, Jim. We appreciate you taking the time to talk with us, laying out their strategy for the future. Carl, I have to tell you, and I know I've talked with Jim Cramer about this, if you listened to that Ford conference call last night, a complete 180 compared to where this company was a couple of years ago. I mean, he was strong, he was declarative, and he basically said, this is where we're going. Now, will they get there down the road? That's the challenge to execute, but far different approach than what we saw just a couple of years ago.
Yep, something that Jim saw coming a while ago. Phil, great stuff. Thanks to you, to Farley, and of course to our own Jim Cramer. That's our Phil LeBeau talking Ford. The U.S. did return to job growth for the month of January as the jobs number comes in at 49K. Unemployment falls to 6.3. Joining us to talk about that, Jan Hatzius, chief economist of Goldman Sachs. Jan, happy Friday. It's good to have you.
It's good to be on. Hello.
Hello. I know you took a cue from ADP and you upped your estimate to 200. Any explanation for why it came in, I guess, a little south of at least your expectations and some others too?
Yeah, we shouldn't have upgraded, obviously. I think explanation is leisure and hospitality was weaker than we thought. The decline in December was not it, but we had another meaningful decline, and we also didn't get the boost in some of the other areas that we thought was going to come from seasonal factors. So the headline definitely on the weaker side in the establishment survey in the payroll numbers. That said, we did have a big increase in the work week. So hours worked in January were actually up pretty significantly. Temporary help services also up. So some of the more leading parts of the payroll report I thought were actually pretty encouraging, even though the headline number clearly weaker than expected, at least what we expected.
Right. The president a moment ago in the pool spray today said at the current rate, it will take 10 years to get back to full employment. He was responding to the jobs number. How would you advise viewers to separate the numbers and the trends themselves from obviously the legislative push that we're under, and in this case involves trying to highlight the risks in this print, not the upside?
Well, I would say that these numbers are very volatile. We've been going through a weaker period in the economy. The virus situation has deteriorated since the fall. That's weighed on the economy, especially in areas like leisure and hospitality. I think all of that is going to change in coming months. We're seeing the virus situation starting to improve, and the seasonals and the higher temperatures over the next few months, I think, should reinforce that trend. We're also seeing, more rapid vaccinations that will also help. So I think we'll have a improved situation in terms of the virus, and that's going to have important implications for the economy as well. Fiscal policy is also turning much more stimulative. The president is making a strong case that we need to do more. We are building in a significant further package, not quite the 1.9 trillion, but we're at a little over 1 trillion on top of the 900 billion that was passed at the end of December. So I think there are a number of factors to expect a pretty sharp acceleration in growth over the next few months.
Jan, do all of those tailwinds that you outlined help bring people back into the workforce? About 400,000 people, civilians, have left the labor force. Is the snapback as quick in kind of getting them back into the labor force, or does that actually take some more time to filter through? And is there anything policy-wise that the government should be doing to bring people back?
Yeah, month to month, these kind of labor force numbers are, very noisy in the household survey, especially when you have this change in the population controls. That's sort of a structural break that occurs once a year at year end. But you're right that there's still labor force participation is still well below where it was prior to the pandemic. Employment is still very far below. There's still a very substantial amount of slack in the economy. So I'm certainly not saying that we're close to full employment or anything like that. What I'm saying is we're still in a pretty deep hole, but we should start to climb out of that hole quite a bit more quickly in coming months.
But Jan, I'm just curious, do you think 1.9 trillion is the right number, or is there any concern that it could even overheat things?
I mean, I don't think we're going to have overheating of the economy when, the employment to population ratio is still 4 percentage points below where it was last February. It's going to take not only a rapid pace of growth for, a few quarters, but actually pretty strong growth for, a couple of years before we're really at levels where I would be much more worried about overheating. So substantial fiscal support is, I think, the right policy, and I do think it makes sense to do more. We think ultimately it's not going to be quite as large as 1.9 trillion, but I do think fiscal policy being expansionary is a much better approach than what we had in the aftermath of the last cycle. Both monetary and fiscal policy have been a lot more proactive, and I think that's an important reason why we're climbing out of this unprecedented downturn, I think, pretty quickly, or will climb out more quickly.
Yeah. After the Georgia Senate seats were settled, Jan, you did put out a note saying that you thought Q1 stimulus would probably be about 1.1 trillion. I wonder if that number is still fresh in your view, and whether or not you've been surprised at the path or the speed of the path to would-be reconciliation.
Yeah, we've been lifting it immediately after the Georgia Senate results. We actually said 750, then we lifted that to 1.1 trillion. And I would say the risks to that are probably still on the higher side. I mean, it's still going to be a while probably before we know for sure. But the path has definitely gone in a more expansionary direction, and that's, I think, further lifted the expectations for growth. So we've been lifting our GDP expectations as well from levels that were already definitely on the higher side relative to other forecasters, and maybe there's even further to go. There are some downside risks as well, of course, and we're still dealing with a very dangerous virus, and there are many uncertainties around there. But I think fiscal policy is a reason why ultimately things might be even a little bit faster than what we have in the forecast at the moment.
Yeah, we do have to give you some props, Jan, because your calls in 2020, in retrospect, have turned out to be very good. And just another sign of just how hard 2021 is turning out to forecast. Good to see you. Thanks as always.
Thank you very much.
Jan Hatzius of Goldman Sachs.
Coming up in a few minutes right here, Nordstrom CEO Eric Nordstrom on the heels of the company's Investor Day. It's going to be his first broadcast interview since he became CEO. That's almost a year ago. And hey, come on, you got to check GameStop, don't you? Can't let 10 minutes go by. There it is, up 31% off the highs, but certainly a significant percentage increase. AMC also a bit of a gainer. We're right back.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Welcome back to Squawk on the Street. February is Black History Month, and we're hearing from some of our CNBC contributors. Here is RBC's Global Head of Commodity Strategy, Halima Croft, sharing her gratitude for the trailblazers that came before her.
Think about the sacrifices that generations before us made to put us in the position that we are now. I think about everyone who participated in the Montgomery bus boycotts and what they went through. And so whenever I'm feeling down, I just remind myself that I'm standing on their shoulders and I have the obligation to push forward because they blazed such a path for me and for you as well.
You'll see a lot more on Black History Month over the next few weeks here on Squawk on the Street. But for more on Halima's story, head to CNBC.com. Stay with us.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
there will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say over September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
Had a new strategy for the retailer at the company's Investor Day yesterday with an emphasis on digital and its Nordstrom Rack stores, also signaling slightly weaker sales for 2021. It did send the shares down a bit, although you see only off by 0.5%. Joining us now first on CNBC is Nordstrom CEO Eric Nordstrom. Eric, great to have you this morning. Fiscal year 21, you're talking about digital being as much as 50% of overall revenues. Given what you've gone through over the last year, could you ever imagine opening another physical store, even your smaller format?
Yes, we can. I don't think for our Nordstrom stores, we don't have any plans to open there. To state the obvious, hard to see new mall development going on, but our Rack business, we see a lot of opportunity for growth there, and it very well could include new physical stores.
And digital, 54% this last quarter, you see it as much as half of all revenues. That is where the investment, I guess, is going. Tell me what Nordstrom really will look like then as a retailer from here on, given we know it, of course, by those stores, by the 249 Rack stores and 100 full-line stores, but really digital seems to be the future for this company.
Well, it's really a combination. I mean, it has to start with the customer. We put the customer at the center, and customers, there's not channel customers. Customers shop as they want to shop. And I think you see in a number of different categories, retailers who've been very successful by leveraging their physical assets and layering on digital assets on top of that. And that's certainly what we've been investing in over these last several years. And while we don't know exactly how it'll play out, people will return to stores. We believe in stores. We believe in digital. And our physical portfolio, we have Nordstrom stores, we have Nordstrom Rack stores, we have Nordstrom local service hubs that we've launched in Los Angeles and New York that have been very successful for us. So we really like that mix of physical assets, and pairing them with our digital assets, we think we can serve customers better.
I actually recently was in your beautiful store on 57th Street in Midtown Manhattan on the West Side. I was one of the few customers in there. You know, what is the future for a store like that? I mean, and when you say get back to sort of normal, do you expect that customer counts will return to what they were in 2019 in stores like that?
No, we don't think normal is going back to pre-pandemic levels. But, I mean, this is a strange time, particularly big urban centers. You don't have office workers, you don't have tourism. And for what we sell, there's headwinds that the pandemic has brought for a lot of fashion. That is a moment in time. People, people will return to getting out and getting out amongst people and interested in getting something new. And that day is looks more sure than ever with vaccines rolling out. So, yeah, we do believe in physical stores, and in particular, New York. New York's unlike any city, I think, really in the world, and really love our location there and how that store's come out.
Yeah, it's a beautiful store. Finally, I noted you did spend a good amount of time on your investor day yesterday during your chat, I think, your fireside chat, talking about ESG. Why?
Well, it's evolved over the years, and where for a number of years it's been a very important subject for our employees, and to be a great employer, an employer that our folks can be proud of. Certainly, it's been paramount to focus on that. It's been more important to customers as of late, but in particular to investors, where some of these governance subjects were dealt with separately. It is really core to a lot of the big funds in their investment decisions. They want to know what companies are doing. They want that transparency, and we think it's the right thing to do.
Well, Eric, we're out of time today, but look forward to having you back in the future as well as we track your company's progress. Thank you.
Thank you.
On the other side of the break, Snap CEO Evan Spiegel on the quarter and the guide. Squawk Alley starts in a couple of minutes.
As far as the Bank of England is concerned, the outlook seems to be relatively optimistic versus what people were expecting to hear.
You should see the strong growth we have and the fact that it's stronger than the forecast we had in November later this year really as a function of the lower starting point. In levels terms, we're not any more optimistic than we were 3 months ago, but I think the vaccination rollout gives us a little more confidence.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Santa Monica, California. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Friday. Welcome to Squawk Alley. I'm John Fort with Carl Quintanilla and Julia Borston. A big hour ahead. Snap co-founder and CEO Evan Spiegel joins us in just a couple minutes. And later this hour, we're going to have another exclusive with the CEO of Peloton. But we're going to start with the volatility still in the meme trade as GameStop surges again after a steep drop yesterday. But Carl, you know how percentages go. These aren't the actual numbers, but if you drop 50% one day and then you rise 50% the next day, you're not back at break even. You're only halfway there.
Indeed, although, John, the highs of the session today have taken out yesterday's highs, so it is a truly volatile mix. I will point out, though, Julia, GME bouncing off of 5109. That's basically the 50-day moving average. So we're back in an environment where you are looking at a stock behave the way stocks sometimes do, and that is bouncing off averages.
That's right. And I think the other question that we're going to be examining with GameStop is whether or not it was really retail traders driving a lot of that volatility. JP Morgan issuing some data showing that institutional investors were actually driving a large portion of that trading activity next week. And John, it really seems like this might be the start of a reckoning of not just about a populist trading, whether it's retail investors versus institutional investors, but really digging into understanding who's actually benefiting from the movement in these stocks.
Yeah, Julia, I mean, Reddit might have gotten it started, but it's not like this is an invitation-only party. I mean, it's the market, right? Anybody is free to play. And when there's volatility, there are people who make a living playing off of volatility, whether it's up or down. So you can be sure, especially given all the talk about this, I mean, it's been nuts. My 10-year-old and my 12-year-old were talking about GameStop all week. Everybody's aware of it.
That's right, John. It has been quite a story. But now let's turn back to Snap. Shares of Snap fell initially despite a blowout quarter. It was softer Q1 guidance that was the catalyst there, but that stock is now up over 3%. Here with us now exclusively to talk about Snap's fourth quarter results is Snap co-founder and CEO Evan Spiegel. Evan, thanks so much for joining us this morning.
Julia, thanks so much for having me, and happy Friday.
Happy Friday to you as well. So, Evan, you beat pretty much across the board: user growth, revenue, earnings. In even your guidance for first quarter revenue was stronger than expected. But the stock did this dip last night on a warning about the first quarter. Tell us what that warning was.
Well, I think what people are really focused on are our investments in Spotlight, which is a new platform that we're super excited about. It launched in November, and it gives people an opportunity to share their best snaps with the entire Snapchat audience and be rewarded for their creativity. So we're distributing $1 million a day to the top performing creators on Spotlight, and that's something that we are continuing to invest in Q1. But I think it's important to put our EBITDA guidance in perspective. We've doubled revenue in the last 2 years, and 47% of that incremental revenue has fallen to the adjusted EBITDA line. So there's great progress overall in the business, and we just see a huge opportunity to invest in Spotlight, which should increase our overall revenue opportunity over time.
Now, Evan, there's been a lot of talk with companies in the fourth quarter about whether or not the growth they saw in 2020, particularly around users, was a pull forward from 2021. And I'm wondering if you think the kind of revenue and user growth you saw is going to be sustainable into the next couple of quarters.
Well, despite our accelerating user growth, we actually view the pandemic lockdowns as a drag on our growth overall. We've seen is that people's friend groups actually tend to get a bit smaller. They make fewer new friends. They're not out and about as much using our camera and posting snaps to their stories, for example. So, I think actually for us, as we look at the end of the lockdowns and maybe the resumption of a slightly more normal life, certainly based on the data we've seen from other cities that have taken maybe a less aggressive approach to locking down, it's actually something we're excited about and looking forward to, and should be a tailwind for other products like our map, for example. We have a map that shows you a really personalized view of the world, where your friends are, what they're doing, the places that are important to you. And that map should actually benefit from increased engagement as people get out of the house and go explore and meet up with their friends.
Evan, I want to return to something that was part of the warning around the first quarter results, and that was about Apple's operating system change that's about to launch. We don't know exactly when it's going to launch, but it will launch soon. And you said you expected to have a meaningful impact on your results. You don't know how big the impact will be, and that's really about limiting targeting of how you target ads to consumers. What is the potential impact, the potential greatest impact of that operating system change?
Well, we factored that impact into our guidance. So we're projecting 56 to 60% year-over-year revenue growth in Q1. And our business was really strong in Q1 of last year. So I think it's a solid comp. And so we're definitely excited about the momentum we're seeing. The reason why we're highlighting some of the policy changes that Apple is making is that they will impact our ability to effectively measure and optimize advertising outside of Snapchat. So what happens today when someone sees an advertisement in Snapchat and maybe later they go buy a product or download an app, we're able to track that conversion and attribute it back to Snapchat advertising. Apple's making some changes in the way that we're able to do that and restricting our use of effectively personally identifiable information. What they've provided instead is their own proprietary measurement solution called SK Ad Network. So we've implemented that, and we're also building our own solutions that use aggregated data to help drive optimization and measurement for our advertising partners. That's in addition to our conversion API and measurement kit. For example. So we feel like we're well prepared for these changes. And frankly, that's because these changes are in line with our privacy philosophy. We've never allowed device specific targeting, for example. And we've always taken a very protective stance when it comes to our users' data. So we generally view this as a good thing overall for consumers, even if it's a little disruptive for advertisers in the near term.
And Evan, good morning. It's John Fort. That's a great place for me to ask this question, I think, which is take us over this ride of the past 4 years, essentially, because you've got, if you look at the stock chart, and we've spent a lot of time looking at stock charts, I want the strategy and the management behind the stock chart. You spent a couple years going down, and then in 2019, there's this turnaround. So when things are going down, everybody's down on Snap, and there's everything that's wrong with it. But it's so interesting to me that in technology companies, sometimes leaders stick to a certain kind of principle despite the crowd going against it. And now it seems like the tide is turning toward that principle that you just mentioned about some things like privacy that you were really talking about all along. So talk to me about morale within the company. Talk to me about how the strategy started to perhaps show up differently, and maybe some changes that you made to help that happen.
Yeah, it's certainly been validating, especially as you mentioned around things like brand safety. We were so frustrated for so many years because it just didn't seem like advertisers cared about things like user privacy or brand safety. And they were just focused on driving ROI, driving results. And that's why we invested so much in our advertising platform so we could really drive that performance. And we were just hoping over time that advertisers would understand and value not only the closed content platform where we moderate the content that our community sees, but also our values around privacy and really building a product that leaves a positive impact on people's lives. So it's definitely been validating and motivating for the team, but we also feel like there's a lot more work to do, and we have a lot of new opportunities in things like augmented reality, for example, because we believe that the power of overlaying computing on the world is going to be absolutely transformational. And we want to make sure that those privacy practices and the way that we think about our platform is really embedded in that transformation as we go from these little mobile screens to wearable technology and computing overlaid on the world.
So taking that further, can you talk to us about maybe the soft benefit that you are seeing now from sticking to that philosophy and strategy, whether that's in recruiting and morale or whether it's in product development, because you haven't based your strategy on a type of data that's now at risk of going away for you?
Yeah, definitely. I think there are many benefits. The first one is that everyone at Snap can really sleep well at night because they really feel like they're making a positive impact in society. And I think that's been even more clear given some of the incidents earlier this year, how critical it is to be thoughtful about the type of content that folks are distributing and the way that they structure their platforms and gather user data. So I think one of the things that has been really helpful is just that now that more advertisers, more businesses are paying attention to this and caring about this, it's a lot easier to have those conversations. And so we're actually being invited, at the C level, for example, at very, very large brands that, maybe a couple years ago would have been hard to get a meeting, just to hear our perspective and understand how Snap is different. So I certainly think getting our foot in the door is a lot easier these days because some of those long-term bets we made, 9 years ago are starting to pay off.
Yeah, and it's something, Evan, we've talked about ever since IPO day, the degree to which you guys have zigged while others have zagged. I am curious, though, it's not surprising to hear you sort of agree, at least at large, with the Apple point of view. Tim Cook did say last week, we can no longer turn a blind eye to the theory of technology that says all engagement is good engagement. Would you fully endorse that view, and how do you see the war playing out between Apple and players who obviously have a much different stance?
Gosh, yeah. Well, I certainly think that folks have different perspectives in this space. But, what Tim has said is really aligned with how we built our business from the beginning, and particularly when he's referencing content, that aligns with how we built our content platform. And so rather than providing a platform where anyone can say anything and reach millions and millions and millions of people, whether that information is inciting violence or fraudulent, we took a different perspective and said, we're going to be thoughtful about the content that reaches millions of people, just like you are at CNBC. And so we're going to moderate that content. We're going to make sure that content's aligned with our content guidelines. And overall, that will create a much more positive experience for our community and also, educate them more meaningfully about what's happening in the world. So, yeah, we've definitely taken a different path from the beginning. It just so happens that path aligns with what Apple's talking about. But, certainly there are different perspectives in the industry.
And do you think investors at large, in aggregate, when they watch big tech or social media, need to reset their expectations for what true engagement growth is supposed to look like, giving some of these new frictions?
I don't think so, because I really don't think it's either or. What we've been able to do over time is innovate so that we can continue to drive engagement growth and user growth while simultaneously protecting user privacy. I don't think you have to promote conspiracy theories to grow your technology business. And we certainly have demonstrated that there's another way. So I don't think investors need to make those sorts of trade-offs. And I actually think if you look at the growth of Snap over the last couple of years, it validates this different strategy of focusing, on premium content partners, on moderating content, and being thoughtful about what you're distributing to your community.
Evan, speaking of moderating content, yes, Snap has zigged when others have zagged, as Carl put it. But what's interesting is Spotlight now, which obviously has grown very quickly, just launched in November, now 100 million users. That is user-generated content, and you do have to worry about moderating that. How is that going for you? Because you've never had to worry about moderating content before. Before it was all either premium content created by companies such as NBC Universal or people just communicating directly with friends. How big of a challenge is that now?
Yeah, well, we've certainly moderated influencer content in the past. And so we do have that muscle built at Snap. It's really just been about scaling that. And of course, we've only launched Spotlight into a couple select markets at this point. And as you point out, it's gotten great traction with 100 million people using it in January. But we've been able to slowly roll that out to manage the growth, obviously, in content volumes and our moderation practices. But we're using a combination, obviously, of machine learning and humans, making sure that there's human review of any content that's getting wide distribution. And so far, knock on wood, that strategy is working. And we'll continue to roll out to new markets as soon as we can support it.
Evan, just this morning there was news about Senator Warner preparing to unveil a bill that would reform Section 230. There's been a lot of talk on both sides of the aisle about reforming Section 230 and making platforms more liable, more responsible for the type of content that is shared on those platforms. Where do you stand now on that reform, especially now that it would apply much more to Snap than it would have even 3 months ago?
Gosh, well, because we moderate all of our content that we distribute widely, I actually think that the Section 230 reforms are maybe less impactful to Snap overall, but they certainly would be impactful to the industry. I think the early intent of Section 230 was actually to promote freedom of expression. For example, if someone leaves a restaurant review that's scathing and the restaurant owner gets really upset, they can't just sue Yelp to get them to take it down. And so it's actually, I think, promoted freedom of information and freedom of expression. I think what people are objecting to is really the second part of Section 230, which provides these platforms a right to moderate the content that's on their platform in a couple broad categories, around harmful content and things like that. And I think what folks are saying is that, instead of being a right, maybe that should be a responsibility. And I think the way that they're going to try to thread the needle here, I would assume, is to really focus on a responsibility to take down content that isn't protected by the First Amendment. And that's probably the way to thread the needle legally. The First Amendment doesn't protect things like incitement or fraud or things like that. And so I think there may be a reform here to require companies to take down that type of content or moderate that type of content.
We heard from Senator Klobuchar earlier in the week, who's going to be looking at ways in which Congress might be able to, say, increase the fines from DOJ against big tech, or even limit the way in which large players buy smaller rivals through M&A. Do you see that as a material risk?
Gosh, it'll be interesting to see how that evolves overall in the industry. I think we're at a sort of precarious juncture, because if you look at global competition in technology, many other governments around the world are going to great lengths to really support and prop up and invest in new technology, which is so important to the future. If you look at any of these major advancements in modern economies, even going back to the Dutch or, the British Empire, a lot of them are catalyzed by technological advancements. That's certainly been the case here in the United States. So I think we're in a bit of a precarious position, because we really need these tech giants to be investing in the future, to be making really big breakthroughs. The future of the United States depends on it. At the same time, we need to have markets that are fair, where, small companies, or startups, certainly like Snap, are able to thrive and succeed. So I think overall, as I look at the regulatory framework, I just want us to all remember as Americans that, regulations aren't substitutes for morality and for doing the right thing. And so I think as long as these businesses can focus on doing the right thing, acting in ways that, overall support and uplift American society, there'll be less need for regulation. And overall, that will make us more competitive as a nation.
Evan, in your earnings report, one of the things that made me do a double take was the daily active user growth in rest of world, that's outside of North America and Europe, up 35 million, 55% to 99 million. What really is driving that? Because you talk on the call about augmented reality lenses, the increase in application performance. Is this an engineering and product market fit story? And how much does that have legs?
Well, it's really a team-wide effort, because it's not just one thing. If you'll remember, 2 years ago or so, we were really struggling to grow outside of the U.S., especially in the rest of the world, because, our Android application was just not performant. It wasn't working very well. And our back-end systems were, not regionalized. They were pretty slow. And so the product experience just wasn't very good for folks outside of the U.S. and Europe. So we invested a lot in the fundamental, technology that underlies Snap, that's made the Android application much more performant and easier to use. And on top of that, of course, we continue to innovate, especially around augmented reality. But we've also, made partnerships with telcos, for example, to make Snapchat more accessible. We've localized content by working with local content partners. And of course, we've customized our augmented reality experiences for all the different places where, Snap has a large audience. And all of that has, really contributed to this growth that we're seeing around the world.
And so how is the model around monetizing those users in rest of world different? Because I seem to remember at the beginning, well, not the beginning, but right before you guys went public, there was a lot of talk on how iOS and the iOS user being more premium in North America and Europe was more important and more monetizable. Now that you've got this rest of world growth, what's the business model around making that a really sustainable part of the business?
Well, I think the important thing to do is to continue to focus on our cost structure and our cost to serve each incremental member of the Snapchat community. And we've been able to keep that roughly flat over time, despite these increases in engagement and these increases in the user base overall. And so that will allow us, of course, to monetize our user base and to generate cash flow from all the incremental, users that we add outside of the U.S. and Europe. But I would say, in the near term, the United States and Europe represent a massive opportunity. I think for a lot of these larger advertising platforms, they represent about 70% of overall revenue. And so I think if you look at the near-term revenue opportunity, we're definitely investing a lot in the United States and Europe, and other markets where we have significant penetration of smartphone users, like Australia, for example. And then longer term, we'll focus on monetizing users outside of the United States and Europe. So we're starting today with resellers, for example, to scale those monetization efforts, but we'll invest more meaningfully as those audiences get to scale outside of the United States and Europe. I mean, we barely scratched the surface when you look at, just 13 to 34-year-olds outside the U.S. and Europe. It's a massive population, and our product really resonates with that audience.
Evan, it's impossible to talk about communications platforms right now without talking about Reddit, which has been such a phenomenon, particularly in recent weeks, in terms of driving these trades that we were talking about at the beginning of this show, such as with GameStop. And I'm curious what you think of this phenomenon and how you think about how these platforms and the conversations on them need to be, perhaps the people on them need to be perhaps held accountable for what they're talking about.
Well, I think the thing that gives me a little bit of comfort is if you take us to the fact, this speculation really represents a very, very small percentage of the overall market. So I think, looking at the big picture, overall markets are actually quite stable, which is something that is reassuring despite some of the news stories. I think separately, one of the things that our generation really paid a lot of attention to is, in the wake of the 2008 financial crisis, a lot of young people obviously were out of work and they didn't have an opportunity to build wealth the way that many older people did by investing at the bottom of 2008 and really riding that, obviously, really up until the pandemic. And so I think a lot of young people learned a lot from that experience and have been looking for opportunities to invest. And when you combine that with this revolution that's happened with these online financial platforms, I think something like 10 million retail accounts were opened in 2020. I really think there's a compelling opportunity, for young people to build wealth. We invested in a company called M1 Finance, several years ago that takes more of maybe a long-term view of wealth building rather than some of these, day trading applications. But just to see the way that, the democratization of these finance platforms can help young people build wealth is really exciting. So I think just looking at the broader opportunity, it's easy to look through some of the short-term volatility, which is really isolated to a very small part of the market.
And Evan, when you talk about this sort of revolution, the truth is that a lot of these people who are on Reddit are Snapchat users or certainly of the same demographic. What is the opportunity there for you and for Snap beyond that investment you made a couple years ago?
Well, we're really still focused on the opportunities inside of Snapchat, but we do believe over time there will be opportunities to provide additional services to the Snapchat community. One of the ways that we're doing that and scalably is through minis, which are these little utilities inside of Snapchat that all sorts of different brands and companies can use to reach the Snapchat audience. And that's part of this trend, I think, towards on-platform conversion and on-platform transactions that I think you're going to see folks embrace, especially as these businesses become more privacy-centric. So I think you can imagine a world in the future where Snapchatters are able to access financial services through one of these minis on Snapchat, and that's an exciting opportunity for us.
Fascinating. Well, we will be keeping an eye on minis, on Spotlight, and also what happens with that Apple operating system change. Thank you so much for joining us, Evan Spiegel. We hope you come back soon.
Thanks so much for having me. Take care.
That was fantastic. Thanks, Julia. Watch Peloton today. Big sales numbers, but the supply chain issues, the margin concerns are dragging the stock down almost 9%. It's about a 10-day low or so. We're going to talk to John Foley, CEO, in a few moments on those results. So stay with us.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as a train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
I'm I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. U.S. President Joe Biden has filled his foreign policy team with several advisors on Asia. Analysts say the move signals the new administration is preparing to respond to China's growing global influence. That story's on the website now. Australia's competition watchdog says Google must decide if it wants to pull its services from the country or not. The U.S. tech giant has threatened to leave Australia over a bill requiring it to pay local media and publishers to link to their content. Head online for the full story. And Chinese short video platform Kuaishou has delivered a blockbuster debut, having been over 1,000 times oversubscribed on the retail side. Kuaishou shares almost tripled in value on their first day of trade in Hong Kong. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Government is threatening Twitter with penalties and jail time if it doesn't re-block select accounts related to the farmer protests going on in that country. Seema Modi has been following this escalating situation, joins us now with the latest. Seema.
John, Twitter in a bit of hot water. The Indian government is threatening to punish employees that are based at the social media platform in India with fines and up to 7 years in jail if it doesn't block hundreds of Twitter accounts that have been tweeting in support of these farmer protests that have gripped the nation's capital over the last 2 months. The request made under a law that allows the government to ask social media companies to block accounts to protect, quote, the integrity of the country. Now, Twitter first complied with India's request to suspend access to more than 200 accounts that belong to activists, political commentators, celebrities who have been criticizing Prime Minister Modi's policies. Upon review, Twitter then quickly unblocked those accounts. These unfolding events reaching Hollywood and Washington, D.C. after pop star Rihanna, climate change advocate Greta Thunberg, and Mina Harris, the niece of Vice President Kamala Harris, voiced their support for the farmers. What Twitter CEO Jack Dorsey does now could have implications for big tech in India. Just in the last year, we've seen Google announce it's investing $10 billion in the country, Amazon an additional $1 billion, Facebook at $6 billion. Also putting their money in Indian startups. There's delivery site Flipkart, which is backed by Walmart, set to go public here in the U.S. sometime in 2021, as well as internet platform Jio and the seamless of India, Zomato. So, Julia, a lot of money at stake here, and social media already under scrutiny around censorship, but certainly reaching new levels here as we watch this showdown between India and that social media company, Twitter.
Seema, that's absolutely right. Not just a lot of money at stake, but this really speaks to the power that these platforms hold. Thanks so much. Speaking of social platforms, keep an eye on Pinterest. Robust ad sales and a beat on the top and bottom lines powering that stock higher this morning. Pinterest reporting it added more than 100 million monthly active users last year. And you can see shares are up more than 6% today. There's a lot more Squawk Alley still ahead, so stay with us.
Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone. Without the resilience of a food system, there is no human species. It's as simple as that.
When you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
But you look at the occupancy rate of our retail properties, was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
Managing Asia, Sim Wong Hu
Singapore's well-known technopreneur back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hu on the next Managing Asia.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC News update at this hour. Last year's U.S. trade deficit was the highest since 2008. It jumped 18% in a year to $679 billion, driven by a sharp decline in exports. Agricultural exports to China last year totaled less than $29 billion. That's more than 20% below the target set by former President Trump's trade deal with China. Russia is expelling some diplomats from Germany, Sweden, and Poland, accusing them of joining illegal protests against the jailing of Kremlin critic Alexei Navalny. Sweden says it expelled embassy workers did not take part in a demonstration. German and French leaders have condemned the expulsions. And Parkland school shooting survivor David Hogg is starting a pillow company to take on MyPillow, which is run by Mike Lindell, a Trump supporter who has promoted false claims of election fraud. Hogg says his products will be made in the U.S. and the company will support progressive causes. You are up to date. I'll see you again in an hour. Squawk Alley is back in a minute.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
sales in its first billion-dollar quarter. Shares of Peloton really getting hit hard this morning, in large part due to supply chain issues and falling gross margins. Challenges that have mounted for Peloton over the last year. Here's our Diana Olick now with the CEO of Peloton in a CNBC exclusive.
John, thanks so much for joining us, and congratulations on your first billion-dollar quarter.
Thank you. It's good to see you, Diana.
Now, you had sales up 128%. We are now almost a year into this pandemic. How long do you expect these exceptional numbers to continue for Peloton, given how much demand you clearly had pulled forward?
Yeah, as you know, Diana, we've grown over 100%, so triple digits every year since we launched the company. So again, yes, this quarter we launched, we're close to 130% year-on-year growth. I can't say that triple-digit growth will continue for years and years, but I can commit to hyper growth. I mean, we are a growth company. We invest in growth. We're investing in manufacturing. We're investing in new content, new markets, new products, and growth is in our DNA, and we can commit to it for years and years for sure.
Now, growth is fantastic, but we have to also talk supply chain. You have continued delays at U.S. ports due to COVID. You just announced that you're investing $100 million into expedited shipping. You're increasing your customer support staff. You sent a note out to your subscribers yesterday to say how committed you were to that support. It's good news for the customer, but not so much for the company's gross margins. What are shareholders to take away from that?
I think shareholders should take away what members take away, which is we are 100% committed to our members and giving them a fantastic experience. In the last couple months with the congestion in the ports, we've had to reschedule some new members' bike and tread deliveries, and that's frustrating to them and that's frustrating to us. And this $100 million plus commitment is so that we can deliver on, the first time on time for our deliveries, for our new products, and get off on the right foot with all of our new members. If there's one member that gets a reschedule, that's one too many for our taste.
Now, your stock was downgraded this morning by Raymond James, who said that while demand remains strong, we believe trends could soften somewhat with social distancing likely to ease with the vaccine rollout. What's your reaction to that?
Yeah, I just think it's flat wrong. I mean, what we're seeing is a shift where people want to work out in the home. They've always wanted to work out in the home. If you look back, Diana, over the course of the last 20 years, there's been close to 5 million treads sold in the U.S. alone every year. And those are people saying, I want to spend real money to work out at home. Unfortunately, they just haven't used those treadmills because they've been boring and they become the cliche clothes hanger and coat rack and collect dust. Now with Peloton, with the engaging content that we bring, that you know well, Diana, where you're immersed in these classes with a motivating community, supportive community, great best instructors in the world, and all the social software, the gamification, we make it super fun to work out at home. And that's what the Peloton bike does, the Bike Plus, and now the Peloton Tread that allows you to take these fantastic boot camp classes from home. So it is the future of fitness, COVID or not. We see it clear as day, and I think the analysts are eventually going to see it as well.
But you do have a lot more competition in the space now due to everyone staying at home. You've seen it come from all sorts of different companies, whether it's Tonal or the Mirror or new offerings from other traditional fitness makers, brand companies. You had a niche space here. You were the streaming fitness top player. Now there's a lot of people out there. It's diluted the space. How do you keep that niche market for yourself?
Yeah, we keep investing, we keep innovating. We have an 8 or 9 year head start. We are investing in manufacturing, like we talked about. We're investing in new content modalities, new products like the new lower price tread, and we just keep innovating and stay out in front. I mean, back to your analyst question, Diana, I think it's interesting that you're right. You're seeing a lot of the traditional fitness players come into at-home fitness because they see the people who are in the space deeply see that at home is the future, and they're all interested in where Peloton's going for sure.
Now, you acquired Precor, which gives you domestic production capabilities in 2 states. Have you started manufacturing there yet? And if not, when?
Yeah, that's a good question. We're excited about U.S. manufacturing for lots of reasons. U.S. jobs, obviously, a big one, but also a hedge against our Asian manufacturing when there is port congestion. If we have options of where we're making different products, that's going to provide some flexibility and optionality. To your specific question, by later this calendar year, we expect to be producing Peloton products in the North Carolina facility with Precor, assuming that deal closes. I have to asterisk that the Precor deal has not closed yet, but we expect it to early this calendar year.
Okay, I want to talk real estate for a minute. You have a brand new corporate headquarters in Manhattan set to open. Some CEOs are saying, though, that, their staff can go virtual forever or do hybrid setup. But you've told me before that you want your employees back in the office. Why is that so important to you?
Yeah, it's a good question, Diana. And like every leadership team, we're obsessed about it because this COVID world has changed the way you can work. And certainly we've been incredibly productive for the last 12 months working from home. I've been so impressed with our team in this remote world. But we did recommit to our entire team a couple weeks ago that we are going to be an office-first culture. I was at our new HQ here in New York yesterday, and it is a very, very special. It's going to be close to 500,000 square feet on 34th and 9th, and it is such a beautiful space. And to answer your question, Diana, I care deeply about culture and human interaction and the fun and the teaminess and the energy that you get from being in an office with other people. And I had a fantastic day yesterday because I socially distanced, but I saw some other of my colleagues, and it was great to see them, and you get the energy of that. And that's one of the reasons why my wife and I live in New York City. It's one of the reasons why Peloton is going to continue to invest in real estate and make sure that we have an office-first culture. I think it matters.
Years ago, you and I talked about how vital it was to attract top tech talent. That is part of why you're investing so much in office space. Given this new work from anywhere culture and New York still being, very expensive, are you now at a disadvantage in New York?
I don't think so. I saw a Bloomberg article yesterday that New York City is the place to go over any other market for technologists specifically. And you're right, as we invest in this headquarters, I think when a young engineer walks in and sees the energy and sees the other people, architecture and energy and HQ is going to be one of the 100 things that those hotshot engineers care about. They care about their comp, they care about equity, they care about culture, they care about their air on chair, they care about the right kind bars in the kitchen. I mean, there's all kinds of things that you've got to land the planes on to recruit and retain the world's top talent, not just software engineers, but across the spectrum of great professionals, and we're committed to it. And I think New York City, it's multicultural, fun. I think it's the greatest city on earth, and Peloton is proud to be here.
John Foley, thanks so much for being with us, CEO of Peloton. Carl, back to you.
Diana, great stuff. Diana Olick with John Foley of Peloton. Watch Cisco this morning, awfully close to a 52-week high today. Evercore takes the stock to a tactical outperform ahead of earnings next week, talking about improved demand for security, tech transitions like 5G, price target 54 on CSCO. We're back in a moment.
At C3.ai, we're solving previously unsolvable problems. Inventory optimization, predictive maintenance, anti-money laundering, operational readiness, precision healthcare, energy management. C3.ai is AI built to transform your business at its core. C3.ai. This is Enterprise AI.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
One beneficiary of the Robinhood rage is Square. That's according to Mizuho, who says the migration over to Square's Cash App alternative is what's driving this week's surge in the stock. You can see shares are flat today, but they are up this week. Don't go anywhere. We're back in just 2 minutes.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO. Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that would be lifted, so let's say post-September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
When we think about the farmer, we need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Welcome back. Let's go back to the GameStop trade. You can see it up there, almost 19%, as Robinhood removes its trading limits on the stock and other beneficiaries of that Reddit-sparked rally this morning. This comes just a day after Secretary Janet Yellen, Treasury Secretary, met with financial regulators and expressed confidence in the underlying system. Joining us now on the Wall Street Bets phenomenon and beyond, Fenway Summer Ventures partner Javier Sade, formerly part of the bottom White House Economic transition team, as well as the SEC and Small Business Administration. Javier, great to have you. So David Sachs told us earlier this week that this GameStop phenomenon was a warning on censorship. What do you think the lesson of this is so far?
It's a very layered situation for sure. What one can glean out of what has happened can probably be looked at through almost a sociology lens, right? Which is, I think, where David is going with that comment, which is that on one hand, you have a pent-up situation in the country with the quad of crises we're going through, wealth gaps widening, the seeming dislocation between Main Street and Wall Street, and they finally found a way to participate in the economy, and all of a sudden you have a situation where due to things that were part of the structural part of the market, and I think this is where David is going, is the fact that they had to suspend trading. And I think that was a real tough situation.
Yeah, I get that, and I'm all for retail investors being able to do all the things that any trader is able to do. But my question next is, what sort of behavior should regulators, should the environment be encouraging? And by that, I mean, we have structures around rules, stocks being halted in certain cases, trading on margin, things like that. These new apps are making it seamless, frictionless, free to take on levels of risk that I'm not sure are historically beneficial for all investors, right? So is there anything that needs to happen or should happen around how these apps not just let people do things, but actually encourage people to do things?
Yeah, and I think that tug of war between maintaining efficient capital markets and protecting investors is what the premise and the construct of that meeting that was held yesterday by Secretary Yellen and the regulators. And that balance is a very difficult one to hold. The fact is that the genie's out of the bottle with technology, and we're talking about, but not talking about fintech. And that is that one of the promises of fintech is that it reduces that friction. On the other side of that is that if you don't have guardrails to protect people, they get burned. So it's I'm probably giving you a non-answer, but that tug of war is really what's at the heart of what we saw last week.
Javier, it seems like there's so many contingencies here. They're the investors. You want to give everyday investors access to some of these instruments and options that may have been limited to institutions in the past. And then so you have protecting them, you have democratizing access, and then you also have the question of the startups and wanting to allow innovation. How do you balance sort of protecting the opportunity for companies to innovate at a time while also considering protecting investors?
I mean, look, there's about 600 unicorns in the world that are valued at $2 trillion.
question then becomes, Jim, is it real? And does it have real legs? You know, as you get further along in the recovery, you're going to have more conversation about the recovery trade and the value trade. But these stocks are simply saying, not so fast. You know, focus on where the consistent growth is, not where necessarily you're going to see some fits and starts as it relates to the economy getting back up again.
Well, so yes, it is real. I'm going to echo what Joe and Liz have said, that, you know, I don't think it's binary. I don't think it's either you're in tech or you're out of tech. You know, Scott, I own Apple, Google, Microsoft. I'm going to stick with them. They've been great. But you also know I have a lot of cyclical exposure, a lot of value stocks. And I've been consistent the last couple of weeks that saying the big cap tech is going to do just fine this year. But it's not, I don't think, going to be the market leader this year. It's had such a torrid run the last 2 years, frankly, the last 5 years. And when you look at the fundamental forces that are propelling either financials, which I know we're going to discuss a little bit later, or energy or industrials, just the fundamental forces of a new economic expansion, easy money, infrastructure spending that may come, just more economic activity in general. I think it's safe to say, I think it's rational to say that leadership this year will come from the cyclical value sectors, but tech is going to do just fine as well.
You know, I want to focus on speaking of tech in the area I just mentioned, John, software. I mentioned the new record high. You've got some software exposure, as probably a lot of people do, because enterprise software has been one of the biggest outperformers within technology over the last year, certainly since the bottom. We've talked about it a lot because people like Brad Gerstner have come on our program and said that maybe some of the valuations have gotten a little ahead of themselves and need a bit of a reset, though month to date or year to date, I should better say, these stocks are going. ServiceNow is up 10.5%. Zoom, popular as ever, up 13.5% after a pullback of its own. Workday now 17%. CrowdStrike's having a nice run of it. You've got Oracle, which is a bit of a leader. You've got Palantir and some of these other names. So what about software?
I think software is going to be one of the areas that you do want to look for value there, Judge, as far as, you know, some of these pullbacks, like that Oracle pullback, like the Palantir pullback. I mean, I think both of those gave you opportunities rather than just reaching for the stars and, you know, grabbing some of these big names that have truly outperformed. I'll throw Zoom in there with it, Scott. They've made some pretty significant corrections, and I think that makes them all the more attractive right here because, again, in the case of Zoom, I know Josh has been long and strong in Zoom. It's come down from over 500 into the 300s. I think that was an opportunity to get in there. I don't know that it goes right back into the 500s, Scott, but I think that that stock is something that people just have found that they really can't quite live without. You know, Microsoft Teams is great. Google Meet is great. But for just regular Joes and Janes that don't have a software package that they pay for on a monthly basis, like with Microsoft, or that don't maybe trust as much Big Brother watching over them over at Google, I think you've got Zoom, and it has become like Kleenex. It has become like Xerox. It is what it is. I mean, it tells people what it does as far as it's become the name of how we communicate with each other. So I think of those that you mentioned and that I'm lucky enough to own, Zoom is one that can continue to outperform.
I want to know about Salesforce. You know, one of the marquee names, Jim Leventhal, in the software space. I think a lot of people probably have that in their portfolios. And after a rest of its own, excuse me, a pullback, it's gotten going again too.
So, you know, the question when you see a pullback like this is whether it's a consolidation or the beginning of a downward trend. That's always the question. Since I recently initiated the position and added to it, I obviously think it's a consolidation. And there's a lot of things that we know here. We know Mark Benioff is a transformative leader, and that matters a lot. Frankly, the reason I got into it was the acquisition of Slack. I think that's both a great defensive and offensive play. Offensively, it gives them a new business line. Defensively, it keeps Microsoft Teams and Zoom from encroaching in on Salesforce's core business. So I see a transformative leader continuing to do transformative thing. And it's almost a verb now in its own right. I mean, is there any company that doesn't have Salesforce in it right now?
Yeah. You know, what I wanted to do, what I thought would be constructive for our viewers today, and I'm glad we pivoted to Salesforce because it's part of the list that I asked all of you to put together of some of your best tech picks. And maybe off the beaten path, maybe that's overstating it, but at least ones that we don't talk about every day and away from the most mega of mega cap technology stocks. Jim, NXP Semi is on your list. You bought more Qualcomm too. Why should people follow you there?
Well, basically, the secular trend is very strong and very intact in these two names. They're both chip manufacturers. NXP is more focused on automotive. We know that automotive sales are really going gangbusters right now, as they should in an early economic activity. Qualcomm's an interesting story. We know that they're the 5G intellectual property leader. They had a little bit of a stumble this week. Now, I don't really think it was a stumble. I think it was a combination. The stock was ahead of itself. And frankly, they did well, but not well enough to meet those expectations. Stock's off 10%. To me, that's an opportunity. Scott, you know I've raised cash recently. If I don't get the market pullback, then I get the pullback in individual stocks like Qualcomm down 10%. 145, I think this will probably be close to 200. Just on earnings growth, not multiple expansion, earnings growth by year end. So that's my way of putting some cash to work very easily, very comfortably.
Just to be clear, you're saying on the pullback that we witnessed, you bought more stock and you bought some calls, just so people know you're actually making these specific moves that you're talking about right now.
Thanks, Scott. Yes, bought calls and options yesterday. The stock is calls and stock. The stock is obviously long term. The calls are my way of saying I think this beat down of 10, 11% is ridiculously overdone. Now, look, if you're buying calls, you got to be ready to lose all of your premium. John can write volumes about that. So that's just a little fun trade I'm doing. But long term is my vision in this stock, and that's why I own the shares and added to them yesterday.
Speaking of chips, Joe, what you call the Rodney Dangerfield of the space is Texas Instruments. And frankly, it's one that we and, a lot of other people don't talk about it all that much. But it's one of your picks in the tech universe that folks should take a look at.
Absolutely. And it's a semiconductor name that offers a 2.5% dividend. It's a company that trades at a reasonable valuation that my friend Jimmy could get comfortable with in the mid-20s. It's got 13% sales growth, which I like. And clearly, it has been a company which has had the technical performance over the last couple of years, but we just don't talk about it enough. Why? Because I think, unfortunately, we equate the semiconductors with the need to show us performance that's 50% or higher year on year. And I think that's just the wrong way to look at it. This is a name, it's a quality name, it's a name that belongs in a large cap portfolio. It's a core semi holding, and it's proving by every metric that it's delivering for you fundamentally.
What's Viva Systems, which frankly I don't think we've ever talked about on this show, and if we have, it was so long ago that I don't even remember.
I will tell you, and again, it's in my quality momentum index, so that's how I began to learn about this company. How about the fact that this company, which has a $44 billion market cap, just became a public benefit corporation. Now, it is the largest publicly traded company to take on that structure. Now, what does that mean? We all know about the world of ESG investing, but Scott, they've taken it a step further. They are balancing the shareholder with the employee, with the customer, and they are ensuring in their mission that they're going to be delivering to society something that has a public benefit. The public benefit is this software application that they partner with the life sciences industry with. So they're focused on health and wellness. This is a company that is growing at a 30% sales growth rate over the last 3 years. It's performing incredibly well, and it's a name, Scott, that we should be talking about more on the halftime report because it is a name going forward that is going to be included in more and more portfolios.
You're not kidding. I mean, it's first of all, it's the highs of the day. Second of all, it's a $45 billion market cap company, which is reason in itself that it should get a little more love than perhaps it does. All right, so Liz, again, the idea, you know, you can't pick individual names, but you can certainly talk about places you want to be, whether it's big cap or small cap within the technology universe.
Yep, and I would want to be in small cap right now. I mean, I'm saying that from a place of assuming that most people are already in mega cap tech and probably overweight mega cap tech accidentally or on purpose based on performance last year. But I think you have to really consider some of those smaller cap names and what they can do for the economy going forward. Things like the digitization of society, the digitization of supply chains, contactless consumerism. Those are all smaller cap names, and they deserve a look. There's something that I think get a good boost middle of this year through the second half of this year, and people should pay attention to them. It's also, it goes into this sort of value versus growth story, which is a little bit frustrating for me, but I don't think growth has to lose and value has to win. I think growth can continue to win here. We just have to shift what we're defining as growth and where we're allocated to growth. And I would do that in small cap tech and some of those healthcare names too.
John Najarian, you have some names where people can make some money? That's what they're after.
I do, Scott. As far as that tech trade that you were talking about, I like Teradata, TDC. I love Palo Alto Networks, both of them intimately involved with cloud. In fact, Teradata's numbers were just through the roof, Scott. Triple-digit gain.
Well, look at the stock.
You never hear that. Yeah, exactly, 35% today or something like that. So I'm not saying people should rush into that one today, but when you're looking for names outside of FANG, that is one that's going to be performing for a very long time. Same thing with cybersecurity over at Palo Alto. You know, SolarWinds, when they fail, and they did fail, these guys were picking up the pieces, and that's why they're trading up near the highs as well. Lastly, Palantir, which, as you know, I've loved since the IPO and before that, even when it was privately held. I love that stock. I think analyzing data is key, and I think they will continue to really provide insight into customers, into movements, and predicting. The predictive capability of Palantir is something that's unrivaled, Scott.
All right, good stuff. Yeah, we're watching all those stocks that you talked about higher today. And we didn't want this to be an either-or conversation because, as we've heard from you guys, you do think that you can own both growth and value and still expect some nice returns from both, as does Tom Lee, which is no surprise. He's been talking about the epicenter trade in his words. That's what he coined from the very beginning. He says the steepening yield curve, we've been watching the 10-year note yield rise of late. He says that's another tailwind for epicenter stocks. Now, we've mentioned that as a potential headwind for growth stocks, that money could potentially come out of those names and into value. Nonetheless, I asked all of you to give me some names from the value or reopen area too. Joe Terranova, Best Buy, Marriott, and you're looking at General Motors, hoping you get a pullback because that stock's been a runaway.
Oh, boy, I wish Jimmy nailed it. I wish I could get that pullback in General Motors so I could get into the name. Marriott, Scott, you know, in the past couple of years, it's a name that I have traded from the long side. I'm not currently in the name. I missed the trade. Bad on me. But this is a form of value that you look at it and you say, okay, it's got quality. And there's going to be a return. We're beginning to see it. I think a lot of the strength within the market this week is related to some of the positive news surrounding the expansion of the vaccine rollout. And with that vaccine rollout, we're going to get to a point I've heard Josh talk about where every day is going to feel like New Year's Eve. Well, I'm not sure if that's going to be the case, but every day is going to kind of feel like we've got that summer mentality where we want to go out. Marriott has the brand in which they'll be able to deliver the customer the type of experience that they're looking for, and they have the strength of the balance sheet. Best Buy, That's a name that's in my quality momentum index. It's a name that I've owned previously, performing incredibly well. It's on the strength of the consumer electronic appetite and the strength that we're witnessing there. That's not going away, especially with the new iPhones that are being offered by Apple for the remainder of this year.
So let me do this. Let me come back at you on Marriott. Guys, throw up Marriott again. So, you know, you're very forthright in saying, okay, I missed it, bad on me. The stock has had a nice little run over the last few months. You know, there's an intraday, but show me the 3-month, because I think it was 26% or 27%. So there it is. So for somebody playing wherever they're playing today, Joe, who's looking at this stock, is it too late for them to get in, even though maybe you missed it and doesn't sound like you're putting new money in this name? Should they?
Yeah, I mean, I'm looking to my right because I'm looking to the stock so I can give the viewers my full opinion on this. This is a stock that back in December of 2019 was trading at 153. Okay, if we have the ability where there is a return to normalcy, we're going to see engagement in travel for both the consumer and the enterprise community, which I suspect we will. This is a stock that will reach that 153. And now, what has also changed from December of 2019 is their balance sheet has actually gotten even better because they were smart enough. Management went out in the spring of 2020 and they did what they were supposed to do. They accessed the debt markets, they raised the capital, and they positioned themselves for the growth opportunity that's going to be ultimately present itself for this company in 2021 and 2022. I also think they'll be the beneficiary of having the ability to be an acquirer, because you're going to see consolidation in travel and leisure, specifically for lodging. I think Marriott's going to benefit from that, being an acquirer, and longer term, that is going to add to the bottom line. So there's a lot more room to go as I look at it here, and it's a name, as I said, I'm sorry I missed it. I probably will get into it soon enough.
No, because I think it's an important thing, right? If you think it has, part of the exercise here is the names you're giving me, the names you're giving me, presumably you think that investors, people watching our program today, still have an opportunity to make money in, just not names that you like, so to speak. That takes me to you, Jim.
Absolutely.
Sorry, Joe. To Jim, because Alaska Airlines, I know that you've talked about that before, as you have Boeing and Marathon Petroleum. I want you to zero in for me on General Motors, okay? A stock that has had a huge run. People who listened to you many, many months ago and who followed you into this name have made a lot of money, and we're happy they've done that. What about here forward, though? That's when the game gets a little bit harder if you put fresh money to work. If you didn't own General Motors here, Jim, would you today?
Yes, thank you for asking this question. It's what's on my mind. So the short answer is yes, but here's how you do it. If you don't own it, they're reporting earnings next Wednesday. I think they're going to blow it out, and I'll explain why in a second. But you don't have to be a hero and put every last dollar in General Motors today. Figure out how much of General Motors you want to own, buy half of that today, and keep the rest of it for after earnings. Because I do think earnings are going to blow out, but that doesn't tell you how the stock's going to react. As you're pointing out, Scott, it's up 100% in 6 months. And I think it will be above 60 before too long and end the year in the 70 to 80 range. The reason I think that this earnings call is going to be so good is everybody's focused on electric vehicles and autonomous. That's great. But underneath that, the traditional internal combustion engine business is going gangbusters. And you see that in sales volume. You see that in average transaction prices, which J.D. Power reports regularly. They're really quite high. Incentives are low. Dealer inventories are low, which means GM is cranking up its production lines.
I'm going to break away. I'm going to go down to the White House and President Biden.
Well, thank you all for being here. I'm accompanied by the Vice President and the Secretary of Treasury, Janet Yellen, and I want to talk today about our plan. And the January job numbers came out today. And while we're grateful for everyone who found work and is earning a paycheck, it's very clear our economy is still in trouble. We added just 6,000 private sector jobs in the country last month. Overall, we added 49,000 jobs. And this at a time when we have more than 10 million people out of work, 4 million people have been out of work for 6 months or longer, and 2.5 million women have been driven from the workforce. 15 million Americans are behind in the rental payments. 24 million adults and 12 million children literally don't have enough food to eat. These aren't Democrats or Republicans, they're Americans, and they're suffering. They're suffering not because of anything they did. Through no fault of their own, they're suffering. Once-in-a-century virus has decimated our economy, and it's still wreaking havoc on our economy today. And so much of it is still about the virus. We're still in the teeth of this pandemic. In fact, January was the single deadliest month of the whole pandemic. We lost nearly 100,000 lives. I know some in Congress think we've already done enough to deal with the crisis in the country. Others think that things are getting better and we can afford to sit back and either do little or do nothing at all. That's not what I see. I see enormous pain in this country. A lot of folks out of work, a lot of folks going hungry, staring at the ceiling tonight wondering, what am I going to do tomorrow? A lot of folks trying to figure out how to keep their jobs and take care of their children. A lot of folks reaching the breaking point. Suicides are up, mental health needs are increasing, violence against women and children is increasing. A lot of folks are losing hope. And I believe the American people are looking right now to their government for help, to do our job, to not let them down. So I'm going to act, and I'm going to act fast. I'd like to be doing it with the support of Republicans. I've met with Republicans. There's some really fine people who want to get something done, but they're just not willing to go as far as I think we have to go. I've told both Republicans and Democrats that's my preference, to work together. But if I have to choose between getting help right now to Americans who are hurting so badly and getting bogged down in a lengthy negotiation, or compromising on a bill that's up to the crisis, that's an easy choice. I'm going to help the American people who are hurting now. That's why I'm so grateful to the House and the Senate for moving so fast on the American Rescue Plan. Here's what's in that plan. First, it puts $160 billion into our national COVID-19 strategy, which includes more money for manufacturing, distribution, and setting up of vaccine sites, everything that's needed to get the vaccines into people's arms. There's simply nothing more important than us getting the resources we need to vaccinate the people in this country as soon, as quickly as possible. So job number one of the American Rescue Plan is vaccines. Vaccines. The second, the American Rescue Plan is going to keep the commitment of $2,000. $600 has already gone out. $1,400 checks to people who need it. This is money directly in people's pockets. They need it. We need to target that money, so folks making $300,000 don't get any windfall. But if you're a family that's a two-wage earner, each of the parents, one making 30 grand, one making 40 or 50, maybe that's a little more than, well, yeah, they need the money, and they're going to get it. And here's what I won't do. I'm not cutting the size of the checks. They're going to be $1,400, period. That's what the American people were promised. Very quickly, here's the rest of my plan. It has money for food and nutrition so that folks don't go hungry. I think our Republican friends are going to support that. It extends unemployment insurance, which is going to run out on March 13th of this year to the end of September of this year, because we're still going to have high unemployment. It helps small businesses, thousands of whom have had to go out of business. It has money to help folks pay their health insurance. It has rental assistance to keep people in their homes rather than being thrown out on the street. It's got money to help us open our schools safely. It has money for child care, for paid leave. It gets needed resources of state and local governments to prevent layoffs of essential personnel, firefighters, nurses, folks who are school teachers, sanitation workers. It raises the minimum wage. It's big and it's bold, and it's a real answer to the crisis we're in. That's one more thing, and I want to say it very clearly on this, be very clear on this point. It's better economics. It not only addresses the immediate crisis we're in, it's better for the long-term economic health of our nation and our competitiveness. My plan creates more jobs, creates more economic growth, and does more to make us competitive with the rest of the world than any other plan. Don't take my word for it. Just look at what leading economists across the nation have said, and in the world, and across the ocean have said. Wall Street investment firm Moody's says if we pass the American Rescue Plan, it will lead to 4 million more jobs than otherwise would be created. The nonpartisan Brookings Institution has looked at the American Rescue Plan and said the GDP will reach pre-pandemic projections by 2021, meaning we'll have recovered by end of 2021. Much sooner, by the way, than if we do nothing. Look, just this week, the Congressional Budget Office projected that if we don't take action, it would take until the year 2025 to return to full employment. There's also a growing chorus of top economists, right, center, left, that say we should be less focused on the deficit and more focused on the investments we make and can make now in jobs, keeping families out of poverty, and preventing long-term economic damage to our nation. The simple truth is, if we make these investments now, with interest rates at historic lows, we'll generate more growth, higher incomes, a stronger economy, and our nation's finances will be in a stronger position as well. And the payoff won't just be in jobs, but in our global competitiveness as well, because we'll be regaining our economic strength faster. So, the way I see it, the biggest risk is not going too big if we go too small. We've been here before. When this nation hit the Great Recession that Barack and I inherited in 2009, I was asked to lead the effort on the Economic Recovery Act to get it passed. It was a big recovery package, roughly $800 billion. I did everything I could to get it passed, including getting 3 Republicans to change their votes and vote for it. But it wasn't enough. It wasn't quite big enough. It stemmed the crisis, but the recovery could have been faster and even bigger. Today, we need an answer that meets the challenge of this crisis, not one that falls short. And that's the issue facing the country right now. What Republicans have proposed is either to do nothing or not enough. All of a sudden, many of them have rediscovered fiscal restraint and the concern for the deficits. But don't kid yourself. This approach will come with a cost. More pain for more people for longer than it has to be. Secretary Yellen talks about the scarring effect that comes with prolonged economic pain. We see that scarring effect in economic data, but more important, we can see it in the lives of people living with long-term unemployment, living in hunger, at wit's end over how to keep their jobs, take care of their kids. And then she talks about the need to alleviate long-term suffering in the economy. We can do that. We don't have to wait until 2025 to get back to full employment, which will be the case if we don't do this. Again, independent analysis from places like Moody's on Wall Street, Brookings Institution, the American Rescue Plan could achieve that by the beginning, full employment by the beginning of next year. So to me, this is what this moment comes down to. Are we going to pass a big enough package to vaccinate people, to get people back to work, to alleviate the suffering in this country this year? That's what I want to do. Or are we going to say to millions of Americans who are out of work, many of whom have been out of work for 6 months or longer, who've been scarred by this economic and public health crisis, don't worry, hang on, things are going to get better. We're going to go smaller, so it's just going to take us a lot longer, like until 2025. That's the Republican answer right now. I can't in good conscience do that. Too many people in the nation have already suffered for too long through this pandemic and economic crisis. And telling them we don't have the money to alleviate their suffering, to get to full employment sooner, to vaccinate America after $8 trillion in deficit spending over the past 4 years, much of it having gone to the wealthiest people in the country, is neither true nor necessary. We do have the resources to get to full employment sooner. We do have the tools to reduce a lot of suffering in this country. We just have to choose to use them. So it's time to act. We can reduce suffering in this country. We can put people back to work. We can gain control of this virus. That's what the American Rescue Plan does. And that's what I'm determined to do. And that's what I hope we're going to be able to do in the near term. So may God bless you all. May God protect our troops. And I truly believe real help is on the way. Thank you all so very much. Thank you.
Mr. President, how could you better target?
Okay, that is the president there on his COVID relief plan and the current state of the economy. President Biden saying, quote, "It's very clear our economy is in trouble. We're still in the teeth of the pandemic. I see enormous pain in the country," said the president. Let's bring in Kayla Tausche, who's been listening in as well. So, Kayla, the sales pitch is ongoing, and President Biden making it very clear what he is not willing to negotiate on, namely those $1,400 checks, which he says are going to be going out, period.
And Scott, he doubled down on the White House's go big or go home approach, saying that the lesson that he learned with the 2009 stimulus, which he personally worked to pass at $800 billion, was not big enough and that the recovery simply took too long. He didn't mention Larry Summers by name, but that's an argument that is crafted to directly respond to a Washington Post op-ed that the former Obama administration economic official wrote this morning, where he said that there is a significant difference between the economy back in 2009 and the economy now, and that President Biden's plan is more than 3 times what the economy right now is demanding. Now, Scott, you also saw a slight recalibration of the message coming from the White House to talk about full employment as a goal. Now, that is strategic because earlier this week, the Congressional Budget Office said that with the stimulus money that's already trickling into the economy, that the U.S. should reach pre-pandemic economic growth by the middle of this year, which some Republicans are latching on to as part of their argument that the size of this package is simply not what's needed. But the CBO report importantly said that the U.S. would not reach full employment from pre-COVID levels until the end of 2024. And so the White House is using that statistics to say we simply can't afford as a country to take that long to get back to full employment. And especially in the wake of this morning's jobs report, that the size of the package is what's needed. Although, Scott, as you mentioned, he did signal a willingness to refine the threshold of who qualifies for those checks, if not the amount.
Yeah, Kayla, thanks. Kayla Tausche for us in Washington, summing up the president and his comments just a few moments ago. Stocks, well, they're higher today. Records for the S&P, the NASDAQ, the Russell, in part because of expectations on a big COVID relief plan. When we come back, big earnings next week. We're going to take you through those. John's going to give you his unusual activity as well. We're showing you the S&P sector heat map today. There it is. S&P is good for 17, and it's led by materials and discretionary. We're back on the half right after this.
The website Lifehacker recently posted an article titled "Buy Your White Kid a Black Doll."
Actually, the full title of the article is "Buy Your White Kid a Black Doll," but watch what they do with it.
Real money.
Heat map right now. Pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number 2. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that maybe that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the 2 countries.
He said, look at those names, Disney, Cisco, General Motors, among others, all set to report. All right, Jim, we went through GM, so we don't have to do that again. But let's tee up Disney after what's been really a remarkable gain for that stock over the last 3-4 months.
Yeah, it has been a remarkable gain. So I think they would have to kind of discover life on Mars for something surprising to come out next week. And I'm not looking for something surprising. In the long run this year, I'd really like to see some news on the theme parks reopening. I think that's overlooked. That was 40% of their operating income in 2019. Getting that back on track would be very important.
Yeah. So, John Najarian, you own Disney calls. I'm wondering how good you think the results now have to be given the run that I mentioned. Then I want to talk to you about Uber. We can ping pong with you and Joe because both of you own that stock. But give me the idea on Disney, okay? A lot of people may have gotten in on this thing because of Disney Plus and have ridden it up. Now what? How good does it have to be?
Well, this is another one of those, Scott, where I don't think people are willing to get off because of exactly what Jim just said. They've got so much coming their way on the reopening that, and by the way, sports getting bigger again. I think that's going to be huge for ESPN, but the reopening of those theme parks, even the cruise lines, Scott, coming back on. I own Carnival Cruise Lines, but Disney also has a pretty significant exposure in that area, and that's out in front of us. So I don't see anybody really willing to jump off Disney with both theme parks and sports right in front of them, about to really start adding to that bottom line. I just don't think they'll be jumping off.
So give me then your view on Uber, which, you know, Josh has been talking about for an awfully long time now as one of the ultimate reopen and restart plays. What your expectations are as you own, I guess, calls, right? You don't own the stock, or do you own both?
I own calls. And call spreads, Scott. And I love the upside here. Obviously, a very big reopening play that has done well even during the pandemic because of the food delivery. They had to basically fight for that because Grubhub was the first one they wanted. And obviously, they had to find a different way to compete. They did that. That deal's going to be closed in the next few months. And I think that Uber just has a great ramp in front of it, Scott, in particular because some public transportation, it'll be a while. It might be a whole year before they get back towards pre-pandemic levels in public transportation. That's great for Lyft and Uber.
Yeah, I mean, you got a real sense this week from Dara, the CEO, Dara Khosrowshahi, and the deal that they just did for Drizzly is very much into where they're sort of placing their long-term big bets on that food delivery, food and beverage delivery, among other things which may come down the road. Joe, your expectation on Uber is what?
Well, for this earnings report, mobility is going to look pretty ugly once again. It's probably going to be down about 45%, but it is about delivery. In Q3, you had 135% year-on-year growth. So while they're kind of waiting for mobility to rescale, Scott, delivery has gained momentum. Delivery now reaches a point where you're going to see EBITDA inflect in 2021, and you're also going to see when mobility returns and rescales, again, you're going to see an inflection point there as well. So I'm staying with this name. There has been in the past concerns about cash. That's been alleviated. They've got enough cash to burn through about $6 billion for 2021. They're okay there. It's a name as it approaches its all-time high at 60. I think it breaks out to the mid to upper 60s very easily.
All right, we're going to bounce for a couple. We'll come back. As I mentioned, John still has unusual activity. That is straight ahead on the half.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
On the next Managing Asia, Sim Wong-Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X-Pi is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong-Hoo on the next Managing Asia.
Time for unusual activity. Doc, what do you got for us?
Well, Scott, as Jim said, it's become a verb, Zoom. ZM is the symbol. Of course, it has come way down from 500 all the way down to that low 300 level. They raised about $1.75 billion, I believe, Scott, the middle of last month. And they did it at about that 340, 360 level. The stock has zoomed since then, Scott, and is back over 400 to about 414. We saw them coming in again, buying upside calls. These calls expire next week at the 430 strike. So next week, February 12th, 430s, I was already in Zoom calls. I added to it on this buying, which was even bigger than what we saw in the middle of last month. I think this one might be a blowout quarter for them, Scott, and I just love the way the stock's performing today.
I want to talk to you about a few other names as well. Snap and Pinterest have both hit new all-time highs today. You've sold calls in Snap, in Ford, in Pinterest. Talk to me. Cashing in some nice gains.
Okay. Yeah, and they are all three great companies. I'm sure Jim and Joe and Liz would probably hold on to all three, but I had short-term calls, Scott, that were going to be expiring anyway. In the case of Snap, it looked like it was going to be a bad move because the stock looked weak in the after hours, has turned around and, of course, moved higher. And I said, I'm going to take that gift and cash out. Ford, we just had multiple weeks worth of upside call buying, took off the short-term calls in there during the day today as it pushed towards 12. And lastly, Pinterest. I can't say enough nice things about Pinterest. The traders of the options of Pinterest have been spot on. It's like they have tomorrow's newspaper today. I followed them in. The stock hit a new all-time high, like you said, and the options just let me take that profit today, Scott.
Okay. We've got more trades ahead on the half. Before that, take a look at some of the stocks hitting new highs today. Activision Blizzard, Etsy, Estee Lauder, big reopen trade. Kramer loves it. There's the stock today up better than 7%. We're back after this.
Of all the companies on the Fortune 500 in the year 2000, more than half no longer exist. Digital transformation isn't just a good idea. It's a matter of corporate survival. Enterprise AI enables organizations to use artificial intelligence at enterprise scale, solving previously unsolvable business problems to help you not just survive, but thrive. C3.ai. This is Enterprise AI.
Helping you navigate the new normal. Squawk Box on CNBC.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say post-September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
It is time now for the Futures Outlook. Week ahead, a mix of economic and treasury data will likely have a chain reaction impacting on gold and elsewhere. Scott Nations explains.
Futures traders are going to have lots of data to trade off of next week. On Wednesday, we'll get consumer price index data. And then on Tuesday, Wednesday, and Thursday, we're going to get supply from the U.S. Treasury, which is scheduled to sell $126 billion worth of notes and bonds. All of that data will be driving interest rates, and recently interest rates have been driving gold prices. So let's take a look at the gold futures contract. Ticker symbol for gold futures is GC. Each contract represents 100 ounces. The minimum price increment is 10 cents an ounce, and that means a single tick for a single futures contract is worth $10. Gold just got killed yesterday, and that was because of higher interest rates. Ended up losing $40 an ounce yesterday, getting back below $1,800 an ounce for the first time since the beginning of December. Now, all this volatility and all of next week's data means that there's a great opportunity for futures traders if they're trading gold. I hope you take advantage.
All right, our thanks to Scott Nations there. We'll, of course, check back on that again next week. We'll come back. We still have final trades to do. We'll do it next.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Tyler Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
As far as the Bank of England is concerned, the outlook seems to be relatively optimistic versus what people were expecting to hear.
You should see the strong growth we have and the fact that it's stronger than the forecast we had in November later this year really as a function of the lower starting point. In levels terms, we're not any more optimistic than we were 3 months ago, but I think the vaccination rollout gives us a little more confidence.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
But you look at the occupancy rate of our retail properties, was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
All right, final trades. Let's do it. Liz Young, you're up first.
I am using financials today. Anybody worried about valuations? It's the cheapest sector in the S&P on a PE basis, and yield curve keeps steepening. I think there's a lot of benefit to be had through 2021.
Yeah, they've been going up. All right, thank you. You have a good weekend. John Najarian?
Dropbox, Scott. At the money calls bought. They have earnings coming out February 18th. They traded about a 24 PE versus an industry that's 38. I think it's cheap, and I think they blow out the earnings. They've already announced some job cuts in the middle of last month, so I look for more upside here, Scott.
Okay, good stuff. Thank you as well, John Najarian. Joe?
Thank you.
T. Rowe Price trying to introduce new names as it relates to the gathering, management, and pricing of assets. You know I like Goldman Sachs and Morgan Stanley. T. Rowe Price is a new one for our viewers to give consideration to.
Okay. All right. Quickly, Farmer Jim.
Apple, Scott, Apple.
All right.
Yes.
Okay. All right. 3 times is better than 1. All right. Thanks. Thanks so much. Have a great weekend. The exchange begins now.
Thank you, Scott and the gang. And hi, everybody. Happy Friday. I am Brian Sullivan. Welcome to The Exchange. Call it the short SPAC attack. All these new investments getting some attention from some short sellers. Will the Reddit rebellion come calling too? Another big wake-up call in the jobs number. The American industry still digging through a depression and why millions of people simply can't go back to work even if they want to. And doggy daycare, free rides, and even paying off your student loans. No, it's not Congress. It's companies. Meet some of the new perks corporations are using to lure in the top talent. All that, plus the top 5 companies seeing the most insider buying of their own stock this week, something exclusive only to us. That is all ahead, but let us start on this Friday by hitting your money overall as stocks try to cap out another big week with some very nice gains. Seema Modi's got the latest on all the numbers and the news behind them. Seema.
Happy Friday, Brian. This time last week, it seemed like we were going into a week where we would see more volatility, but we're actually on track for the best week since November of last year. We're looking at the S&P 500 and NASDAQ both at record highs. And interestingly enough, if you take a look at the biggest gainers on the S&P for the week, it's names in the leisure and retail space, names like L Brands and Under Armour higher by 19%. MGM Resorts in the casino space up 20% ahead of earnings out next week. So that reopening trade certainly seems to be a part of the conversation. On the flip side, take a look at Peloton. We saw sales top $1 billion, but the company is saying that they need to invest more so they can accommodate the strong demand it is seeing for its bikes. CEO John Foley saying that these investments are needed. And he also said, I don't know if you saw the conversation earlier today on CNBC, Brian, that with the vaccine coming out, they don't see demand slowing down. I thought that was really interesting. I mean, for those of us who have invested in that bike, we're not going to stop using it, are we?
Oh, you have a Peloton?
I do. I mean, I was convinced by you because I know you're a big fan.
Well, yes, I was not going to ask you your handle because my stats are too embarrassing. Do you like the classes or do you like the mountain rides?
I like a mix of both. Cody's my favorite instructor. And if I can just bring it back to the stock for one quick second, I do want to show that even with today's drop of 8%, because I'm a finance nerd, take a look at the last 3 months. You've actually seen a trade in this $150 sort of price range. So we'll see if it can get above that. Obviously, over the last 6 months, still up about 103%, Brian.
Well, shout out to Cody. By the way, once you have the bike, you're probably going to keep paying that monthly fee or the treadmill. By the way, Seema Modi once again wondering why I'm on television. Seema, thank you very much. Well, the January jobs number mixed with only 40,000 jobs newly added due to the coronavirus and, of course, restrictions, lockdowns, etc. The unemployment rate falling, though, to 6.3%. Participation, though, dropping significantly. 4.7 million people simply prevented from working, even if they wanted to, because the pandemic or lockdowns or their kids' school is closed. But despite problems with jobs, the markets are focusing on the positives. Here they are. Here's why the markets have been ripping higher. Number one, you got vaccines up, cases down 50% in a month. You got $1 to $2 trillion in stimulus coming. We don't know the number, but some bill will pass. You, of course, have the easy Fed, 0% rates and $4.5 trillion in money floating around the globe. And a little bit less sort of obvious, the yield curve. Watch that. Up 7 days in a row. We've only had one 8-day run on that yield curve tightening in a decade. Joining us now with more is Michelle Meyer, head of U.S. economics at Bank of America Global Research, and Ernesto Ramos, chief investment officer at BMO Global Asset Management. Ernesto, I'll begin with you. You saw sort of not our wall of worry, our wall of ripping. I mean, you got these things that are out there that are all kind of factored in. Is there one of those that's more important to you and your team vis-a-vis the markets?
Well, the most important one is one that you didn't mention, which is the earnings growth outlook. In 2021, the consensus has the earnings for the S&P 500 going up by 30%. And at the end of the day, we think that's what's driving the market higher. You're seeing estimates being revised higher, which has dropped valuations by about 4 points on the S&P in the last few weeks. So that's really fueling the growth in the market right now. And not to mention the ones that you already did talk about. The yield curve is very interesting. The yield curve shows that the growth stock sector might be giving way to value stocks because as yields go up, value stocks come more into play and small caps and value stocks. So we think that's an area where you want to make sure you have some exposure to.
Okay, yeah, Michelle, would you agree with that? I mean, the yield curve, I know it's a little bit wonky, probably a little bit boring, but it matters a lot to the banks and the financials, which matter a lot to the market. And to Ernesto's point, could it be the push or maybe the result of this kind of rotation that we have seen?
So to me, I think it's important to consider why the yield curve is steepening and what that tells us about the economy currently. The steepening in the yield curve, the backup of rates, is a story of stronger growth. It's a story of potential inflation pressures. And it's a story that suggests that the economic recovery is going to pick up speed. And we very much agree with that. We're forecasting 6% growth this year. We think we're going to see a pretty meaningful acceleration, particularly in consumer spending right around the turn of the year, provided, of course, that the bullet points that you laid out in the beginning end up proving to be right. We get another round of fiscal stimulus. The virus cases continue to come in and come lower and lower, and people feel as though the coast is clear to start engaging in the activities that they hadn't before.
Yeah, how much does the Fed play into that, Michelle? Because let's say that we see a turn and virus cases start to go up again and things reverse. The Fed and maybe the Treasury, too, with, of course, Janet Yellen there, they've got our back. So it's almost like I feel like we're in one of these, if the news goes bad, don't worry, the Fed has got our back, at least financially.
Well, this comes to this idea of the Powell put or the fiscal put, which is there now as well. You know, if the economy were to weaken, there's a very strong counter from both monetary and fiscal policy. On the monetary side, it would probably just mean that they delay the tapering of asset purchase. They continue to expand their balance sheet. They kind of re-embrace a dovish stance again. And on the fiscal side, if the economy were to weaken, it probably would lead to a larger package and a more timely package. So certainly there's that counter that's really, really important. But in our baseline, you know, you end up seeing what is a very favorable situation, which is kind of this 1-2 punch of a low virus number coupled with the accumulation of stimulus. And it's very powerful for the economy.
Yeah. Yeah, and it has been powerful for the equity markets as well. So, Ernesto, where can we make money right now? Is there anything that even appears to be under or maybe fairly valued?
Well, I think you want to get exposure to the broad market, and I would say you want to have some growth, some value, some large caps, some small caps. And we have BMO Global Asset Management as funds in all those categories. The key is not to overpay for the stocks that you're buying because the market is a little bit highly valued. So you want to make sure that the stocks that the funds are buying are under the benchmark. So most of our funds trade at 3 to 4 points below the respective benchmark. So that's a level of protection in the funds. And one risk that we haven't focused on is corporate tax rates might be going higher as the Democrats now control both houses and of course the executive. So this is something that fueled the rally when Trump cut taxes, and we think it might be a risk that people are not paying attention because they're giddy with all the other good stuff that we've already talked about, and they're forgetting that there could be a big corporate tax hike on the way. So you have to be a little cautious and not get too carried away here.
Yeah, and Michelle, I want to kind of pivot just a bit because, and I'm not going to ask you to dive into politics. Do not worry. None of us that needs that right now. But there's a huge political debate. Unfortunately, it has become political about schools. Okay. Now, a lot of schools in America are open. But if you go to the big cities, L.A., Chicago, New York, many schools are closed and may be for the rest of the year. 4.7 million people dislocated from the workforce, according to the U.S. government. They want to work. They probably can't. Much of that probably has to do with their kids at home. You can't leave your 7-year-old at home alone to go to a job. So have you guys done any work on the importance of schools to the macro economy and the job market?
The linkages that you explained there are spot on, which is that when schools are closed, it means you don't have as much workforce engagement because it's hard for two parents to be out of the home and working. And there's a lot of evidence of that in surveys, and there's a lot of research that's been done on the topic that suggests that is exactly right. So when schools are able to reopen more broadly, which should come with the broader reopening of the economy, I do think that that helps to unleash a lot more labor into the economy, people who are on the sidelines, they're waiting to get back in, and they will do so once the coast is clear. And that has really impacted specifically women. If you look at the labor force participation rate amongst women, particularly prime working age women, it's down much more so than other cohorts. So that's a perfect example of how that could end up kind of resolving itself over time when the economy does indeed reopen more broadly.
Yeah, I think there's 1 million kids between LA and Chicago alone as they fight to reopen. Of course, you want to do it safely so the teachers, but to your point, there may be 1 million parents who simply can't go to their job. Because let's be honest, all of us watching CNBC, we can probably zoom in. There are millions of Americans that can't Zoom. They're the ones that we see at the store, at the restaurants, and we appreciate everything they do because they're out there every single day. Michelle Meyer, Ernesto Ramos, have a great weekend, everybody. Thank you.
Thank you.
Thank you.
All right, now to another fascinating story developing in the markets. Some short sellers are starting to poke around some of the SPACs, you know, all those blank check companies that are popping up nearly every day. And one big one has a big-time target, Chamath Palihapitiya, and is backed Clover Health, which is down again after a brutal short seller report. Leslie Picker joining us now with the latest on this and the broader push. Leslie.
Hey, Brian, that's right. Clover publishing a very long response to that report, calling the short sellers report, quote, rife with ad hominem attacks, sweeping inaccuracies, and gross mischaracterizations. Among the key findings of the report by short seller Hindenburg Research is that Clover is under active investigation by the Justice Department over a variety of issues, something that was never disclosed to shareholders until that report. Now, that report specifically took aim at Palihapitiya's due diligence chops, Clover acknowledging that it has received a request for information from the DOJ, but not any civil investigative demands or subpoenas. The company said in consultation with outside counsel, they didn't believe it was material to warrant disclosure. The company did note that it received a notice of investigation from the SEC yesterday. Hindenburg a few hours ago tweeting that it is preparing a response to Clover's response. But we're starting to see a trend here, Brian. Short sellers are increasingly targeting companies taking public by SPACs. We saw it with Carson Block's Muddy Waters and Multiplan, and with Hindenburg and Nikola before that. A record amount of capital has been raised by these special purpose acquisition vehicles, and now there's about $100 billion sloshing around looking for deals. The short thesis is that the competition can cause SPAC sponsors to ink deals hastily with limited due diligence and higher prices. But their efforts may be complicated by the recent backlash against short sellers. Even Hindenburg, which usually takes short positions, did not do so with Clover, saying that it instead wanted to showcase the, quote, role short sellers play in exposing fraud and corporate malfeasance. Brian.
All right, Leslie, stay with us. I want to broaden out the conversation and bring in Mr. Herb Greenberg, partner at Pacific Square Research, CNBC contributor, longtime friend, a guy I miss every day, and also a guy who's been writing about short sellers since John Madden's Raiders were playing in the Super Bowl. Herb, it's great to have you back on. You know, listen, I mean that as a compliment, my friend, because you and I have been through a lot of battles, Rocker Partners, Taser, remember all that stuff, Overstock.com, the Sith Lords. Talk to us about the role that short sellers often play. They are not, sometimes they're bad, but they're not always these anti-American, anti-patriots trying to ruin corporate America, are they?
Look, every time I hear that, obviously I want to shake my head. That's probably the most absurd comment I've heard. And my response to that is always the same. If you don't want the scrutiny, don't go public. And once you're public, you're a quasi-public organization, and you're opening yourself up to scrutiny. After all, these companies file SEC documents. They have filings with the SEC, and those filings have all sorts of information. And as I always like to say, you have two very smart people, and they both can come down very differently on how they see the company. And some people don't think the company is all it's cracked up to be, and they take a position against that. That's called short selling. But what they are, Brian, is they're also detectives in the marketplace. And that's not some like hoo-ha. They're out there basically trying to get you ahead of the curve that there may be a problem that may or will have a problem with the stock. And we have so many examples of that. Not that they're always right. Nobody's always right. No long is always right. No short is always right. Things happen. But the reality is you need people policing. They are among the ones policing.
Yeah, I mean, listen, a lot of these companies, and by the way, they come on the air, we like their CEOs. A lot of these companies, Leslie, they've got huge PR departments, right? I mean, they can tell their story, and sometimes it's one or two people that are poking around the balance sheet for a year that are able to uncover something that is malfeasance or just plain out fraud, and the market thanks them later, but at the time, they get attacked. I'm not saying I'm sorry for short sellers at all, but man, some of them just get punched in the gut constantly.
Yeah, you have to have a strong stomach to do this, especially the type of work that the Hindenburgs of the world are doing and the Muddy Waters of the world are doing. And notably, last week we saw Citron actually decide no longer to publish short reports after 20 years of doing so, having been on the opposite side of that GameStop trade, which marked a pretty notable sea change in the small industry that is short sellers these days. And it's worth noting, it is a small industry, smaller than it's been in recent years. Short interest as a proportion of just the overall market is at a 17-year low. There aren't that many people actually even short selling right now, whether it's for hedging purposes or directional bet. And so it's just kind of remarkable seeing these, changes in response to what we saw last week with GameStop.
Yeah, and I guess, Herb, listen, we've learned. Go ahead, buddy.
Well, I was just going to say something. When Leslie mentioned the low short interest, the one thing I would point out that people seem to forget in all of this is that the short sellers also provide, they help keep efficient capital markets, and they provide that sort of natural buying when a stock starts to fall, because they're going to be there buying. If they're not there, it's a vacuum. It's walking into an elevator shaft while looking at your phone and not really realizing the elevator isn't there. You go straight down. And that, I think, is one of the concepts that sort of gets lost in the noise of all this.
Okay, Herb, but let me flip it a bit. Okay, the reason that the Reddit army went after GameStop, was because it had 130% shorted effectively through, and people say, how's that possible? I don't want to go into this synthetic stuff and options, whatever it might be. The SEC is supposed to prevent naked short selling. This was not exactly that, but Herb, do you think there should be limits on not banning short selling, but maybe firm caps on the amount of any kind of product that can be percentage short against the float?
My response to that is go read Reg SHO, which I think was 2005 by the SEC. Go down to, I think it was section D or somewhere. There is a huge section in that Reg SHO, which was designed to prevent short selling, that explains how there can be the appearance of naked short selling when there is none. This was a populist idea to sort of glom onto by people who had no idea what they were talking about. And the reality, I don't know what the real short interest in GameStop was, and I don't really care. But when I see people pulling that number out over and over again without knowing what they're talking about, that's disturbing, because they don't understand how the markets work. And I think that there's been very little discussion about that in the mainstream media.
Well, regulation SHO, Herb, while important, not exactly light reading. And maybe that's why we're not exactly getting a lot of conversation. No, it's not. Right. Herb, it's great to see you, buddy. Miss you every day.
It's great seeing you, pal.
You always add a smart voice. Yeah, we'll have you back on. Leslie Picker, awesome stuff as well. Leslie, see you soon. Big story there that is nowhere near being over. Thank you both. All right, coming up. Former hedge fund manager, hockey team owner, baseball team owner, and now developer. All one guy, Jeff Vinnick. He's got a lot of titles to his name. He'll join us to talk about his latest investments in one American city. Plus, we're going to name the top 5 companies with the most insiders buying up their own stocks this week. The top 5, something you will not see anywhere else. And it's been a big week for a lot of stocks. But here's the best of the best so far in the Dow. It's Dow, Amex, Visa, Cisco, Nike. Big weeks. We're back after this.
This is The Exchange on CNBC. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
I'm Jemana Versace, and these are the stories you should be checking out on CNBC.com. U.S. President Joe Biden has filled his foreign policy team with several advisors on Asia. Analysts say the move signals the new administration is preparing to respond to China's growing global influence. That story's on the website now. Australia's competition watchdog says Google must decide if it wants to pull its services from the country or not. The U.S. tech giant has threatened to leave Australia over a bill requiring it to pay local media and publishers to link to their content. Head online for the full story. And Chinese short video platform Kuaishou has delivered a blockbuster debut, having been over 1,000 times oversubscribed on the retail side. Kuaishou shares almost tripled in value on their first day of trade in Hong Kong. Check out that and all these top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Oh, welcome back. Well, normally we do this next exclusive segment every Friday on Worldwide Exchange, 5 a.m. Eastern. Check it out live or tape it if it's a little bit too early. But since I'm here today and I think it's important stuff, we're going to do it right here on The Exchange. And that is our weekly insider buying segment, highlighting the 5 companies with the most insiders buying up their own stock. This isn't stock buybacks. These are individuals with their own money buying their own stock. And as always, the data comes courtesy of InsiderScore.com with our gratitude. So here you go, counting it down, 5, 2, 1. The 5th most insider buying this week, Alliance Data Systems, ADS, director buying $410,000 worth. Second purchase by the director, by the way, in 6 months. Number 4, TI, Texas Instruments, a board member there buying just under $1 million worth, $997,000 to be exact on that name. The 3rd most insider buying, this is fascinating. Intel's outgoing CEO Bob Swan, that's right, on the way out the door, buying up Intel stock, picking up $1.5 million worth of INTC. Second, 2 are a little lesser known names. Second most insider buying, Teledyne Technologies, TDY, a director buying $3.5 million worth. By the way, he had recently sold about the same amount, so this was a complete 180 reversal on Teledyne. That is a stock to watch. And the most insider buying this week is little talked about and little heard of, MSC Industrial Direct, ticker MSM. No, not mainstream media. Long Island-based maker of cutting tools and such. A board member there, a former CEO, by the way, buying $5.2 million. And get this, according to Insider Score, the last time this former CEO bought MSN was 2008. Wow. So there you go. The top 5 companies with the most insider buying, ADS, TI, Intel, Teledyne, and MSC Industrial Direct, MSM. We've been doing this for a few months now, and the stocks we've highlighted, and there are many, have as a basket outperformed the overall market. All right, coming up, No industry has been ravaged like the restaurants, COVID, lockdowns, and labor costs expected to go up. We'll speak with one of the biggest barbecue chains in the country about what they're seeing on the road ahead. And don't forget, if you are getting out or getting anywhere, then watch us live on the go on the CNBC app. The Exchange will be right back. Dow's up 90.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
All right, welcome back. Well, not sure if you've heard, but there's a big football game this Sunday. The Kansas City Chiefs and the Tampa Bay Buccaneers facing off in Super Bowl 55, which is also being held in Tampa Bay. So is there anything Tom Brady really can't do? Because it's not just about Tampa Bay, as they're calling it, and football. The city, which is booming, is now bringing in some big buck new developments. And Diana Olick joining us now with a closer look at a very special guest. Diana.
Well, Brian, Tampa just ranked as one of the top 5 housing markets for 2021, according to Zillow, clearly propelled by the work from anywhere world of the pandemic. But developers were already taking big bets on the city. A $3.5 billion downtown development broke ground in 2016 and is still going up. 1 million new square feet of office space, as well as 1 million of retail and hotel and residential. Water Street Tampa is from a partnership between Bill Gates and Jeff Vinik. Vinik also happens to own the Stanley Cup winning Tampa Bay Lightning, and he's here to talk about it all. Jeff, thanks so much for joining us. I got to say, the landscape for construction and development has changed dramatically during COVID, from equipment delays to labor issues and a real spike in the price of building materials. How has that hit your project?
It hasn't. We've been under construction for about 2-3 years now. And so we have locked in a lot of our materials. Labor actually has eased up a little bit. So, we got about 4 or 5 million square feet of our phase one, which is a little bit over $2 billion. And this is all coming out of the ground now. Actually, it's being topped off now. And 15 months from now, we're going to have 1,000 new residential units. We have 500,000 square feet of office, USF Med School, 2 new hotels, a 4-star and a 5-star, retail, galleries, the whole thing. So we are very excited with where we're at, and we're opening soon.
Yeah, but of course, timing is everything. And as you talk about millions of square feet of office, retail, it's a time when those two sectors are really struggling badly. What are you seeing in the leasing?
We're seeing outstanding interest. You're right. These are very difficult times economically. A lot of people are hurting. But the fact of the matter is, for the overall U.S. economy and certainly for the Tampa Bay economy, this is kind of a 18-month setback on very strong growth. I'm extremely bullish about the overall economy looking at over the next 10 years. And I'm even more bullish about the Tampa Bay economy. People are moving in here right now at a rate of 2 to 3% a year. You combine that with, the construction, the activity that's going on here. You're looking at nominal growth in Tampa Bay, Florida, about 7% plus over the next 5 to 10 years. That is a booming economic growth. We are going to lead the country in the amount of economic activity. And, great partner I have in Cascade Investment, Bill Gates' company. And they see it too. This is the place to be, and we're so fortunate to have this Super Bowl to be able to broadcast to the world what they're missing by not doing business here and moving to Tampa Bay, Florida.
Now, even before the pandemic hit, Water Street Tampa was the first community to be given the WELL designation from the Well Building Institute. Now, given how the hyper focus now, what does that really mean physically when people are looking at wellness and health, and how does that attract tenants?
Yeah, it's kind of driven the interest in tenants and residents in wellness into hyperdrive. I mean, people already were moving in that direction, very strongly in that direction before COVID. And we've designed all our buildings as well as our overall district to meet the WELL building standard, which has really higher standards for air quality, for water quality, for water features in the district, for trying to cut down on pollution, for having fruit, for doing a lot of walking inside buildings, overall walkability, bike paths, water fountains, you name it. And we are the first WELL certified community in the world. And, it's all about quality of life to everybody we're bringing here. Again, whether it's office workers, people who are living here, people staying in the hotels. This is going to be a very distinctive district and, leading to a very vibrant downtown Tampa and a very vibrant Tampa Bay.
Hey, Jeff, it's Brian Sullivan. Appreciate you joining Diana and joining us here on CNBC. There's obviously a lot going on. Ybor City, by the way, is fantastic. Jimmy's Tacos, I'll just throw that out there. That aside, we're talking a lot about wealth taxes in the United States now, obviously state taxes as well. Do you think that this work from home thing that we're doing, while may not lasting permanently for everybody, is just going to accelerate this move? Because if you layer the wealth tax on top of that, you can't avoid the federal government, but you can avoid a state government.
Yeah, I don't know. I don't want to speculate on politics and wealth taxes, things like that. On the work from home movement, no doubt 5-10 years from now, there will be more hours worked at home than there were pre-pandemic. I still think having a central office location, there's no substitute for person-to-person interaction, stimulative, the collision of ideas to create better, to create better projects and stimulate thinking. I still think that's an essential part of business. Wealth tax or no, I'm very bullish on the opportunities.
Well, you may not want to touch this next one either, Jeff, but I'm going to ask it because you and I were both around and you were just rolling it in a hedge fund back then. Do you see any similarities between now and 1999?
So let me give a preamble before I cautiously answer that question. So my preamble is I'm incredibly bullish on the economy over the next 10 years. And I know people have been hurt by COVID, very sympathetic to that, but I think things are going to get a lot better. And I think the biggest theme we're looking for is for finally Main Street is going to beat Wall Street. So that means more equality, more jobs, better paying jobs. I think all the trends are going in that direction. In terms of just the overall market environment, I think we definitely have pockets of activity that rival 1999, 2000. There is huge speculation in going on in some areas of the market. Maybe I'd even call it a mania in some areas of the market. So I think you do have to be very cautious. But overall, when we have a really strong a good economic outlook, I think in general, for companies that make money and have good long-term prospects, I think they're just going to do fine in the market.
Well, and Jeff, just jumping off that, the retail trading community is more engaged than ever thanks to apps on our phones. What warnings do you have for this new generation of traders?
Yeah, you know, capitalism is a great thing, and markets are a great thing. And every so often, they kind of break or things wrong a little bit. And that just goes with the territory. And I think the phenomenon we had a couple of weeks ago, where stocks got squeezed, shorts got squeezed, and stocks went way above their economic value. I think that was just one of these things where things went a little bit, got a little bit out of hand, and some got hurt by that. My fear is those retail investors who are fueling it, they couldn't all buy low and sell high. It just doesn't work that way. So I'm hoping that, you know, my fear is that a lot of them have gotten burned by that, actually bought high and sold low, lost quite a bit of money, and they may not want to come back to the market. They may have a bad experience. So I hope that people didn't get hurt by putting, you know, touching their fingers down on the frying pan. But, you know, that, again, that's kind of, I wouldn't call it a sideshow. It's real money and real activity. But the bigger picture is a really strong goods producer. We have an economic boom going on right now, goods producing. Service side of the economy is in the tank. As more people get vaccinated and we come out of COVID, that's gonna turn up. And we have a ton of stimulus that's already occurred, that's in the pipeline. We have $1.5 trillion of savings. We are set up for just dynamic, strong economic growth over the next 2, 3, 5 years. I think we have an economic boom right at our doorsteps.
And that's a great place to leave it, though. Jeff Binnick, thanks so much for joining us. Brian, back to you.
Yeah, you know, Diana, too, if you look at like the U-Haul truck rates going down to Florida, the cost is often triple what it is going north. I think, Diana, everybody's heading south. Whether or not they're going to stay there forever, we don't know. But when there's 2 feet of snow on the ground and it's 74 and there's no state taxes. Yeah, it's a big deal. And Diana, big interview, and we appreciate you bringing it to the exchange. Thank you.
Thank you.
All right, coming up, the vaccination push plows on. J&J one step closer to having their vaccine hit the market, and the Biden administration sending in the National Guard to help. Literally. Stories coming up. Plus, total student loan debt in America now topping a staggering $1.7 trillion. Some in Congress want it canceled. Corporate America also stepping up to help. We'll give you details ahead.
I can see the future painted in my eyes. Open up the door and fade into the night. Dive into my world I know. Take my hand, follow me into the sun. There's no end. This is where we go.
At Standard Chartered, we believe money can be a force for good. Which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost our planet.
This is where we go.
Standard Chartered, here for good.
CNBC's Healthy Returns Conference is all about the biggest developments going on in medicine and the things that investors can use to make decisions about where to put their money.
The majority of innovation in the last 10 years has not come from the top 10 pharma.
We've got FDA Commissioner Scott Gottlieb.
There are things that we can do to make it easier for the generic companies.
Craig Venter, he's a genetics pioneer.
Preventative health care could save the economy trillions of dollars.
At CNBC, what we do is we follow the money. Healthcare is 18% of the U.S. economy, so it's a huge business story, but it's also deeply, deeply personal.
Brian Sullivan. Good morning. Worldwide Exchange on CNBC.
And welcome back to The Exchange. Hope you're having a good Friday wherever you might be. The markets right now are having a pretty good Friday. Not great. They were up 196 in the Dow. They're now up just about 100 points, but still, it's been a nice week for stocks. In fact, this week, the NASDAQ is up more than 6%, one of its best weeks in a long time. As far as the sectors that are doing well, you got materials, consumer staples, and consumer discretionary sort of leading the way there as well. Communication services up as well. IT, the only sector, by the way, in the red. And it would not be a show without showing you GameStop. That stock jumping a little bit today, of course, after just a wild few days, really a week of trading. Stock's fallen 81% this week, but of course it rocketed higher last week. GameStop right now up about 11.5%. All right, let's step out of the stock market. Get a check on some of your top world and national news. For that, Sue Herrera and a CNBC News Update. Sue.
Good to see you, Brian. Here's what's happening at this hour, everyone. The Pentagon is deploying more than 1,100 active duty troops to 5 COVID vaccination sites. 2 locations will be in California, with troops set to arrive there in a little bit more than a week. Virginia lawmakers have voted to repeal that state's death penalty. The bill now goes to Governor Northam, who is expected to sign it into law and make Virginia the first southern state to end capital punishment. Workers at an Amazon warehouse in Alabama will get to vote on whether they should unionize. The National Labor Relations Board has denied Amazon's motion to halt that election. Ballots will start going out on Monday. And fashion designer Peter Nygard has been denied bail by a Canadian judge. Nygard faces extradition to the U.S. on 9 charges of sex trafficking and racketeering. He denies the allegations. You are up to date, Brian. I will send it back to you.
All right, Sue Herrera, thank you very much. Now let's get the very latest on the fight to get everybody vaccinated. Johnson & Johnson officially requesting emergency use authorization from the FDA for its COVID vaccine candidate. Now, if approved, this would be the 3rd vaccine in the U.S. market. It would not only boost the overall supply of doses, but could also simplify vaccinations for many because it's only 1 dose and does not need to be kept at negative 70 degrees Celsius. Now, overall, the pace of shots in arms has picked up dramatically. Right now, more than 57 million doses have been distributed, 35 million of those administered. Remember, there's a lot of logistical log jams. Now, of those, nearly 30 million have received 1 dose, and about 7 have had both. Little back of the envelope math, and about 10.9% of the American population over the age of 18, because that's how the census breaks it out, has been vaccinated. That far number, by the way, is the number to watch. There's your daily vaccination update. By the way, the pace is about 1.4 million shots in arms every day. All right, coming up, with student loan debt topping 1.7 trillion, employers are taking steps to help workers pay off their loans. Sharon Epperson will join us with a look at how much help is really being offered and how it could also help bridge the racial divide. And as we head to break, February is Black History Month, and we are honoring some of our CNBC friends and contributors. Here is contributor Tiffany McGee with her personal story about taking risks.
When I was about 5 years old, my dad quit his corporate job to be an entrepreneur. So the next day, he went and sold hats and gloves on the street corner in the middle of a snowstorm. He eventually grew his business into 2 retail stores. He taught me how to take risks. And now, with the launch of my new firm, Pivotal Advisors, I'm the first African-American woman, first Afro-Latina to have an institutional investment advisory OCIO firm in the country.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch. Weeknights on CNBC.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
Well, student loan debt in the U.S. is still on the rise, topping $1.7 trillion. And the gap in that debt held by black against white borrowers is also growing. But some employers and the federal government are taking steps that could try to lessen the burden and bridge that racial divide. CNBC's Sharon Epperson is here and has more.
All extra money goes towards the loan.
31-year-old Aaliyah Gibson, a human resources specialist for New York Life, spends a third of her budget paying off her student debt. But she's not tackling her college loans alone. She's getting help from an often untapped source, her employer.
The program pays out $10,200 over the course of 5 years, and it's $170 per month.
According to the Society for Human Resource Management, about 8% of organizations offer student loan repayment assistance as an employee benefit. Vault, a leading technology platform that helps companies navigate that process, says employers now have a new incentive.
Now is a perfect time for employers to intervene.
That's because the COVID-19 relief package that passed last December now allows employers to make contributions of up to $5,250 a year to their employees' student debt, tax-free, through 2025. Employees don't have to pay taxes on those contributions either. And Gibson says there's another big bonus.
You, one, are saving money on not paying interest, and you're paying down the principal, which is the name of the game to paying off your student loans.
Borrowers got a break from accruing interest and making monthly payments on their federal student loans, starting in March under the CARES Act. And after one of President Biden's first executive orders, that pause will now last until at least October 1st. But it's temporary relief.
A pause only delays the inevitable, which is the student loan debt still exists.
And can play a significant role in future wealth. Studies show black young adults start their careers with more student debt than whites, and that disparity grows over time as white borrowers pay down their debt faster. The impact? The average net wealth of older white millennials with a bachelor's degree is 10 times more than blacks in this age group. Having employers, government, and individual borrowers work on paying down student debt is a strategy Gibson hopes can help close the racial wealth gap.
For people like myself and other people of color, this helps to close that gap tremendously because once again, you are able to take control over your financial situation.
As companies compete to attract the best, most diverse workforce, Volt CEO Romy Parzik says offering student loan repayment assistance can also be a powerful incentive for retention and recruitment. And advocates are also pushing for Congress to make the tax incentives around the employee benefit permanent. Maybe that will encourage more companies to offer it as well, Brian.
Yeah, I mean, heck of a story, Sharon. So a quick question, follow-up. Are there other ways that companies, bosses are helping workers pay off their student loan debt other than the ones that you just laid out?
Well, in addition to this pandemic time that we're seeing with direct payments being made, some companies are actually taking paid time off that has not been used and using that money to allow employees to put that toward their student loan debt. There is also another really innovative idea of allowing people to pay down their student loans on their own, but then that money that they're contributing, that percentage of their payroll that goes to student loan debt, their company will match their 401k contribution, put money into their 401k at that percentage so that they're not missing out on building their financial future while they're paying down their current debt.
Yeah, I'll never forget going out for beers with some of my law school classmates, Sharon, and a classmate of mine showed me her student loan debt. Undergrad and law school was over $300,000. I often think about where she is these days. I should follow up with her. Sharon Epperson, thank you very much. Appreciate it. Great and important story.
Sure.
All right, on deck. While parts of the country are in a recession, many parts of the restaurant industry remain in a full-blown depression. Your next guest runs a huge restaurant chain. She'll tell you what she wants Congress to do about it.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say post-September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Well, really no industry, maybe hotels, has been hit as hard during the pandemic and lockdowns as the restaurant business. While the food services sector saw big job declines in January, losses pale in comparison to the nearly 500,000 jobs lost in December in travel, leisure, and hospitality. Now the proposed $1.9 trillion relief bill could provide some much-needed help. With Joe Biden's $15 minimum wage proposal on hold, at least for now, a lot of restaurants are really concerned about the future. Joining us now is Laura Ray Dickey. She runs Dickey's Barbecue Restaurants. They have more than 500 locations, 44 states, and multiple, in fact, 2 in the United Arab Emirates, as a matter of fact. Laura Ray, thank you very much for joining us. A lot of members of Congress and their aides and lobbyists watch CNBC all day long. You've got a direct platform to them as a representative of the restaurant industry. What would you like Congress to know about your business?
Well, thank you so much for the opportunity. I think I would love Congress to know that there's a real opportunity to help the industry, to make a direct impact on our workers, on our industry directly with, for example, targeted aid that specifically helps the industry, any sort of tax credits, any sort of payroll tax or incentives in that regard. And also, after prioritizing our first responders and vulnerable populations, then prioritizing frontline workers in the industry for vaccines would greatly help restore consumer confidence.
You know, your restaurant's unique, okay, because I know that you have some that are more dine-in than others. Can you talk to us about the difference running a restaurant between, you know, a sit-down Dickey's, I think you have one in New Jersey, Egg Harbor Township, and sort of more of a takeout in a more open area? Geographically, things are very, very different in America.
They're very different. And that is an absolutely excellent point about why we need such a variety in the type of assistance that will help us out. For example, our business is that type of flexible space. We have indoor space, we have outdoor space, we have dine-in, drive-through, delivery to go. It's one of the reasons that we're doing better than a lot of our competitors and peers in the industry, because we have such a digital infrastructure that allows for delivery. That's really where we're seeing our growth in sales. But the folks that just have dine-in business, those are the folks that are suffering the most, especially those that are in the casual dining and fine dining sectors where you have, for example, waiters and waitress style. For us, that doesn't apply. We come in and have a pitmaster, and you go through after you get your smoked brisket right there in front of you and your sides. You're queuing through, you're paying with the cashier and sitting down, or taking it to go or having it delivered. It's that flexibility that's helped us, but it's also that type of flexibility that many folks don't have, and that's why any type of incentive for relief for the industry is really helpful.
Laura Ray Dickey with the Restaurant's Perspective, and by the way, making us hungry, too, with Dickey's Barbecue. Look forward to dining in with you at some point again soon. Laura Ray, thank you very much. By the way, I'll be on the news with Shepard Smith tonight talking about New Jersey opening up just a little bit and going out to dinner tonight. That's it for The Exchange. Have a good weekend, everybody. Power Lunch begins after this quick break.
Navigate the new normal. Squawk Box on CNBC.
As far as the Bank of England is concerned, the outlook seemed to be relatively optimistic versus what people were expecting to hear.
You should see the strong growth we have and the fact that it's stronger than the forecast we had in November later this year really as a function of the lower starting point. In levels terms, we're not any more optimistic than we were 3 months ago, but I think the vaccination rollout gives us a little more confidence.
Welcome, everybody, to Power Lunch for a Friday afternoon. I'm Tyler Matheson. Seema Modi will join us for the hour in just a moment. And here's what's ahead. Do not call it a comeback. Stocks, however, are back at record high levels as investors bet more on stimulus and a strong economic recovery. That in light of a fairly weak jobs report, however. Crypto fever on Wall Street as big firms drive the latest rally in Bitcoin. We've got those details. And later, waiting for the Super Bowl kickoff. We'll talk sports and sports investing with George Pine about how it's going to be a streaming Sunday this year. Power Lunch starts right now.
Well,
Welcome to Power Lunch. I'm Seema Modi. All three major averages are on pace for their best week since November, coming off a volatile last week. Bob Pisani has more on this major turnaround. Bob.
And Seema, we're in the middle of a little bit of a melt-up, not just today, but really for the whole week. The S&P 500 is up 5 days in a row. Hasn't done that. Best streak since, go back to August. We're up 5% for the week here. And why are we melting up? Well, there's several factors involved. Let me just list them for you. First, the most important thing, the vaccine rollout is accelerating. That's number one. Number two, it's go big stimulus over go small stimulus. President Biden will be getting the bigger end of the stimulus, closer to $1.9 trillion. And, of course, we've got a second half reopening that's getting very real. We're seeing stories about travel bookings surge. And finally, most importantly, blowout earnings. And, of course, we're seeing some real numbers. They're raising estimates for 2021. That's really what moves the markets here. As for the shorts this week, the big stories last week here, much quieter. Bitcoin started the week at $325. You see here down, it's $58 now. That's down about 80%. AMC, another big short. That one's down 50%. Best Buy, Bed Bath & Beyond down 25%. Finally, GameStop may be a little iffy, but boy, they are buying video games. Did you see Activision Blizzard? New historic high, blowout earnings, and the guidance they gave for 2021 well above estimates. This is a story of two different game companies there. Of course, GameStop versus Activision. Very different stories there. Guys, back to you.
All right, Robert, thank you very much. So as stocks do approach these record highs, what's left to buy now at what prices? Let's bring in Alicia Levine. She's Chief Strategist and Managing Director with BNY Mellon Investment Management. And Ron Insana is CNBC Senior Analyst and a commentator as well as a Senior Advisor at Schroders North America. Welcome to both of you. Ron, are you feeling a little more sanguine about the direction of the market and the economy than you were, say, a month or so ago?
Yeah, I would say, Tyler, from the perspective of the vaccine rollout and the additional vaccines that are likely to get emergency use authorization, you have to feel somewhat better about that. And the quickening pace of vaccination is good news as well. And then again, this clearance, this budget process that went through overnight that resulted in clearing the way for a budget resolution that might be larger rather than smaller, as Bob Pisani suggested, for the Biden team to infuse more money into the economy is all good news. And as he said, earnings are good. So, yeah, I mean, I'm feeling better. I mean, and obviously, you know, we can talk the valuation game all day long. The reality is with interest rates at zero, the Fed committed to keeping them there. It's very hard to fight the tape, fight the Fed, and now fight fiscal policy in a manner that would lead you to try to get, I think, maybe too negative on the market in the short run.
My sense, Alicia, is that you largely agree with what Ron just laid out there. Tell me where you don't, if you don't. But I was also struck in my notes by one thing that you said to keep an eye on, and that was the energy sector as a bit of a telltale on where the market and the economy may be headed. Why energy?
So thanks. Nice to see you again, Tyler, on a Friday afternoon. Yeah, I do think energy is really the place to go for you to see where the market's going, because that is the deep value play here. That is the sector that's really unfavored and also subject to a lot of regulation with this administration. If this sector can power ahead in terms of price performance, and I think you're safe in terms of where the market's going. And so I would use this almost as a contrarian observation of, you know, where we think the market's going, that despite the regulation that has come and will come, if it can power ahead, the market's okay. I'll say this, I think that the higher yields do require some rotation into financials and into industrials. Industrials really have underperformed for the last few months. They've been quiet. They've been building bases. So I'd look to industrials right here. I think some of the longer duration assets could have trouble as yields move higher.
What is the lesson, Alicia, to you of this Reddit scenario that we've been living through the last 2 weeks? What can investors take away from it intelligently and safely?
Yeah, so in some ways, the Reddit rebellion was really what I'm calling a perfect storm. And it really started with over-positioning on the short side. And you kind of needed that as a prerequisite condition to get this going. But then, of course, you've got people at home, stimulus, extra cash in bank accounts, and a social community that move together. And I think that's really a fascinating thing. I think the lesson I'd like for retail investors and all investors to learn that parabolas don't end well. Very hard to commit new capital when parabolas are growing, because it doesn't end well. It may not end in a month or a year, but it will end. And you have to be very nimble here when you get these kind of price movements. And wherever you're invested, those kinds of moves are dangerous ultimately.
Ron, we don't see certainly an overheating job market, which often is one of the precursors to inflation. But you say that rising inflation and rising interest rates, perhaps tied to all the money that has been pumped into the economy, is something that bears watching.
Yeah, I think so, Tyler. We've seen inflation break-evens, tick up above 2%, both in terms of the 5-year break-even and the 10-year break-even, suggesting that the bond market, which was discounting 0.5% inflation rates last March, is now discounting better than 2% inflation rates. And again, as the Fed Reserve suggested, some of this can be transitory, supply chain disruptions and the like, and then pent-up demand could drive some prices higher. But, Larry Summers, a former Treasury Secretary, wrote an interesting op-ed in the Washington Post about prospectively and potentially overstimulating the economy and leading to an outcome in which inflation accelerates, as we're throwing now on top of the $900 billion, potentially another $1.9 trillion to get this economy going and get it back to full employment. I don't think it's an immediate term risk. I just think we have to pay attention to it a little more than we have in the past and watch those break-evens, and you could get those from the St. Louis Fed or watch the 10-year note yield, and that may be the tell going forward.
Yeah, when you look at the total tonnage of stimulus that has already been put into the economy by the Fed and the federal government, and now the prospect of more, as a percentage of GDP, it's really massive. We've had a little trouble with Alicia's shot, and we're going to say goodbye to her and Ron as well. Thank you both very much. Seema.
Ty, Robinhood's reputation as a service that brings trading to the people taking a big hit during the GameStop phenomenon. First, we saw the app get trashed with negative reviews, and now the complaints are rolling in with the FTC. Kate Rooney looking at that side of the story. And Kate, I guess it's starting to get the attention of Washington.
That's right, Seema. The Federal Trade Commission saw a surge in complaints about Robinhood last week as that GameStop trading saga played out. The agency shared more than 100 complaints with CNBC about Robinhood between January 24th and February 2nd. That was up from just 7 complaints the prior week. We read through some of these complaints against Robinhood. They do show a widespread frustration with customer service. Some talked about an inability to leave the Robinhood app. One Robinhood user says that they could deposit but not withdraw. Another said that their complaint was essentially sent into the void, as they call it. Quote, this customer says, I just want my money and I want to close my account so that I can be done with this service. We don't have comparable numbers yet for the other competitors. We will, of course, bring you that when we get it from the FTC. Robinhood did respond, saying that they're committed to improving the support they provide customers. They also say it's a top priority, and their hiring of customer service agents tripled last year. This does, of course, speak to some of that record growth at Robinhood that we've talked about and the difficulty of keeping up with momentum. The app now has more than 13 million users and, by one estimate, added 600,000 clients just last week. Seema, back to you.
So interesting, Kate. I was actually texting with a friend of mine who considers himself a Reddit trader, and he's been seeking the legal counsel of his dad's lawyer to see how he can put some type of lawsuit together. But I know you're also watching for data on the most actively traded stocks amongst retail traders. You would think it's GameStop, but it's not, right?
Yeah, not the case. We got some data from JP Morgan out today that shows that GameStop was not in the top 10 among the most bought name by retail investors, at least last month. That suggests that despite grabbing the most attention online, it really wasn't the Reddit traders moving GameStop. Institutional investors may have been the ones driving a bigger portion of that wild price action in GameStop. You had AMC Entertainment and Plug Power, which were also caught up in that trading frenzy. Those two did make the top 10. But it was also big tech. You had Facebook, Microsoft, Tesla, and Apple all making it into the top 10. This also does get back to Robinhood, though. They have argued that a majority of their clients are not really day traders. This does show investments in some high-flying, sort of volatile stocks, but also some of those blue chip names like Apple. Back to you guys.
All righty, Kate, I'll pick it up. Boy, it looks nice out there wherever you are in California. It's a lot different than it is here in New
sunny,
Jersey.
right?
All righty, folks, we know Reddit. Yeah, right, exactly. We know that Reddit sort of started that GameStop frenzy to crush the hedge funds. But we also know that some hedge funds cashed in as well. Let's go to Leslie Picker for that side of this complex story. Leslie.
Yeah, Tyler, that whole narrative of the little guys taking on the big guys, well, it got a little muddied this week. Retail traders, as Kate was mentioning earlier, they were actually not big participants in GameStop. They were net sellers last Tuesday through Thursday as well, according to Citadel Securities. So who was the one buying? That's the big question right now. Well, much of that activity was driven by hedge funds covering their shorts and other hedge funds riding the momentum higher and subsequently lower. The Journal reporting earlier this week, and we've also confirmed that one fund called Senvest Management has been long GameStop for a few months and crystallized $700 million gains when the stock hit its peak. BlackRock, too, which as recently as last week owned 13% of the company, may be sitting on significant paper gains, even despite the recent ups and downs. Some shorter-term institutional investors, albeit computer or human, whose positions have not been disclosed, and honestly, they may never be disclosed, are also said to be traversing this stock on the long side. But still, as we've been reporting, those who were short, notably Melvin Capital and Maple Lane Capital, facing significant losses from the activity, guys.
You know, Leslie, this is really, to me, for the hedge funds, it's really a lesson in risk management and how exposed as a percentage of your portfolio you're willing to be in any single issue or position, right? Right.
Well, risk management always comes down to statistics. And if you think about it, what's the percentage chance that any specific stock you're going to be short is going to go up 1,000%? I'm not a statistician. I did TA statistics in college, but I would say it's a very, very, very small chance if you're kind of thinking about it from a risk management standpoint. Now, we know after last week there are certainly lessons to be had about risk management and, you know, how levered you can be and how, you know, what your short exposure is to certain stocks, especially those that could easily be targeted for a squeeze. That is something that a lot of people in the hedge fund industry are certainly reckoning with and certainly drawing their conclusions and lessons and reshaping their portfolios as a result.
And you also wonder what type of risk management strategies these retail traders are using, Leslie, with the fact that Robinhood is lifting more restrictions today and what you're actually seeing GameStop higher on the day.
Right. Well, they probably don't have the same kind of, you know, institutionalized guy who sits in the office whose job it is to make sure that the portfolio is up to snuff when it comes to risk management. But you're right. The risk management falls to the Robinhoods of the world, to the exchanges of the world. We saw GameStop halted a few times already today based on some of that volatility. And, of course, Robinhood lifting the restrictions on the amount of shares it can purchase. The users can purchase. Yeah, and what you have here is this very unusual, I got to wrap it, but this very unusual situation, maybe we've never seen before, of a crowdsourced short squeeze taking place via a social media platform. Leslie, have a great weekend. You too. Thanks, Tyler.
And coming up, you bet. Wild moves in GameStop might not be the only surprise traders get this year. Probably pretty sure that won't be. Wait until they see their tax bill. We'll explain that. Plus, a big week for Bitcoin as the cryptocurrency edges back towards $40,000, a little bit down today. We're going to take a look at what's been driving the gains next on Power Lunch.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
But you look at the occupancy rate of our retail properties, it was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
Not just stocks. Bitcoin having a strong week, up almost 10% as the boom continues to be driven by more money from institutional investors. Last year, according to CoinShares, total inflows were $6.7 billion. In the first 5 weeks of 2021, there has been $2.3 billion in inflows. Joining us now to discuss is Meltem Demirors, CoinShares Chief Strategy Officer. Meltem, good to have you on. We've been seeing more interest from institutional investors, BlackRock, Fidelity, over the last 3 months. So I'm wondering if the recent surge in Bitcoin and other cryptocurrencies, you would attribute that to the Reddit retail trader, because we know cryptocurrencies is a big topic of conversation on these Reddit chat boards.
Yeah, Seema, great to be here. And obviously a lot of conversation about Reddit, social trading. I think Tyler was just chatting about the first crowdsourced short squeeze. What we're seeing in Bitcoin is certainly not a short squeeze. Look, I think there's two factors here. What we really look at CoinShares is we look at sentiment, and sentiment really drives demand. And as you alluded to, a lot of the interest in Bitcoin is coming from institutions. When we look at trends on the trading side, on the structured product side, where we operate and manage $4 billion in assets for our clients, a lot of the inflows are coming from institutions who are allocating through publicly listed exchange traded products or funds. There is retail participation, but it's nowhere near what we saw in 2017. I think what we are seeing, where we are seeing the retail participation, is in things like Dogecoin and other sort of smaller market cap cryptocurrencies that lend themselves more to memification and, what we call meme coins or meme stocks if you look at GameStop and AMC. But really what's driving Bitcoin, in my view, is a fundamental shift in sentiment. Ray Dalio's talking about it. BlackRock's allocating to it. Guggenheim's allocating. Right. All of the major allocators are now getting in.
But how long can this last? I mean, how long can this bullish sentiment surrounding cryptocurrencies last when you have the likes of Janet Yellen, who just got confirmed as Treasury Secretary, and one of the first things she said is that there will be more regulation that the cryptocurrency industry should get ready for?
Yeah, absolutely. And look, I think Janet Yellen's comments were fairly nuanced. There's an alphabet soup of 3-letter agencies that already regulate the Bitcoin industry. I think there's sort of this misconception that Bitcoin's unregulated, which is certainly false. We spend a lot of time on compliance in our organization. But look, I think what is happening is in 2020, it was a risk for investors to allocate to Bitcoin. In 2021, it is a risk to not allocate to Bitcoin. And it's not just investors investors, it's corporations. MicroStrategy is soaring on the back of its allocation to Bitcoin. It has more than doubled its treasury reserves due to its allocation. They just hosted an event with over 1,000 corporate treasurers in attendance. And also, I think we now have nation states starting to seriously look at what role Bitcoin could potentially play in the future of their economies. So it's not just institutions and retail, it's also corporations, it's governments, it's the whole world. And I'm really excited.
I'm sure it's exciting for you. I guess the money is flowing there. I hear you on that point. BlackRock and Fidelity, even eBay and PayPal offering more Bitcoin trading options. But when you see the likes of a Dogecoin, I mean, just be real with me. This is an internet meme. This can't last, right?
Sure, but look, what I think is happening with Dogecoin is very similar to what we see in other stocks over the last 12 months. Here's my crazy idea, right? The most popular part of any video game is the market in that video game. In Roblox, most people spend their time in the marketplace. This is what we see now. People are at home, they're learning about capital markets. Money printer go burr was a meme last year. This year, we have retail traders and my friends on Reddit and Twitter talking about short squeezes. Like, who knew that this would be the world we live in 2021? So I think we see the same thing in the crypto space. People are attracted to finding new opportunities. People are concerned about the long-term viability of their savings. People are looking at what's happening to the money supply. Janet Yellen has expressed an intention to continue printing her way out of this crisis. So people are looking for ways to preserve their wealth. And look, is Dogecoin a way to do that? Most certainly not, in my view. I think the fundamentals there are fairly flawed. But generally, we see people taking a bigger interest in capital markets and thinking about what it means for them in their lives. And I think that's a good thing on the net. Now, there's obviously some work that needs to be done around education, but overall, I think this trend is going to continue across all asset classes, not just crypto.
And when you have the likes of Elon Musk and others with 45 million Twitter followers joining the conversation, that certainly lends it to a broader sort of narrative around crypto. We'll leave the conversation there, Meltem. Good to have you on.
Thanks for having me, Seema. Have a good one.
You too. Ty.
All right, still ahead, Super Bowl Sunday is coming, if you hadn't heard, and we're going to talk to the sports investor George Pine about what's at stake and what makes this year's game so different. And it's not just that it's in Tampa with the Tampa Bay Bucks. Plus, it's been a wild ride, of course, for GameStop. Why do I keep saying that? GameStop investors, a flood of retail traders coming into the market here in 2021. It could make for an even wilder tax season. That's next on Power Lunch.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC. Seth is all new with David Duchovny, Elizabeth Olsen. Plus, Seth says,
hey,
it's Groundhog Day, and Punxsutawney Phil found his shadow.
Which in COVID times means 6 more weeks of February.
News Seth, this weekend.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number 2. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
Well, despite the sell-off, some buyers are still betting on GameStop. The stock soaring as much as 60% today. A host of new retail investors flooding the market following that Reddit rally. But these new traders are in for a big surprise, potentially. Taxes. Robert Frank has more. Hi, Robert.
Hey, Tyler. Well, accountants and tax preparers also getting flooded with business from all those new stock traders. They're just getting their 2020 tax bills. Now, here are the most common and costly surprises. There are really just three of them. First, many are learning that the gains held on stock less than a year are taxed at ordinary income rates, so as high as 37% rather than the cap gains tax, which tops out at 20%. Also, lots of mistakes around wash trades. That's where you sell a stock at a loss, buy it back to get the tax loss. The rule says, of course, you got to wait a month before the buyback, but many of these folks sold too early, and now they're not able to use that tax loss. And finally, lots of traders using multiple brokers, and unless you combine all those 1099 statements, let's say they bought one stock at Robinhood, sold another on Schwab, their actual tax bill is going to be a lot higher when you net all of that together. Now, one important piece of advice here for all those traders, maybe in GameStop or others who lost money, and this could save you a lot. Between now and April 15th, please elect mark-to-market for your 2021 returns. If you don't, your capital losses that you can deduct against your other taxes for this year is capped at only $3,000. If you elect mark-to-market, you can use the entire loss against any gains this year, Tyler. So look, GameStop is up today, but anyone who's lost money in this first month of trading, if they elect mark-to-market, can use that entire loss in 2021 if they do that. So that's could save you a lot of money on your taxes.
The entire loss, let's say you lost $60,000 instead of $3,000. If you use the mark-to-market accounting, you can write off the entire $60,000 against other capital gains or against regular income.
That's right, and you can do that against either in the same year, and that's what's great about it. If you don't do this, you can still use that loss. You just have to carry it out over 20 years or however it takes to get there, $3,000 a year. This way you can write off that entire loss against your income or against capital gains in 1 year. Now, you have to have tax trading status, which is a sort of separate thing you've got to do, a bit of a bureaucracy. But again, given the savings here, if you have a big loss in January, that could save you a lot of money. You got to do it by April 15th, so.
By April 15th. Well, boy, I've been there on that $3,000 loss rule, and it pains me every time I have it. And it's happened quite a few times.
Yeah.
Robert, thank you very much. Seema, over to you.
Sal.
All right, ahead on Power Lunch, streaming Sunday. Super Bowl Sunday is upon us, but how much will the pandemic and cord cutting change the way people watch? Plus, a grim sign for the economic recovery, the job support coming in lower than Wall Street had hoped. We will hear from the former New Orleans mayor. All of this when Power Lunch returns.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
You are up to date, Ty. I will send.
Sue, countdown, speaking of the Super Bowl, it is on until Bowl 55 between the reigning champs, the Kansas City Chiefs, and the newcomers, the Tampa Bay Buccaneers. But there's an old comer in there, as everybody knows, Tom Brady. Sunday's game is going to look a little bit different this year. Fewer fans, socially distanced pods, and many people will stream it, according to a jump in cord cutting. Here to weigh in on that is the sports betting, and sports betting and more is George Pine, the founder and CEO of Bruin Sports Capital. George, it's nice to have you back. Let's talk about streaming. If I want to stream the game, and apparently about 3 million people did at the last bowl, don't I still have to have a subscription to some streaming service or app, whether it's Hulu or YouTube TV or one of the others, to be able to stream it? And they will have had to acquire either the rights or the rights to a CBS station which is carrying it.
That's correct. Of course, that's if you're watching it in the United States. Outside the United States, you can watch it on a product called Game Pass that we actually operate in 181 countries. But, last year, 3.5 million people tuned in by streaming, and I expect that number to jump a great deal this year.
And this is directly tied to the number of people who have cut the traditional cable or satellite cord, right? And they've substituted. They still got Wi-Fi from some provider, and they sign up, as I did recently on vacation, for YouTube TV that has a somewhat limited number of channels, but it's got a lot. I mean, I could watch all the games and in some cases more.
And you can watch it in all kinds of different locations. So it's actually a very good product. I mean, you can watch it in your car. You can watch it outside the home. You can watch it in all kinds of devices. So in a lot of ways, it brings the game closer to you, where you're at.
So take me inside the numbers there. What would, say, a Hulu have to pay to get access to the game? Are they paying the NFL a rights fee, or are they paying CBS a rights fee to be able to carry the CBS feed?
CBS is would be the group, because they paid an enormous fee to broadcast the game, and that's a way for them to retrieve their investment. So CBS is the broadcaster, and you have to go through CBS. But, it's a good experimentation for the NFL. And, the way media is being consumed is changing.
George, I'm wondering how you think the dynamics of this game, this high-stakes showdown between the legendary Tom Brady and who's expected to be the next greatest of all time, Patrick Mahomes, how that could generate more interest this time around. Here's a great example. Myself, I'm not the biggest football fan, but even I will be there on Sunday watching this great rivalry to see who's going to win.
So, a lot of things in sports about matchups, and you can't have a better matchup than the greatest of all time and maybe the next greatest of all time. And you saw that with the championship game TV ratings. The Bucs game was up 5%. The Chiefs game was up 2%. In a trend, the NFL was off 7% for the season. So those championship games rated quite well. And to be fair, because of the pandemic, because of the political climate, ratings in general have been softer in sports, not different than 2016. So those championship games, they're an indicator that there's probably going to be a good number of people watching on Sunday. The last 3 years, it's been around 100 million. There was a stretch there for 10 years, was about 110 to 115. This game could be 100 to 105 million, which to me would be a really strong number.
Yeah, it would. It might justify a new contract for Jim Nantz. By the way, I think this is a matchup of perhaps the most talented quarterback we've ever seen in Mahomes against the most competitive quarterback we've ever seen in Brady. He is one fiery competitor. Let's turn to gambling, if we might. Is the gambling take this year? Let's call it the take. The total revenues. Is it going to be up or down? Because there's nobody running office pools that I know of.
Yeah, it'd probably be up. It'd probably be flat, maybe down a little. But the big difference this year versus other years is there's 20 states that have legalized gambling. So the winner on Sunday is going to be the states that are going to be generating revenue, where in the past that wasn't the case. And God knows we all need revenue in the state government. So actually, it's probably a good thing for state governments. It's probably flat overall.
All right, George, thanks very much. And I know you got a stake in the game. You're friends with the president of the Chiefs, so you're rooting for them. Have a good weekend, sir.
Go Chiefs. Thank you.
And Ty, same to you, I
Seema.
hear. You're also in favor of the Chiefs this Sunday.
Well, I think they've probably got an edge. Their offense is as good as any I've ever seen. Bruce Arians, a terrific coach. These are two very, very good coaches going head-to-head here. It'll be interesting. It'll be fun. It's going to be a blast.
Andy Reid seems to be such a favorite. And the fact that Mahomes and Kansas have actually beat Tampa Bay, right? The last time they squared off, Kansas came ahead. So we'll see what happens.
For someone who says they don't follow football very much,
all right,
you're really good. I mean, listen, I didn't know that. I take your word for it.
Disclosure,
You're
I have a
the fan
partner
here.
who is from Kansas, so I therefore have much more knowledge on Kansas than I did a year ago. Tyler, thank you. Coming up in Power Movers, bikes and body slams, we will explain. Plus, we'll tell you the best way to play travel stocks as that industry hopes to start to get back to normal. Stick with us.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say post-September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
now for today's Power Movers. And we are going to start with Peloton. The stock down despite beating on earnings and revenue. The reason? Increased costs to cut down delivery times. WWE, World Wrestling Entertainment, falling today. Revenues were down 28% in the fourth quarter as the pandemic made holding live events impossible. Shares down 10%. And we end with Magnite, an advertising technology company. It is paying $1.2 billion for a company called SpotX. Investors loving the deal, sending the stock up 22% despite that $1 billion-plus price tag. All right, it is time for Trading Nation, and let's talk about travel. The U.S. is weighing the possibility of a vaccine passport where passengers will have to disclose whether they have been vaccinated. This, as the TSA says it will now issue fines to travelers that fail to wear a mask while in transit. Will these new requirements help or hurt the travel industry? We have a handful of travel earnings next week, Expedia, MGM. So let's bring in the traders, Craig Johnson of Piper Sandler and Daniel Shea of Simpler Trade. And Daniel, it's curious. What I found interesting is that if you had to square up hotels versus Airbnb, you'd actually put your money with Airbnb. Tell us why.
I would actually put my money with Airbnb because, I'm an active options trader, and I know that the fundamentals don't make a lot of sense here, but I like the chart pattern. It's continued to trade in a pattern of higher highs and higher lows. You have some consolidation on those lower time frame charts. Personally, for me, I'm looking for that consolidation to break out and trade up into the $220 price point. So for me, that looks perfect to sell some bullish put credit spreads and then also do a bullish fly and center the strike of the fly around $220. So, I think that right now people are using Airbnb a lot more than hotels and also a lot more than airplanes as well. So you do have a little bit of macro backing, but I think the technical setup here looks great for an options trade.
And Craig, one of Airbnb's biggest competitors is Expedia. It has Vrbo, the vacation rental platform, and that company is set to report earnings next week. What do you make of the chart?
So, Seema, if we check in on the chart of Expedia in here, the chart still looks very good. You're still making a nice series of higher highs. You're back above your 50. You're back above your 200-day moving average. And it looks like to us that this stock still has, more room to run. If we look at it from an options perspective, too, it looks like you got maybe about 8% kind of plus or minus coming into the print coming up to this. And if I look back through history, you can see that in terms of top and bottom line beats, they've obviously excelled very well there. So that's one name to us that looks very good. And then, Seema, I'd also just point out, look at the chart of MGM. Here's an example of a reopening trade, people getting out, wanting to experience the world again, heading back to Vegas. You look at that particular chart, it's just now starting to break out to new highs. And it looks like to us that this stock seems very strong heading into the earnings print. And again, they've been another company that's done very well heading into earnings prints.
And MGM shares up 20% just this week. Craig and Danielle, thanks. And be sure to head over to tradingnation.cnbc.com, where we trade some of the stocks that are trading in record high territory at this hour. Ty, over to you.
All right, thanks, Seema. The economy adding 49,000 jobs in January. Today, President Biden calling that recovery too slow and pushing for more stimulus.
I know some in Congress think we've already done enough to deal with the crisis in the country. Others think that things are getting better and we can afford to sit back and either do little or do nothing at all. That's not what I see. I see enormous pain in this country.
Up next, much more on jobs and the economy when Power Lunch returns after this.
And now, the
Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone. Without the resilience of a food system, there is no human species. It's as simple as that.
When you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
As far as the Bank of England is concerned,
The outlook seemed to be relatively optimistic versus what people were expecting to hear.
You should see the strong growth we have and the fact that it's stronger than the forecast we had in November later this year really as a function of the lower starting point. In levels terms, we're not any more optimistic than we were 3 months ago, but I think the vaccination rollout gives us a little more confidence.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared island would look like into the future.
Ireland's Prime Minister, the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Congress debating the Biden administration's $1.9 trillion economic relief plan as the January employment report released this morning. 49,000 jobs added in January after a sharp decline in December. So that's the good news. Unemployment rate down to 6.3%. But what are those numbers not telling us? 49,000 gains is good, but not very great. Mark Morial is the CEO of the National Urban League and the former mayor of New Orleans. Mayor Morial, welcome. Good to have you with us. Behind those numbers are some somewhat disturbing facts. Number one is that we're really not even close to being back to where we were a year ago. Women, in particular, seem to be suffering. Unemployment rates, as has been the case so often historically, are higher for blacks and Hispanics.
So, Ty, thanks for having me. And I would point out that the labor force participation rate is down, and that accounts for much of the decline in the unemployment rate. And in addition to that, women seem to be leaving the workforce in record numbers, some 300,000 in the last month, and that again has affected the unemployment rate. So the unemployment rate may not tell the whole story of where we are economically in the nation, with people losing hope and losing faith, particularly when they've been in the hospitality and leisure businesses.
You know, I read a very interesting article earlier today by Neil Irwin in the New York Times, in which he pointed out that there really are two ways that economic pullbacks affect people. One is it's a narrow focus on people in particular industries like hospitality, travel, performance arenas, and so forth. And the other is the broader economy. For much of last year, it seemed like the non sort of pandemic-tied industries came back reasonably well. But right now, we're even seeing job losses in durable goods. We're seeing job losses in the warehousing sector. So my question, I think, is, where should stimulus be targeted? Should it be targeted at those industries that have suffered the most, namely hospitality, restaurants, travel and leisure and so forth? Or should it be much broader than that? And how do you target it so that you put some recognition into the equation that the wealthiest among us probably don't need the help?
So the economy is highly interdependent. And one industry affects another industry because one industry may be a supplier for another industry. So we've got to keep that in mind, the interdependence. I think the other thing is that Congress passed significant stimulus bills last year. And that stimulus and that PPP sort of pumped up the economy. And then in the fall, it began to run out. And the pandemic has not yet dissipated so that the economy can come back to normal. The fastest way to, if you will, stimulate the economy is to put money in the hands of consumers. And those consumers will spend that money on necessities. They'll spend it on the things that they need. And consumer spending is 2/3 of the economy. So that, to me, is the important element of a stimulus, which is why checks in people's hands, enhanced unemployment, in addition to continued support for small businesses, I think is a foundation of a strong and effective relief or stimulus plan.
You know, we look at inequality of wealth, inequality of income in this country, and I think you'd probably agree that the Federal Reserve has pumped a tremendous amount of money into the economy through quantitative easing, the buying of fixed income securities, and that has buoyed the markets. But the people who are in the markets, you know, the top 10% control something like 90% of the market wealth. That doesn't really help people in the lower 50%.
Ty, once again, we see that the reality of Wall Street is not the reality of Main Street America. And so it's always been deceptive to look at the performance of Wall Street and the performance of markets as a broad gauge of economic health and prosperity. As I was told many times, you've got to put the jam on the lower shelf. And in this instance, that means enhanced unemployment. It means enhanced SNAP or food stamps. It means checks in people's hands who are working men and women so that they can pay their rents, so that they can take care of their children, so that they can pay their mortgages. Consider this. If people cannot pay their mortgages, what will be the impact on financial services companies and mortgage companies that hold mortgages? There's a rippling effect. Once again, we see the interdependence of the economy. The way to do stimulus is to get the jam on the lower shelf so that people can survive, spend and invest in necessities, and that's the best way to get us through this pandemic, or one of the important elements of getting us through this pandemic and through this economic downturn.
All right. Got to leave it there. Mayor Morial, always good to see you. We'll see you next time.
Okay.
All right. Everybody's coming out for the Chiefs today, Seema.
Seriously, it's red in Kansas right now. All right, thank you, Tyler. Check out this chart summing up this week's trading action. The S&P 500 up nearly 5%. That's a big move for the markets in just a week, but compare that to GameStop's 80% drop. Power Lunch. We'll be right back.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
That would cause the high margin trades, the street shops really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
All right, welcome back, everybody. Let's wrap up the week here. It's been one of the best weeks since I think it was early November for stocks broadly, Seema. Right now, the Russell 2000 up more than 1% as the Dow, the S&P 500 and NASDAQ post somewhat more moderate gains there. There is progress, it would seem, on Capitol Hill for a more robust rather than a less robust stimulus package. And it does look like some of the vaccination efforts across the country, while they are spotty, are beginning to pick up some steam.
Yeah, that momentum certainly seems to be working. And you look at GameStop, that saga continues. Once Robinhood lifted those restrictions, you saw the stock move higher. It's up about 14%. There were 2 trading halts earlier today. But of course, the 1-week chart, that really tells you the story, down 82%. And the story doesn't seem to be over, Ty.
Yeah, it's as we talked about it earlier, this was a kind of a crowdsourced short squeeze there, and we'll see what the ultimate damage or wealth creation is. So that'll be it for Power Lunch for a week. Thanks for watching. Great to be with you, Seema. And Closing Bell is up now.
Thank you, Tyler and Seema, and welcome everyone to Closing Bell. I'm Sarah Eisen here with Wilfred Frost. Stocks in the green again. What a rally we've seen this week. Stocks up every single day, on track for their best week since November. Let's look at what's driving the action. 1 hour left of trade. An underwhelming jobs report this morning. The Labor Department showing the picture still looks weak. Democrats moving forward in Congress with a large stimulus bill. COVID numbers and vaccines still moving in the right direction. And corporate earnings, once again, a bullish driver from Snap to Activision to Estee Lauder. GameStop is higher. VIX is back down near 20. S&P, NASDAQ, and Russell all set for record closes. Again, we saw it yesterday. 59 minutes left in the trading week. Wilfred.
A week where we stand 4.6% higher on the S&P. Coming up on today's show, Senator Mark Warner upping the ante in the debate over big tech regulation, proposing big changes to the Section 230 liability rules. He will join us to break it down in just a few moments. Plus, some hopeful news on the coronavirus front as daily cases continue to fall, and Johnson & Johnson applies for emergency authorization for its vaccine. Dr. Scott Gottlieb will join us with what all of these developments mean. And check out shares of Columbia Sportswear getting a big pop today on the back of earnings. The CEO will join us to talk about their results, the supply chain, and the state of retail, up 17%. Let's get straight to the markets, though. First of all, as stocks look to close out a very strong week on a high note, up 0.3% today, 4.6% for the week. Mike, over to you.
Yeah, Wilf, you have to be fairly impressed with this activity here. 3% loss last week, popped right back up. It just acted as a little bit of a shakeout or a gut check. Seems like a sweet spot for the markets, feeding off of that 2020 stay-at-home, powerful tech earnings stream, as well as anticipation of an acceleration in the economy. So a lot's working here. This is a 2-year chart. We're right back on that track. In fact, bobbing right up against the upper end of this path right here. That's something to note, because every time you've gotten up there, it tends to eventually slow down, even if it sort of hugs that line for a while. Also, though, early 2020, I was remarking on that. We did get that late January, early February dip, surged to new highs, then, of course, fell apart later in February because, obviously, of COVID. Take a look at a handful of growth stocks that were great performers, especially in the first half, 2/3 of last year, let's say. I wanted to document DocuSign, Square, as well as Shopify, because they are these elite up-and-coming growth stocks that have been really just consolidating for months. And I think you would look at that and say, that's actually pretty bullish. They have not lost most of their gains that they had built up over this period. They've well outperformed the NASDAQ 100. And, you know, arguably are looking like they're poised maybe for another leg up. So even as everyone's excited about the cyclical trade, these things have hung in there. So the market has multiple ways to win. However, are we getting stretched in terms of stocks, outperformance of bonds? Look at what this looks like, a 5-year chart of the S&P 500 against the Vanguard long-term bond index. It's corporates and treasuries. Obviously, yields going up is bullish, but that looks pretty steep, looks very similar to that 2018, 2017 line. So it wouldn't be a surprise if maybe we get some slippage in this relationship before too long, guys.
Wanted to take a moment, Mike, with you on the jobs report, which was pretty disappointing today. Half the jobs added than expected. The gains were really only concentrated in government jobs and temporary help. I mean, it shows a real picture of weakness still. We've only gained back a little more than half of the jobs we lost since February, and the market just continues to look past it. For how much longer can investors do that?
You know, look, it was a January number. I think you can look inside the data and say there's some signs of scarring in terms of how many permanent layoffs. That's actually ticked higher. That's not good news. So it supports the idea that we would probably need or want another push of fiscal support. On the other hand, 6.3% unemployment rate. It was not strictly because people stopped looking for work. And if we could dial back to last April, people thought we'd be at maybe 9-8% at the end of 2020. So I think that you can play it both ways. But yes, the stakes were not that high because everyone is fixated on what the spring is going to look like in terms of an economic pickup as opposed to how January was. So for now, I think we're still giving it a pass for the moment.
Mike, thanks so much for that. Meantime, check out this major turn higher for Snap. The stock rallying today following yesterday's earnings beat. It initially fell on those results, and then CEO Evan Spiegel was on Squawk Alley earlier today talking about the rollout of Spotlight, a feature that's been seen as a TikTok competitor.
We've only launched Spotlight into a couple select markets at this point, and as you point out, it's gotten great traction with 100 million people using it in January. But we've been able to slowly roll that out to manage the growth, obviously, in content volumes and our moderation practices. But we're using a combination, obviously, of machine learning and humans, making sure that there's human review of any content that's getting wide distribution. And so far, knock on wood, that strategy is working. And we'll continue to roll out to new markets as soon as we can support it.
Joining us now, Needham senior analyst Laura Martin, who has a hold rating on Snap. Laura, just what drove this intraday turnaround, massive intraday turnaround?
Yeah, so I think they really grew revenue very strongly in the fourth quarter, up 62%, and they grew EPS up 55%. Their year-over-year subscriber ads were very strong at 22%, but their ARPU, so the average revenue for each of those, went up 50% faster. It rose 33%. So I think very strong fundamental earnings momentum coming out of 4Q. The stock originally was down yesterday because Evan said that they'd had a couple weak advertising weeks in January, and he was worried about IDFA, which is an Apple privacy setting that comes into effect later in the quarter. But I think that kind of negativity affects so many stocks that aren't being hurt by this, which is why you've seen Snap turn and rally later today.
And Laura, we're going to be talking to Senator Mark Warner about Section 230 in just a few minutes' time. Are Snap as exposed to potential more regulation in that area or others as the likes of Facebook, or not?
Definitely not, because Snap only, you have to actually by hand add one person at a time. So it's very much your best friends, which is why they only have 260 million users every single day versus Facebook's at 2.2 billion. And so that's all about only your close friends. So basically the privacy settings are perfect for the regulators on Snap.
Well, Laura, I wanted to ask you about some of your very hot stock picks that you've had over the last few months. Fubo TV, Trade Desk, I mean, those have been really, really strong calls. Stocks have gone straight up. Magnite was the one you gave us last time. Are all of these swept up, do you think, in the retail trading frenzy and the unusual activity we've seen?
Well, let's talk about Trade Desk, Magnite, and Fubo, which were the ones we were talking about last time I was here. Little volatility in those, but they're up nicely since the last time I was on, as promised. And I would say the streaming and connected TV growth very strong coming out of the fourth quarter. And I think next year is going to be probably 40% growth in connected TV as linear TV advertisers are looking to follow the audience to streaming, because the streaming audience almost doubled during COVID. So now advertisers are really looking to reach those people in those hours of viewing. And so I think all these connected TV, so Fubo and Trade Desk and Magnite all participate in connected TV advertising growth.
Let's get on to Peloton as well, who have obviously reported last night. Clearly, there's a lot of delivery delays. Some of that's on them, some of it's not. Do you think they've learned from those errors, if they were errors in the first place?
Yeah, I mean, I think that's the best point. I mean, they're disrupting an entire industry, and they've never run a public company before. And I think they made a mistake, which is at a time when they couldn't meet bike demand, they introduced a second bike. Created chaos, created long service times, and elongated their deliveries. So having learned from that now, they're supposed to be, they announced 2 months ago they were going to introduce a lower price tread. So it looked like they were going to make the same mistake again, but no. They used the UK as their test market demand is through the roof. So now they're not going to launch the U.S. as fast. They're going to use the U.S. inventory, and they're going to meet demand in Canada and the U.K., which is higher than expected. And they're going to push off the launch in America, which is great because that forces Americans to buy $4,500 treads instead of $2,500 treads. So all good from a shareholder point of view.
We'll just do a lightning round with you, a la Kramer, Laura. We talked about some of your hits that you've had, some big ones lately, but what about the miss on Netflix? Are you still not a buyer, even though we've continued to see momentum and strong earnings as evidenced by the last quarter with that and other FANG stocks?
I am, and I have been really wrong on Netflix, but I'm going to stand my ground because I believe that what happens next in the streaming world is that these big conglomerate, deep library competitors add sports, they add news, and they make the offering not only 55,000 hours of general entertainment library like Netflix has, but they have things like sports or Olympics or the NC2A that drive viewers to their streaming services. And they have deeper pockets because they have sister subsidiaries that can fund losses. And I just don't think Netflix as a standalone entity can compete with those.
Up 3.3% for the week. Laura Martin, always good to check in with you. Thank you.
Thank you.
From Needham. After the break, Senator Mark Warner says the controversial Section 230 rules provide a get-out-of-jail-free card for big tech. He's going to join us next to discuss his brand new bill aimed at reform. You're watching Closing Bell on CNBC. Dow's up another 57 points.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Respond to China's growing global influence. That story's on the website now. Australia's competition watchdog says Google must decide if it wants to pull its services from the country or not. The U.S. tech giant has threatened to leave Australia over a bill requiring it to pay local media and publishers to link to their content. Head online for the full story. And Chinese short video platform Kuaishou has delivered a blockbuster debut, having been over 1,000 times oversubscribed on the retail side. Kuaishou shares almost tripled in value on their first day of trade in Hong Kong. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
Keep up with the crisis. Squawk on the Street on CNBC.
Minutes left of trading. S&P set for another record close. As the latest stimulus proposal makes its way through Congress, the Biden administration is going to have to make some tough choices about its next legislative priority, and it could have a big impact on jobs. Kayla Tausche with the story. Kayla.
Sarah, the administration has just 2 shots this year to use the reconciliation process to pass its agenda with just a simple majority. And Democrats are already paving the path to do that for the American Rescue Plan if they can't get 10 Republican votes. So what is going to be the legislative priority for that next option? Well, despite top Democrats spending much of last year on the campaign trail talking about health care being first up, it appears to be infrastructure. Just look at the number of jobs that would be created here. These are exclusive numbers crunched for us by Moody's Mark Zandi. Healthcare, he says, according to Biden's campaign plan, would create about 2.6 million jobs at about $57,000 apiece. Infrastructure, by comparison, more bang for the government's buck. More than 11 million jobs at a cost of $51,000 apiece. Earlier this week, White House economist Jared Bernstein told me that perhaps improbably, he doesn't think that if they pursue infrastructure, they'd have to exhaust that last chance.
So when we're talking about infrastructure, clean energy, childcare, many of the elements of the Building Back agenda, it is not at all obvious to me that that has to go the route of reconciliation. And if we're talking about infrastructure, it's actually pretty obvious to me that we probably won't.
We will see if that is the case. Bernstein says the infrastructure plan is already in the works. The White House says to expect the recovery portion of the plan to come out sometime this month. Wilf and Sarah.
Kayla, thanks so much for that. And sticking with Washington Democratic senators today announcing the Safe Tech Act to reform Section 230 with the goal of holding social media companies accountable for enabling, quote, cyber-stalking, targeted harassment and discrimination on their platforms. Joining us now in a First on CNBC interview is one of the authors of that bill, Senator Mark Warner. A very good afternoon to you. Thanks for joining us.
Thanks for having me.
So give us the headline on this. What does it aim to achieve, and what does it not quite go as far as doing?
Well, what we wanted to try to draw up was a carefully tailored reform of Section 230 that didn't go at the underlying debate about speech. We've seen these platforms change dramatically since the late 90s when Section 230 was put in place, in many ways as a way to encourage moderation. It's obviously achieved the opposite. We wanted to make sure that things that were foreseeably and repeatedly happening on these platforms that is illegal is pointed out. So let me go very briefly through this. We made very clear that Section 230 protections do not apply to paid advertising. If a company, if Facebook is making money off of fraudulent advertising, that should not receive the Section 230 protections. We want to make clear that Section 230 did not preclude injunctive relief. If you have been harassed so often from one of these platforms and you're able to get injunctive relief, Section 230 should not preclude it the way it did in the so-called famous Grindr case. We wanted to make sure that civil rights laws applied and that Section 230 did not prevent that. And we wanted to make sure that the Alien Tort Act, so that if someone in Rohingya could show cause under the Alien Tort Act, for example, that Section 230 would not protect. The fact that we've got now such broad-based civil rights support for this tailored reform, I think is a good sign. What it does not do, it does not basically say, let's get rid of Section 230 entirely and call all of these platforms broadcasters the way CNBC is.
So Senator Warner, I'm most fascinated, it's all very interesting, most fascinated in the first part of what you just outlined. So does this now mean that a social media company would be classified essentially as a publisher when it comes to a post that they are outright being paid to push more aggressively?
We're saying that an individual's post, you can still say stupid things under the First Amendment right, but we're saying that stupid thing protection does not apply to paid advertising. So yes, if that paid advertising violates a civil rights law or is otherwise blatant disinformation, that Section 230 protections do not apply to that paid advertising. Just as we say that also if someone on an individual basis is the subject of so much harassment that you could go out and get injunctive relief, that injunctive relief should not be prohibited by Section 230. Section 230 has basically become a get-out-of-jail-free card for these platforms. That was not its original intent, and we think it's time to reverse that.
And just to clarify one step further, Senator Warner, that applies, therefore, if Facebook, for example, were being paid directly to promote a post. However, it doesn't apply if I make a stupid comment on my Facebook page and Facebook is showing commercials in and around alongside that, like many websites do on every single day posts.
Absolutely. This is where we were trying to not get into the speech, First Amendment speech debate, and there were people who will try to go further. We were trying to work particularly with the civil rights community, because the civil rights community 2 to 3 years ago was very reluctant to reform Section 230. They've now seen the level, for example, of abuse that takes place on some of these sites that advances, for example, racist, white supremacist views. If those actions violate civil rights laws, the platform cannot use Section 230 as a protection. So we've gone one on advertising, we've gone one on the civil rights approach, we've gone one on the injunctive relief. So there are a variety of prongs on this legislation.
Senator Warner, President Biden himself is on the record making his position clear on this, that he wants to see a repeal of Section 230. So this is just a reform. Could it even get his signature? Have you had conversations with the White House about this?
We've had opening conversations with the White House. I think there's a reason why Section 230 has not been reformed, why the platform companies have not had, frankly, any meaningful legislation take place. They are some of the most powerful companies in the world. And while they sometimes say they would be supportive of reform, when it comes to Section 230, which has been, I think, abused, which I think has been carried to an extreme that it was never intended when it was created back in the late 90s, when these were literally arguing they were simply dumb pipes in terms of transmitting information. That's clearly not the case. So there may be others, maybe even President Biden, that wants to go further. We think we've hit a sweet spot where we can gain the support of civil rights activists, gain support of people who've been thoughtful on this issue, recognize that certain areas like paid advertising should not have the same level of protection as an individual's posting on a Facebook site. We think we've hit that middle, but we're willing to, part of the sausage-making process now starts.
Well, the other question is, can you gain Republican support? Because, as I understand it, it would have to be bipartisan, and it sounds like the Democrats and Republicans agree that something needs to be done, but it sounds like not at all. Do you guys agree on what needs to be done? And conservatives and Republicans have very different problems with social media, like limiting speech. I think they want it to go the other way. This doesn't meet the rules for reconciliation, so you're going to need bipartisan support. How likely is that?
This is only going to happen if it's bipartisan. And we think, I've started conversations with some of my Republican friends, we think the fact that it is narrowly drawn, that we are taking on actions that we've seen repeated, that are foreseeable, that in many contexts within existing law already are illegal. But I think Section 230's protections have crept in inappropriately. I think we will have strong bipartisan support on this. And, there are some on the Republican side who think the platforms are biased, against conservatives. The truth is, the platforms are biased towards getting more eyeballs, and more eyeballs usually mean to promote extremist propaganda, extremist posts on either end of the political streams. So I don't think they have a bias one way or the other. Their bias is on making money, and that oftentimes can lead to the kind of extremist propaganda that has created the QAnon and in many ways led to some of the activities that culminated on January 6th.
I mean, it sounds like what you're doing here is targeting Facebook, where a lot of this goes on. But Senator Warner, that the debate is going to move on to other small platforms and small businesses. And like all regulation here, the question is going to be, is this just going to, Facebook can navigate the big, complex regulatory burden. What happens to the smaller companies if a bill like yours goes through?
Well, again, this is not targeted at Facebook. We've looked through challenges around YouTube. We've looked at obviously Twitter. There are I think some of the concerns on some of these new platforms like Parler. We did not put a carve out for startup platforms, but that would be probably part of the negotiation, the discussions going on. What we've done is we took a long time, thinking through this so that we wouldn't run afoul of traditional First Amendment concerns. We think we've, again, threaded the needle on activities that I think we can find that kind of bipartisan support. Advertising shouldn't have the same level of protection as individual posts. Trying to make sure that if you can obtain injunctive relief because you are harassed or cyberbullied so much should not be prevented by Section 230. Making sure that if you are violating civil rights laws, Section 230 should not be as an excuse to allow those violations. I think we can find some common ground around those core principles.
Senator, final question. Just wanted to pivot to the topic of stimulus. I'm sure you've been following and seeing the craziness in markets we've seen of late, and I wondered what your view was as to whether stimulus checks should be used, as it seems they have been in some circles, to buy stocks and go into the stock market, or is the stimulus checks aimed at the people that really need to spend it today to get by, as opposed to people who maybe have the capability to save and invest it for the long term?
Well, first of all, I think if you look at the data recently, the spike in online retail purchasing, particularly around clothing, the spike in day trading, and the spike in sports betting as the stimulus checks come out is a pretty interesting correlation. One of the reasons why I've been a big advocate that we ought to narrow these stimulus checks really to those most in need, and that the notion that a family of 4 or 5 making upwards of $250,000 to $300,000 would still be getting checks, even though they may not have suffered any economic loss, doesn't make sense to me. I would rather take some of those dollars, for example, and redirect them towards broadband so that we can get that kind of 97% penetration in America that I think is possible if we make a significant broadband investment. And I've been encouraging the White House to move up that broadband investment because it is directly tied to COVID, because we've seen the necessity of having broadband play out during COVID. It will also have a long-term stimulative effect, and let's go ahead and get it in this bill, because there are areas either around checks or even in the state and local government area where perhaps the investments with broadband could be better spent.
Senator Warner, thanks for joining us.
Thank you, guys.
We've got 34 minutes left of the session. We are higher by about 0.4% on the S&P, 4.6% now for the week as a whole on the S&P 500. The Russell leads the charge today, up over 1%. Up next, everything about this year's Super Bowl will look different due to the pandemic, including betting on the big game. We'll look at the wager winners and losers next. As we head to break, here's a look at the top tickers today, searched for on CNBC.com. Yet again, GameStop up there, top of the list, Apple, AMC, the 10-year, and Ford. Gosh, seeing the 10-year search for as much as GameStop, a sign of the polarizing times. We're back in a couple minutes.
Daybreak in the U.S.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Pre-COVID time, our biggest tourists came from India. That was our number one. I mean, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? I mean, we are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
Is business. Stocks are telling us that the economy is going to come back and resurrect itself relatively more quickly than some of the economic numbers say. Making sense of the disconnect is what we're trying to do every day for our viewers. The way we socialize, the way we travel, it's all going to be changed for many, many years. This is seismic, it is historic, it is the story of our lifetime.
pandemic changing just about every aspect of this year's Super Bowl, including how people bet on the big game. Contessa Brewer joins us with the latest. Contessa.
Well, take a look at this here, Will. Parking lot outside is full. Inside, the FanDuel Sportsbook feels a little different in this era of social distancing. More than 23 million Americans plan to bet a total of about $4.3 billion on the matchup between the Chiefs and the Bucks. According to the American Gaming Association, that's down 37% from last year, even though sports betting is now legal in 7 states more than last year. Now, you can blame the pandemic. Fewer office pools, for instance, and all those boxes being passed around. The capacity restrictions at sports books comes into play here. But online and mobile bets on the game are up 63%, in part because more states now allow it. FanDuel tells us the action is lopsided for the Chiefs as 3-point favorites. Vegas has its money on Mahomes for MVP and for those prop bets. Orange Gatorade, guys, is the clear favorite, or actually it's the orange favorite. At this New Jersey sportsbook, they're on pace to beat last year's betting handle. That's the news from New Jersey out of the sportsbook. Sarah?
Very, very cool that you got an inside peek. Contessa Brewer. Contessa, thank you. Time now for a CNBC News update with Sue Herrera. Hi, Sue.
Hello, Sarah. Hello, everybody. Here's what's happening at this hour. Bail has been set at $3 million for Adam Coy, the Ohio police officer charged with the murder of Andre Hill, a black man who was unarmed and standing in his own garage. A ruling by the International Criminal Court appears to clear the way for it to begin a war crimes probe into actions by the Israeli military and Israel's construction of settlements in the occupied territories. Israel has said the court has no jurisdiction. Nearly 2 out of 3 Republicans say Joe Biden was not legitimately elected president. That's according to a poll by the Associated Press. Overall, roughly 2/3 of those questioned say Biden won the election. Actor Christopher Plummer has died, known for roles as varied as Captain Von Trapp in The Sound of Music, to a museum director who becomes openly gay after his wife dies in the movie Beginners. That role earned him an Oscar and, at age 82, made him the oldest actor to win an Academy Award. Christopher Plummer was 91 years old. You are up to date. Sarah, I'll send it back to you.
Sue, thank you. Still to come on the show, medical device company Becton Dickinson reporting very strong quarterly results helped by its COVID diagnostics unit. We'll discuss with the CEO coming up. And later, Dr. Scott Gottlieb will join us to talk about the latest virus trends in the U.S. and just how quickly J&J's vaccine may get approved. But as we head to break, take a look at bonds. Yields mostly higher to end the week. 10-year Treasury note yield 1.16%. There's been a yield steepening. It's helped financials climb. They're on top of the sector performance. Every sector, though, is higher for the week. We'll be right back.
To build a power plant is to light up a civilization. To purify a waterhead is to last a hope. To build a trackway is to facilitate connectivity. To develop an algorithm is to offer one more possibility to the world. Shanghai Electric. Beyond Shanghai. Beyond electric.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
Straight ahead, medical technology company Becton Dickinson reporting a 309% surge in first quarter profit due to high demand for its COVID-19 test. We'll talk to the company's CEO in an exclusive interview. That's next here on Closing Bell.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say over September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
Dow edging higher in this final half hour of trade. Becton Dickinson out with strong earnings this week. Q1 revenue growing nearly 26%. Much of that growth came from sales of its COVID-19 diagnostic products. The company also raised its 2021 fiscal guidance. Despite being lower today, the stock is up 26% from the March lows. Joining us now by phone for more is Becton Dickinson President and CEO Tom Polen. Tom, thanks for joining us. My question is actually on the second half outlook and what you're telling investors. Obviously, the past quarter has been a good time to be selling COVID-19 tests. But what happens when we start getting more vaccines into people's arms for demand for testing?
Sure, Sarah, and thanks for having me this afternoon. As you mentioned, we had very strong performance on revenue and earnings in this first quarter, and it reflects not only strong diagnostic revenue, but I think even more exciting for us is strong performance of the base business, which was up nicely against the backdrop of COVID resurgences around the world. I think to your question in terms of what happens with testing as we think about going forward, what you've seen to date is really a testing happening a lot in kind of the usual locations you may expect: hospitals, urgent care centers, pharmacies. There's pop-up locations, but mostly led by traditional healthcare system providers. What I think will probably be the next big push as we go into the back half of the year, and hopefully as we see the continued rollout of vaccines and hopeful continuation of them being very effective with the virus, is a big push in kind of the return to normal testing in more non-traditional healthcare settings. These could be places like schools, businesses, airports that are helping enable more of a return to a normal way of life.
So my question on that, Tom, is how much do your tests cost for people? Because I too could see, in massive office buildings in Manhattan, for instance, where you have thousands of people entering to either show you have a vaccine or a test. But we talked to Illume, the at-home testing saliva, no prescription test that just got approved. It's $30 a test. So how much are your tests, and how practical does it make using on a larger scale to open things up like buildings and schools?
Yeah, quite a bit less expensive than that test. We've actually been very focused. So we make over 40 billion devices a year as a company, and talk about that later. But we're very good at manufacturing, and we're very good at manufacturing things efficiently. And so as we've been scaling up our production for COVID diagnostic tests, and we've made tens of millions of those already, we've actually just very recently reduced our pricing by about 25% on those tests into the low to mid-teens per test to really do exactly what you mentioned, which is ensure access to the testing, particularly in light of the new variants that are emerging and spreading. Right? We want to be part of helping to stop that with expansion of testing.
As and when demand for testing tails off, do you think that will be adequately made up for by demand for some of your other products? Do you think there'll be a massive catch-up of other sorts of hospital procedures?
So for us, we've been doing a few things. And just as you think about the company, we're perhaps one of the most relevant and broad companies related to the COVID-19 response. So we're involved not only on the diagnostic side, again, making both molecular and rapid point-of-care tests, but 90% of anyone that ends up in an ICU is treated with one of our devices. That could be one of our infusion pumps or a syringe or another part of one of our products used to collect blood, etc. But we're having a role in helping them. And then we have a major role. We're making over 1 billion additional injection devices specifically for the COVID vaccine. And so that will continue to roll out. At the same time, one of the things that we're doing is taking the strong performance that you saw us start off the year with, and we're actually reinvesting a good portion of that into driving incremental innovation. So that's something that we've actually begun. We've created a growth and innovation fund across the company. We've initiated a number of new innovation programs that will help fuel future growth. And people have really been extremely energized because ultimately at the end of the day, for us as a healthcare company, the way that we fulfill our purpose is by bringing new innovations that help more patients. And so we're doubling down on that, even in the middle of the pandemic.
Tom, one final one on testing for me. You mentioned the various mutations that we're all watching and scared of. How are the tests performing against those mutations? Are they as effective, or do they need to change?
Yeah, great question. So for our assay, particularly our point-of-care assay, the rapid 15-minute test, we actually target a different protein than the spike protein. And the spike protein is what's been changing with the new variants primarily. And so we've been evaluating that, and we haven't identified any impact of the variants on our rapid tests at this point.
Tom, thanks so much for joining us.
Thank you, Sarah, and thank you, Wilfred.
When we come back, Ford's CEO weighs in on the quarter and short sellers point to cracks in SPACs. Those stories and many more when we take you inside the market zone next.
The countdown to the close of the US markets is sponsored by IG.
The news is coming so fast right now. The pandemic has brought on a mortgage crisis. People are unable to pay their home loans because they've lost their jobs. Overnight, more than 4 million homeowners were asking for a mortgage bailout. The other story of the pandemic is this surprising housing demand. People want a backyard. They want home fitness. They want high-tech homes where they can homeschool and work from home. The home is the most important thing right now. At CNBC, we cover your financial health. That's what we do best.
As far as the Bank of England is concerned, the outlook seems to be relatively optimistic versus what people were expecting to hear.
You should see the strong growth we have and the fact that it's stronger than the forecasts we had in November later this year really as a function of the lower starting point. In levels terms, we're not any more optimistic than we were 3 months ago, but I think the vaccination rollout gives us a little more confidence.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Seth is all new with David Duchovny, Elizabeth Olsen, plus Seth says,
hey,
it's Groundhog Day, and Punxsutawney Phil found his shadow.
Which in COVID times means 6 more weeks of February.
New Seth, this weekend.
Left in the trading day. We're now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Laffer Tengler Chief Investment Officer Nancy Tengler with us as well. Good afternoon to you, Nancy. Let's get things off with the broader markets. Stocks are rallying again with the major averages on track for their best weekly performance since early November. The S&P, NASDAQ and Russell all on track for record closes as well. Mike, snapshotting the week-to-date performance, what stands out to me is that energy is top, then communication services, then banks, then consumer discretionary. Yeah. It's not really an either-or this week. It's pretty broad and pretty big in terms of the gains.
Right, which completely reflects the position the market is in right now, which is sort of multiple things to draw upon to support itself. We're in this period where, of course, the profits have been overwhelmingly good relative to estimates, and there was a reminder that these big growth and tech companies really had an amazing 2020. At the same time, everyone's willing to bet with bond yields going up and the fiscal stimulus coming again, that in fact we're going to accelerate in the real economy and commodities are flying. So it just seems as if all things are working at the moment. And honestly, the only question is, do we get to one of these short-term overshoots again before very long? It's, a very impressive performance this week for the market, but you wonder how much you can project out from here.
4.6% for the S&P, Nancy, almost 6% higher for the NASDAQ this week. This is looking like a melt up. Are you buying? Are you buying on the way? Are you feeling the bullish enthusiasm?
Well, we're still expecting a correction one of these days. We've been a little bit early on that, but yes, actually we did some buys yesterday. But in a portfolio, what we're doing is we're taking gains in one spot and putting money to work in new spots. So we added Costco recently back in. It was in the portfolio years ago, and then we added it back in recently. But I think the most encouraging thing, Sarah, is that the breadth is pretty impressive. 91% of S&P stocks trading above their 200-day moving average. Very different from the bubble we saw in 99-2000, where it was closer to 30%. And the market multiple was much higher on peak earnings versus trough earnings that we're coming out of now. And the multiple's significantly lower on the S&P, 22% versus 27. So we still find places to buy, and we still find reasons to be bullish for the longer, medium, and long term. But we do think we need a recalibration, a pullback, a correction, whatever you want to call it.
Let's hit Ford. A lot of individual movers. Ford shares are higher after the automaker's profit beat estimates. Phil LeBeau with the details there. Phil.
Sarah, take a look at this chart. This is Ford over the last 3 years. Why are we showing this to you? Because shares of Ford briefly today traded at a 3-year high. And that's because after the company reported better than expected results for the fourth quarter, what really moved the stock after hours and earlier today was what they said about their EV plan. And here's what they said. They are going to be doubling their original investment, which was about $11.5 billion. That means they're going to be spending an additional $15 billion through 2025. That includes building a new electric F-150 plant in Dearborn, Michigan. Here is CEO Jim Farley talking about the future with us earlier today.
We're not going to cede the future to anyone, and our electric strategy is very specific. We're going to invest in segments where we're the dominant player and we have scale, like the F-150, the Transit van, our Mustang.
While Ford shares are up about 75% since Jim Farley took over, compare Ford to General Motors and then compare them to Tesla. You still see that Tesla is the preferred choice for investors right now, at least in terms of what people are thinking for the EV future. By the way, General Motors, it reports Q4 results next week, and expect a big focus during the analyst call will be on their plans for electric vehicles. Guys, back to you.
Phil LeBeau. Phil, thank you. Nancy, the EV plans by the old school automakers like GM and Ford really breathing some new life into these stocks. Are you a buyer?
Well, we've missed it, Sarah. We tend not to be owners of that the auto space just because of the cyclicality and their lack of loyalty to the dividend. But I bought a Ford F-150 and I'll trade it up for a electric version as soon as it's available. We do own a lot of the chip stocks instead that are feeding into the space. But it's been a great trade. As you know, we owned Tesla, sold it way early, and so we're on the sidelines in the auto space.
Mike, is it a zero-sum game here when you look at the traditional autos starting to get a benefit because of their EV plays and Tesla? Will Tesla have to start to pull back, or can they all benefit and just see massive multiple expansion, maybe not to the extent of Tesla's, but somewhere in between?
Yeah, I think at this point, the way the market is treating it is that Ford and GM are simply getting ahead of the potential market share loss they might otherwise have in internal combustion engines. So in other words, they're going to cannibalize themselves. They're going to basically disrupt themselves as opposed to having to go after whatever, is ahead of Tesla. But also consider the market cap breakdowns. Tesla's at $800 billion. Ford is around $50 billion market cap. Yesterday, Apple went up $50 billion in market value on news of perhaps an Apple car, went up an entire Ford. So it just seems as if these traditional automakers have unchallenging valuations, especially at a time when people are still buying in decent numbers, the existing run of models.
Astonishing figures there. A pair of Chamath Palihapitiya's SPACs are coming under scrutiny. Leslie Picker's got the details of that for us. Hey, Leslie.
Hey, Wilf, that's right. And we actually hadn't heard from Palihapitiya since that report from Hindenburg Research targeting Clover Health was first disclosed yesterday morning, but now Palihapitiya actually tweeting his response to it. He says that yesterday's report was rife with personal attacks, thin facts, and bluster that has been rebuked by the company. He goes on to say that while I may have my own views on short sellers, I do believe they should remain part of the capital markets and recognize the perspective that in some cases they can identify real anomalies. That is not the case here. He goes on to say he'll let Clover's long-term goals and performance speak for themselves going forward, but certainly the latest bit of news here in what's been just dueling arguments on both sides of the aisle. On one hand, you've got this Hindenburg Research, which yesterday put out a report calling Clover a broken business facing an active undisclosed DOJ investigation, and the research itself questioned Palihapitiya's due diligence in that report. Now, Clover responded this morning by saying that the DOJ made a request for information from the company, from the DOJ, but that its counsel did not deem that to be material and therefore not in need of disclosing. Now, Clover declined 12% yesterday, trading lower today, although now it's up 4% potentially on that recent tweet by Palihapitiya. That's Also the case today with Open Door, which was taken public by a different Palahapitiya SPAC. Open Door announcing an upsized follow-on stock offering, and a Wall Street Journal column this morning questioned some of its accounting practices, guys.
And so, Leslie, what was the reaction over the last day and a half before we got the tweet that we just saw from Chamath? Were people siding with him already on these forums, or were they starting to doubt perhaps his credibility for the first time in a meaningful way?
People are very big fans of Palahapitiya on the Reddit forums. You know, in terms of Clover in particular, I haven't seen as much dialogue on this particular stock in the forums in recent days. But there is definitely a fan base for Chamath among the Reddit people who comment on the Wall Street bets.
Leslie, thank you. Mike, I wonder if all this talk and criticism and spotlight on due diligence puts a little bit of a dent in the SPAC mania. I don't want to call it a bubble, but if it is that, starts to poke holes in it.
You know, you have 350 of these that have come out in the last year. Tremendous number of companies that are just a pool of cash looking for a deal. And the way these deals get consummated and brought out to the world is basically completely from the company's point of view. There's an investor deck that gets put out there. It's not the same as going on a roadshow for an IPO with your filing and all the restrictions involved thereby. And so I do think that there's a after-the-fact scrutiny that has to happen or is happening to some of these companies. Just see if there's, you know, you were promised more than there really is when the deal was done.
Let's hit Canopy Growth. Shares are under pressure today after being downgraded by Piper Sandler. Frank Holland with the details. Frank.
Hey there, Sarah. Canopy down about 2.5% right now. Following that downgrade from Piper, the company's saying the fundamentals just do not support current valuations. Piper will go on to add, Canopy entering the U.S. market is already priced into that stock, and then based on their forecast, U.S. legalization could be 2 to 4 years away. Certainly a departure from the current investor sentiment. Cannabis stocks, they really had a big rally in 2021 on a lot of exuberance that legalization will actually happen soon. The Amplified Cannabis ETF up 68% year to date. U.S. legal sales are forecast to increase 40% year over year this year to $21 billion. Back over to you.
Thanks so much for that one. We've got 2 minutes left of the trading day, and we are nicely higher for the session and the week. Mike, been looking at the internals, as always, for us.
Yeah, they've been in tune with the higher market, moderately positive in terms of up versus down stocks in the New York Stock Exchange. This is, you know, about 2 to 1, so not overwhelming, but it's been each day very consistently more up stocks than down stocks. Cumulative breadth is supporting the message of the overall rally, so not giving any kind of divergent signal there. Take a look at the U.S. dollar index. That has been, you know, maybe a quiet story this week. It was up every day except for today this week, and actually has come pretty strongly off that January low. This is a 6-month chart, so it shows you kind of this bowl formation forming there. And today, maybe with a little bit of a give back when you had the weaker jobs report. Perhaps it really has been rallying in part because positioning was so short against the dollar out there. And then the volatility index also confirming the message of the rally, down at 21. This is basically as low as it's been since the COVID crash. November 30th, it was also right around here. So cracking below 20 would probably also be viewed as a positive tactical signal, Sarah.
Under 1 minute to go before the bell, and stocks are adding to their gains for the week. It's remarkable. We've been up every single day this week, though last week was the worst week for stocks since back in October. Take a look at the major averages. There's the Dow up 92. We've gotten a little bit of a tick higher here into the close. It's the only one of the big four that does not look set to close at a record high, though it's not far away. 31,188 would be a record close. Not quite there. S&P 500 is looking at a record close. It's 7th so far this year, and it's only early February, and it's 5th day in a row of gains. Nearly every sector is higher right now. The exception is technology, but for the week as a whole, every sector is set to close higher on the week. Big winners include energy and financials. There's the bell. NASDAQ also at a record high, up 0.6%. And the Russell 2000 index of small caps, big winner again, up 1.4%. Closing at its own record high. Wilfred.
Three record closes once again, massive gains for the week as a whole. Welcome to the Closing Bell. I'm Wilfred Frost, along with Sarah Eisen and Mike Santoli, CNBC senior markets commentator. For the week as a whole, we're seeing gains of 7.7% for the Russell, 6% for the Nasdaq, 4.6% for the S&P, and 3.9% for the Dow. As for today itself, up more like 0.4% for the three major indices, with the Russell up 1.4%. 10 of the 11 sectors higher today, led by materials. All 11 sectors higher for the week quite comfortably. Columbia Sportswear, a big winner on Wall Street today after better than expected earnings. Coming up, the outerwear company's CEO weighs in on the surge in online sales and ongoing supply chain challenges. Nancy Tengler from Laffer Tengler Investments is still with us, and Gabriela Santos from JP Morgan Asset Management joins the conversation as well. Mike Santoli, I'll come to you first of all. Clearly big gains for the week as a whole. We could also mention yields rising for the week as a whole, but also something we've talked about every day this week, the VIX falling quite considerably and steadily throughout the week, which I guess is being taken as quite a bullish sign.
Yeah, it was a little bit of a mini panic a week ago. It got up above 35. So clearly people had a sense that they wanted to hedge the downside. This sense that a correction is overdue was absolutely in the trading community. And then it has just bled away because the market itself really just kind of passed that little test of that 3% drop. And I think it brings you to a point where you have to look at like your index card of bull market, sayings, which is don't fight the Fed, don't fight the tape. New highs are bullish, not bearish. And, the bond market is basically your friend in terms of the message right now. The only question remains, are we paying up front too much for what we all expect to be positive fundamentals? And are we going to overshoot on positioning and sentiment again? I think you kind of reset those things a little bit last week. So maybe there's some room for them to continue to heat up before you have to worry again.
Gabriela, after a week like this, where do valuations stand? We've gotten some good earnings and some good outlooks. Does it justify the price levels we're seeing?
We have gotten quite some good earnings for the fourth quarter, record percentage of companies beating by record amounts. The issue is that the beats have not been rewarded. So I don't think investors are paying as close attention to this earnings season as they normally would, because it's all about where we're going in the post-vaccine world. And a couple of things that stood out to us as very bullish signals this week. Number one, the huge upside risk we now have for fiscal policy, packaged closer to President Biden's proposed $1.9 trillion now seems feasible. And as well, number two, we've really seen consensus expectations for vaccinations get pulled forward once again. They were slipping into the third quarter. Now they've gotten pulled back to the second quarter. So a way to get through the tough time and also a light at the end of the tunnel for where we're going. So we still think risk on positioning makes sense here with a cyclical bias.
Gabriela, clearly part of the volatility, particularly late in the month in January, was due to the short squeeze and the GameStop retail phenomenon. Was that the case for all of January? And is it a little bit overconfident to see the volatility pull back this week and think that's now the norm for the rest of the year?
Well, I think clearly the increase last week had to do with technical factors. And we had a big adjustment that was done by hedge funds last week, degrossing by the most that they had done since March of 2020. So the effects of those technical factors have waned this week, and you see volatility dropping. But let's be honest, the VIX is still at 21 times. So volatility is still more elevated than it was pre-pandemic. And to me, that's a sign that investors are still actually expecting some risks up ahead. We know vaccinations are not going to be a breeze. So to me, it's actually comforting to see that volatility levels, while they've fallen, they are still elevated.
Nancy, I mentioned that every sector finished the week higher, broad-based rally, as you noted, but big differences in performance. Energy as a sector up 8.3% for the week, 7% for communication services, and financials were up 6.5%. Healthcare was only up 0.5%. What sort of sectors are you positioning yourself in right now as we look forward to post-vaccine world?
So we are involved in the reopening trade, Sarah. I mean, clearly where digitization meets the consumer, we're overweight. So we like a broad array of consumer discretionary companies, many of the usual suspects, some additional. And then we had added to Disney to our 12 best ideas portfolio. So we are increasing our exposure to communication services, and then financials is also an overweight for us. And then, of course, you know that we like tech quite a bit, mostly the cloud pipes and the data aggregation and cybersecurity aspects of tech. So we're less involved. We're market weight the energy trade, but we're less involved in materials and chemicals, and increasing our exposure to technology, consumer discretionary, financials, and industrials.
Mike, why didn't the market get spooked by 1.17% on the 10-year this week?
Just not high enough to really change the equation very much. Credit spreads are very, very tame. In fact, they've been tightening, so the cost of corporate credit is not nearly rising to anything like challenging levels. And I think it just fits in with the general posture of people of feeling like that's a reflationary story. Commodities are a reflationary story until it becomes a little more worrisome. You're still talking about negative real yields, even with the 10-year at 1.17. So all those things put together says we think it's fine. Plus, of course, you get the tailwind for the cyclicals and financials.
Yeah, I mean, the other question is why yields rose at all today on a day where we got some pretty disappointing jobs data. But I guess you could say it makes the case for Biden's nearly $2 trillion of stimulus. Let's talk about retail investing. Huge theme still. Robinhood's customer service complaints soaring during the short squeeze frenzy. Kate Rooney with some new details. Kate.
Hey, Sarah, the Federal Trade Commission saw a surge in complaints about Robinhood last week. That was, of course, during the GameStop trading saga. The agency shared more than 100 reports with CNBC about Robinhood. Those were between January 24th and February 2nd. That was up from just 7 complaints in the prior week. We read through a lot of what these customers had to say, and the comments, for the most part, show widespread frustration with Robinhood's customer service. Some talked about not being able to even leave the app. One says they could deposit, but they couldn't withdraw. Another says, I want my account closed. Others described complaints into what they call sending issues to Robinhood into what they call the void and really never hearing back. We should also point out we don't have comparable numbers yet for the other brokerage firms from the FTC. Robinhood did respond, saying that they are committed to, quote, improving the support they provide customers. They say it's a top priority, and hiring of customer service agents also tripled last year. This, of course, speaks to a lot of the growing pains over at Robinhood amid that record growth and the difficulty of keeping up with customer service, along with that momentum. The app now has more than 13 million users, and by one estimate, added 600,000 accounts just last Friday. Guys, back to you.
And just remind us, Kate, what at all does this mean? What are they saying about what is supposed to be this multi-billion-dollar IPO coming for Robinhood?
So if you ask the venture capital investors, they say this growth is a good thing, and some of the growing pains often highlight just that they have more customers, and no matter what happens, even if they have trading outages like we saw in March, some of the restrictions, they are able to add more customers. I talked to one investor last week who said that the growth way outweighed any attrition that they saw. So they're seeing that as the same bet you would make on maybe a social media company that would have that level of engagement and growth. They see it as a good thing, and they all say that the IPO is probably coming sooner than you might think based on some of the headlines last week.
Okay, Rooney, thanks so much for that one. And for more on that story on Robinhood, be sure to check it out on CNBC.com. Coming back to the broader markets, Gabriella, you said you like an exposure to the cyclical names. Is that also because of valuation or just because of the exposures that they have?
It's both, Wilfred. It's valuations. A way to look at this is just the value style versus the growth style. Still the deepest discount we've had really since the early 2000s. So the market overall has full valuations, but the value style is still an area with attractive valuations relative to growth. And it also tends to be the kind of companies that are very geared to the surge in economic growth that we expect this year and the surge in earnings earnings growth that we expect to come from the cyclical sectors. I mentioned the value style as a way to increase cyclicality. Another way is to overweight small caps versus large caps. And a third way, which I'm particularly passionate about, is increasing international exposure versus the U.S. International markets, just by their nature, are much more exposed to cyclical sectors than the U.S. is, which is a much more defensive market.
Yeah, Nancy, I know you said you were in a lot of the cyclical names and groups. What about small caps in particular, which has worked really well this week and so far in 2021? That theme continues from the end of last year.
Yeah, we do have our clients allocated to small cap, but we don't buy small cap securities directly. So we use other people's expertise. But we've actually been increasing our exposure internationally because we do think global markets with the resurgence in the PMIs all being expansionary in every economic region except for Mexico and Japan on the cusp, we actually are focused with our incremental allocation to the global markets. And that's where we've been increasing, as well as commodities over the last couple of months.
Nancy Tengler, Gabriela Santos, good to see both of you today. Thank you for joining us.
Good to see you.
We appreciate it. Up next, the CEO of Columbia Sportswear on how supply chain and shipping disruptions are impacting that company's bottom line. We're back in just 90 seconds on Closing Bell.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
But you look at the occupancy rate of our retail properties, was about 94%, telling you that the domestic consumption environment is gradually stabilizing. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
Shares of Columbia Sportswear rallying today on the heels of reporting earnings last night, which beat expectations. The outdoor lifestyle company, which is brands including Sorel and Mountain Hardwear, forecasts 18 to 20% sales growth this year. Joining us now in an exclusive interview, Columbia Sportswear CEO Tim Ball. Tim, good to see you. Thanks so much for joining us.
Great to be with you. Thank you very much.
So is this a resoundingly strong kind of vote on the U.S. consumer?
Well, we're a global company. We always refer to the indexes from 2019 for our company, where international business was about 40% of our total sales. So, we're considered an American company everywhere we do business. And, obviously 60% of our sales are here in the U.S. So people tend to think of us frequently just as a U.S. company, but we're quite international.
I presume the strength is all online and bricks and mortar struggling. Is that something you expect to continue even post-pandemic and reduce your footprint accordingly?
We have only a smaller percentage of our total business in our direct-to-consumer business in brick and mortar. We have lots and lots of customers globally who have big operations on brick and mortar, and we don't expect that those are going to evaporate. Certainly, consumers during the pandemic spent lots of time online and lots of money online. But I think there are some places in the world where shopping is a true hobby. And I would point out Japan, et cetera. And so we think a good mixture of both online and brick and mortar presence is appropriate. And, obviously online sales, people being comfortable shopping online is growing fast and will probably likely continue to get share.
Tim, overall, the numbers were really strong. The stock reflects it. But what about China? I think they weren't as strong as some of your competitors are seeing in that market, which is recovering and has stores open and shoppers coming in. What are you seeing in terms of resonance from your brands in China?
No, that's right. We really only have the Columbia brand distributed in China. And we were clear to investors yesterday during our earnings call that we've underperformed there. We have a very strong brand. We've been in business in in China for over 10 years. The brand's well known there, but we just haven't done as good a job in that market as we should. So we're making changes. We're adding to the team that's managing the business. We're increasing our focus on that market, and we will get better, no question about it. The market is growing, and Chinese consumers like the outdoors. They like skiing. The government has a big focus on being a big part of the Olympics coming up, and there's big investment going on from that standpoint. So we feel like our commodities are going to be right in the right place. We just have to do a better job executing.
So overall, Tim, how unusual was this year for you? Obviously, you've had a lot of stores closed and people are spending more time outside and all these things that are coming with the pandemic. How would you say net it all shook out, and what does it mean as you look ahead to this coming year?
Well, when we went through the period of preparation about 1 year ago, had we thought we were going to come out in this good a shape with the kind of cash balance we had and the kind of robust business that we had during 2020, we frankly would have been shocked. It was a lot of unknowns, and not that those unknowns are not continuing. There's plenty of risk throughout the pandemic environment. But we feel very strong. And, we started with a strong balance sheet, and we've increased the balance sheet quite significantly. So we think we're in a great position. And, the risks exist, but we're going to come out much stronger, I'm sure.
Tim, thank you for joining us to talk about what you're seeing.
Thank you.
Tim Boyle, Columbia Sportswear. We've got a market flash on Amazon's truck fleet. Moving stocks. Courtney Reagan with the details. Courtney.
Hi, Sarah. Yeah, take a look at shares of Westport Fuel. This stock is moving higher here after hours on a report from Reuters that Amazon has placed an order for more than 1,000 truck engines that run on compressed natural gas. And these engines are made by Westport Fuel and Cummins in a joint venture. You can see shares are higher by 35% of Westport Fuel here after hours on this report from Reuters, according to two sources familiar with the matter. Back over to you, Wilf and Sarah.
Courtney, a fascinating one, up 40%, 38.9% in after-hours trade. Courtney Reagan there. Up next, Mike Santoli looks at the market valuation and whether stocks are starting to look expensive. As a reminder, you can always watch or listen to us live on the go on the CNBC app. We will be right back here on Closing Bell.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Welcome back. Let's send it over to Mike, who's taking a look at stocks upside potential from here. Mike.
Yeah, well, in particular, the value line median appreciation potential. Value line research, tried and true, been around for decades. They cover 1,500 to 2,000 stocks. They have a quantitative method for evaluating them, and they project a 3 to 5 year potential appreciation for each stock in their coverage universe. Now, that all gets boiled into this, which is the median appreciation potential within that universe. As you can see, it spikes around. It gives really good indications of market bottoms, because when this goes higher, it means that the forward appreciation potential has gone up, mostly because stocks have gone down a lot. So you see 09, you see 2020. Now, when it's at the bottom of this edge, which is right here, it shows you that basically the forward appreciation is considered to be not that great because valuations are high and maybe growth's not going to meet it. And you can see now it's bumped around down here at times in the past decade. You would see it in 2018, even around 2016. So it's not as if it's a market top indicator, but it's showing you that the risk reward is turning against it. And as I said, better for bottoms than tops. And right back to 1969 levels. And there was a little bit of a nasty bear market in 1970, guys.
So, Mike, two questions. The most recent trough there on that was when exactly? And is this basically now suggesting that we're back to the sort of Tina argument for stocks?
Well, arguably. I mean, that's January of 2018, which is when you had valuations kind of crest for a while. And you also had bond yields higher than they are today. So that was when you got the tax cut and the expectations of fast profit growth. So all of it was kind of encapsulated in the market at that moment. And the market really did nothing for over a year after that.
Mike, thank you. Mike Santoli. Up next, former FDA Commissioner Dr. Scott Gottlieb on the risks of a post-Super Bowl coronavirus surge and the timeline for approving COVID booster shots to deal with new variants. Plus, February is Black History Month, and we are honoring some of our CNBC contributors. Here's contributor DeWardrick McNeil with his advice for the next generation.
I would like to see the next generation use their power, the same sort of power that we saw this summer with the protests for George Floyd, to push Washington to pass policies that are beneficial to their economic health. They've done a great job on social justice, but I would like to see them push Washington on the economic justice piece of this.
This will improve trade, especially trades in goods and services. It will reduce the cost of procuring, for example, for Qatar. It will also help the airlines by reducing also the cost. Therefore, there is always benefit from improving economic relationships, especially that we are now entering into a new phase in terms of globalization.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
The news cycle is racing along. We have to be checking every bit of it along the way, because one false narrative can change the course of how we respond to this pandemic. And We can't let that happen. We're going to do our dead level best to get it exactly right and never tell people how to think about it.
News on the vaccine front. Johnson & Johnson seeking FDA approval for its COVID-19 single-dose vaccine. This, of course, comes after results showed the vaccine to be 85% effective at preventing severe disease. Meantime, preliminary studies show the Oxford AstraZeneca vaccine to be 75% effective against the UK variant. Joining us now to talk about all the latest developments is Dr. Scott Gottlieb, former FDA commissioner, sits on the boards of Pfizer and Illumina, and is a CNBC contributor. Dr. Gottlieb, always good to see you on a Friday. My first question is on the plummeting case numbers, which is obviously welcome news in the U.S. It's happening at a time where a little less than 10% of the population is vaccinated. So it's not necessarily that. What is the explanation for why cases are falling so dramatically right now?
Yeah, it's a combination of things. If you look at Google mobility trends, you've seen a real decline in people's activity. So people, probably recognizing the severity of the pandemic, have withdrawn some of their activity. I think you're seeing better adherence to masks, more leadership around wearing masks. And the fact that we've infected probably at this point 25 or 30% of the population, the combination of infecting that many people and vaccinating another 10%, there's probably not a lot of overlap between those two groups right now, because who are vaccinating right now, mostly elderly individuals who have been avoiding getting infected through this pandemic. You have enough population-wide immunity at this point that you don't have herd immunity, but you are getting a reduction in the transfer of the infection. And then when you layer in the reduction in mobility, that's probably having an effect. Now, why people have withdrawn some of their activity, it's probably a combination of things. I think on one level, people are seeing that there's a dangerous pandemic and they're starting to be more cautious. I think you're probably also getting a little bit behavior among people who say, look, I'm going to get vaccinated next month or two. I've made it this far. I've avoided getting infected. Maybe I should just be careful for the next month and then I'll be vaccinated. So I think it's a combination of things that are affecting behavior right now.
And not in that Florida Publix. I don't know if you saw that viral video of all the older ladies checking out, but nobody was wearing a mask there. I just wonder, could it be at all that the virus is mutating into a less virulent, fatal, and contagious disease, as we saw with the Spanish flu?
It's possible. Probably not yet. I mean, we haven't really detected variants that we think are less infectious or less pathogenic. It is true that the mix of viruses that are circulating in the United States right now are different than what was circulating in the fall and are different than what was circulating in the spring. And we're not really good at detecting the sequence variations that we're seeing and correlating that with experimental evidence and clinical data that would show whether or not the virus is changing its behavior. We don't think that's the case right now. I think a lot of it can be explained by behavioral changes. When you do look at the mobility data, in many respects, it looks like April. People have really withdrawn their activity for a period of time, and that's probably accounting for some of this. And again, the fact that we've infected probably upwards of around 30% of the population. And so the RT, the rate of transfer, just begins to fall when you get to those levels, even though it's not herd immunity. Herd immunity isn't binary. It's not all of a sudden we're going to wake up and one day it's just not going to be spreading because we're going to reach some magical threshold. It happens gradually as you build up more population-wide immunity, which is what we're doing at this point.
So clearly, Dr. Colley, things are looking a bit better, but are they looking good enough to start reopening indoor dining as they are in New York next weekend?
Look, I think we're going to see cities and states gradually make these decisions. There's been a lot of economic hardship, and the pandemic has hurt a slice of the population more than others. People who are small business owners who operate in the hospitality sector have been disproportionately impacted by this pandemic. I think that we're going to see continued improvement as we head towards the spring. We should see virus levels continue to come down this month. And so you can start taking more risk against that backdrop. You're going to see, infection levels tick up a little bit as you do that. But I think the overall trajectory is going to be downward. Now, the difference is in parts of the country where B117, the UK variant, has become more prevalent. So when you look at Florida, in particular, southern Florida, as well as Southern California, where 5% of infections or more right now are B117, which is a more contagious variant, it's going to be harder for them to see continued declines in virus levels in those parts of the country. So I think what you're going to see is sort of a plateauing of the declines in those parts of the country. And you could see a regional effect where certain parts of the country have more persistent infection than other parts. But here in the Northeast, I think you're likely to see continued declines, a combination, again, of a lot of people starting to get vaccinated, a lot of people having been infected. And then as we head into the spring, it's going to present more of a seasonal backstop against transmission. So hopefully for most of the country, the picture is going to continue to improve.
So we know that the vaccine makers like Moderna are already working on boosters, and the FDA is coming up with a plan to get them speedy approval. Dr. Ghali, what's the end game here? Can you ever see a time, and when is that time where we don't need vaccines and boosters for COVID-19? Or is that just with us forever?
It might be something that we do seasonally for a long period of time. I mean, it's hard to look out what it's going to look like in 10 years, but I think certainly for the next several years, we're probably going to get seasonal boosters for this. And at least for the foreseeable future, heading into this fall, those boosters may be reformulated to reflect the new variants. Now, it may be the case, there's a lot of people suggesting that this virus isn't going to mutate itself endlessly, that there's a sort of subset of things that it could do to change its conformation, change its proteins in a way to try to evade our immunity. And once we engineer vaccines to accommodate most of those changes, maybe we'll get a more stable formulation. But I think it's still likely to become an annualized shot, because even if it confers immunity that persists past a year, I think heading into the fall and the winter season, when this coronavirus is going to want to circulate, you're going to want to make sure you have maximal immunity. So I think we may be getting boosters for quite some time. Now, in terms of the new variants, I think we have enough time to try to engineer new formulations, and all the companies, including Pfizer, the company I'm on the board of, are working on that right now, new formulations that cover those new variants. And that we should be able to get to the market, if things go well, within a 4 to 6 month time frame. So we should have it in time for the fall, when those two variants that we're worried about, the South African variant and the Brazilian variant, P1 and B1351, are likely to threaten us. I don't think they're really going to be problems for the spring and the summer, but they could become problems for the fall.
Dr. Ghali, but what's your expectation, or what is the timeline for when J&J and AstraZeneca might be approved in the US? And what do you make of some of the little extra releases from the AstraZeneca vaccine over the last week or so?
Yeah, the AstraZeneca data, as it accumulates, is looking more and more promising. And that vaccine has been put in a lot of people at this point, so you have real-world evidence. I don't know that there is a single study that FDA can hang its hat on right now. So if they do file an authorization for emergency use, it's sort of going to be an amalgamation of the different data from the different trials. The J&J trial, which read out, and they just filed their request for an EUA today, I think that should get authorized by the end of this month, or certainly by early March. They have an advisory committee meeting on February 26th. FDA should be in a position to authorize that shortly after that meeting, if the data that the FDA reviews supports what we've seen from the top-line readout that the company provided, which I think it should. I mean, J&J knows how to develop vaccines. They know how to manufacture them at scale. So this is going to be an important addition to the market.
I'm trying to figure out what it's going to look like for everyone to go back to work normally, to go back to really crowded office buildings and stores and all that. You put out a roadmap a few months ago with a colleague, I think, about how to reopen safely in the middle of the pandemic. And that was followed, Dr. Birx has mentioned that when she was on the White House Coronavirus Task Force. Are you going to do that again once we get to a certain threshold of vaccinations? And should workplaces require people to show proof of that? I mean, how does that look? How are people going to feel comfortable going back to work in any kind of normal environment?
Look, I think we're going to go back to work in the fall and the winter. I think probably 50–60% of the public will be vaccinated by then. I think workplaces are going to have to take certain precautions. They're going to have to retrofit HVAC systems, improve air quality. I think that you will have some distancing at work insofar as they won't crowd people into conference rooms. People will be more conscious of confining small people into small spaces where you can get the conditions for spread. I don't know that businesses are going to require vaccination. I think what you're more likely to see is basically 2 lanes to work. People who get vaccinated and can provide proof of vaccination don't have to take certain measures. Maybe people who don't, who opt out of getting vaccinated, have to do a daily symptom check, have to undergo routine screening. There might be other measures in place. I think you're likely to see that also in public venues. I mean, you can envision 2 lines into Disneyland, 1 line for people who can provide proof of vaccination and another where people have to undergo some secondary screening for fevers and symptom scans to get into the park. So I think that's what we're likely to see. I don't know that we're likely to see vaccine mandates because I think there's going to be uneasiness about putting those in places. But I do think businesses may impose certain conditions on people who don't get vaccinated to make sure they're not bringing a virus into the workplace.
Yeah, maybe antigen tests, as the Becton Dickinson CEO told us as well. Dr. Gottlieb, thank you very much for joining us. Always a pleasure.
Thanks a lot.
Breaking barriers coming up. Deborah Martin Chase, the first African-American female producer to have a deal with a major Hollywood studio, will join us to discuss increasing diversity in the film and TV industry and the challenges of making new content during the pandemic.
CNBC's Healthy Returns Conference is all about the biggest developments going on in medicine and the things that investors can use to make decisions about where to put their money.
The majority of innovation in the last 10 years has not come from the top 10 pharma.
We've got FDA Commissioner Scott Gottlieb.
There are things that we can do to make it easier for the generic companies.
Craig Venter, he's a genetics pioneer.
Preventative healthcare could save the economy trillions of dollars.
At CNBC, what we do is we follow the money. Healthcare is 18% of the U.S. economy, so it's a huge business story, but it's also deeply, deeply personal.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Time for a CNBC News Update with Sue Herrera. Hi, Sue.
Hi, Wilf. Good to see you. Hello, everybody. Here's what's happening at this hour. Vice President Kamala Harris and Treasury Secretary Janet Yellen saying businesses that were left out of previous pandemic aid programs will be first in line for the next one. That includes many black-owned businesses. Harris and Yellen say support will also expand to include outreach and technical assistance. Through next year, Microsoft is suspending donations to all lawmakers who voted to object to the certification of Joe Biden's election as president. The company is also halting donations to state officials and organizations that called for the election results to be overturned. 2 of the 3 impeachment petitions against Kentucky Governor Andy Beshear have been thrown out. One more, calling for his removal over pandemic restrictions, is still being considered. In Afghanistan, Taliban leaders are telling NBC News they are returning to frontline duty as the Biden administration reviews an agreement to pull U.S. troops from the country by May. You are up to date. That's the news update this hour. Sarah, back to you.
Sue, thank you. Up next, bridging the diversity gap, Deborah Martin Chase, the first African-American female producer to have a deal with a major Hollywood studio, has her latest project airing this weekend, right after the Super Bowl. She's going to join us next with more on how she is pushing racial boundaries in the film world. Plus, Reddit traders could face a reckoning when it comes to taxes. We'll explain when Closing Bell comes right back.
Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone. Without the resilience of a food system, there is no human species. It's as simple as that.
When you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
There will be a gradual pickup. So before the summer, there can still be a bit of ups and downs depending on the variations and the types of lockdowns that we do. And it is only after the summer where we assume that the effects of the vaccination will kick in. And we have the intention, once that will be lifted, so let's say over September, to do the complement to get to our 50% of payout on 2020 results, as we always do.
Hollywood still has a ways to go in terms of diversity and inclusion. According to UCLA's 2020 Hollywood Diversity Report, people of color only represented 15% of film directors and 9% of studio heads in 2019. And from the 2018 through 2019 TV season, they only represented 10.7% of broadcast scripted show creators and 8% of network heads. One person breaking these barriers, powerhouse producer Deborah Martin Chase. She is the first African-American female producer to have a deal at any major studio. Her latest project, The Equalizer, premieres this weekend following the Super Bowl, and she joins us now for more. It's great to have you here, Deborah. Thank you.
Happy to be here.
So first of all, just on the new show, what was it like to film during a pandemic?
Well, look, I'm sitting here. Below me is our stages. We're at the Izod Center at the Meadowlands. So we created our own bubble in a sense. Not that we were living here, but we were, 200 people working here every day. It's challenging, though. I mean, we're testing every day. We are, trying to wear shields and masks and maintain 6 feet of a distance from each other while we're doing something that's very intimate, creating television. But, we wanted to get it done, and not to mention the cost. It's really expensive. But so far, knock on wood, we're on episode 6, and we've been going strong and taking care of each other.
Looking forward to seeing it. Just on the diversity question, which we wanted to dive into, we did see some progress with some of the Golden Globe nominations. For instance, the 3 directors that were female that were nominated. I guess the previous record had only been 1. Are you seeing progress in 2021 as we enter this new period where people are more aware in your industry, both on and off screen?
Look, absolutely. I mean, we still have a long ways to go. And as you mentioned earlier, we need more decision makers of color, and we need more people just even at the table, making decisions. But at the end of the day, what has changed is the consciousness that, Hollywood has finally realized after years of many of us, beating down the door and saying that diversity is good business. The proof has been in the pudding, with movies like Black Panther and Hidden Figures and My Own Harriet and, with the explosion on TV. People realize that, diversity pays. It's not just the right thing to do. So in many respects, the issue that you have right now is a pipeline problem because people are starting to hire directors of color and women and writers. Used to be a writer of color could never get on a white show, and now people do want their rooms to be integrated. In fact, I know CBS has a new mandate that 40% of their writers' rooms need to be diverse going forward. But you don't have enough people because people haven't been given opportunities in the past. So yes, the attitude has changed, the appetite has changed to give opportunities, and we're seeing the results of that on camera, on the screen.
Were you very pleased to see the nominations, particularly in the director category for the Golden Globes this year?
Yes, absolutely. I mean, the Nomadland director and Regina King, who's a dear friend and who's been at the top of her game for, so long. Yes, absolutely. But again, the awards are kind of the cake. And, the decisions that lead to the awards are made much, all along the way. So it really is about having people at the table making the initial decisions about what television shows are going to be made and what movies are going to be produced that reflect all opinions and colors. That's how you're going to really see lasting change.
I mean, deservedly, on-screen diversity is a huge focus this year. You made Cinderella back in 1997 with 2 Black female leads, Brandy and Whitney Houston, and I was excited to see that it's coming to Disney Plus this year. How different was the environment then and now? So the environment, listen, that aired in 1997, so it was completely different. Yeah. And not only was it's the significance of Cinderella that you had Brandy and Whitney Houston in the lead roles, but really it was the, what we call colorblind casting, or certainly diverse or multicultural casting of that movie. It was the first time that it had ever been done on television. And I think it's part of what made it so special. You had beautiful Brandy in the title role, but then the prince was the fabulous Paulo Montalban, who's Filipino, and Whoopi was the queen, was married to Victor Garber. And I think, that inclusiveness is what made it just special, and everybody could relate to it. And I'm thrilled that Disney Plus has entered it into its programming. I was knocking on their door. My good friend Vanessa Morrison is the president of Disney Plus, and I had been getting besieged on social media with people saying, "Where is it? Why isn't it there?" And so everybody worked hard to clear up some rights issues, and February 12th it'll be on.
Well, we look forward to that, Deborah, and we look forward to The Equalizer. I didn't see the original CBS show, which I believe was in the 80s. I loved, though, the Denzel Washington movies. What's the new take for your TV show? What can we expect?
Our show is really based upon the original 80s television series. Denzel, and I love those movies so much, but they took a much darker path in telling the story. And at its essence, you know, The Equalizer is about Robin McCall, played by Queen Latifah, who is a former CIA agent who realized that she really wanted to help people, the everyday people, you know, the people who are falling through the cracks in the system. But she's also a single mom. And so in its essence, she's like most women who are juggling family and career and, you know, sense of duty and obligation, which with trying to, you know, deal with the ultimate 15-year-old daughter. So, and Queen Latifah is so fabulous in the show. I mean, she is kicking butt. She's doing most of her fighting herself. She's also warm, and just all the things that she is as both a woman and as an entertainer, she brings to that role, and it's exciting.
How different is it for you these days, Deborah? I mean, you've been doing this for a long time. Now that there are so many options for your TV shows, the streamers and the competition for content, it's not just the big three networks. Does that change the process for you at all?
You know what? It's not so much changed the process, but it certainly opens up the opportunities. I mean, my job as a producer is to find material that I think is great, and then figure out what is the right platform for it or the right, you know, distribution format. And so all of a sudden you have, you know, where the studios really have gotten into the business of finding things that will appeal to the most people. You know, you can have a show on a streamer that has a very loyal, specific audience, and it can still be a hit, which means, you know, you can express different voices and tell different stories about different people and cultures. And it's really exciting. It really has made being a producer, it's a great time to be a producer right now, and I'm happy I'm still here doing it.
Deborah, thank you so much for joining us. Much appreciated. Great to see you.
Thank you so much.
Deborah Martin chased that. Up next, it's been a wild ride for GameStop investors, and now the flood of new retail traders are getting another painful lesson in investing. Taxes. All the details when we come back.
But you look at the occupancy rate of our retail properties, was about 94%, telling you that the domestic consumption environment is gradually stabilized. I think it's the lack of tourists that would cause the high margin trades, the street shops are really suffering. So again, this is a big assumption whereby we have to be dependent on when the borders are going to be reopened.
He's a billionaire investor and startup king.
Starting a company is jumping off a cliff and assembling the airplane on the way down.
And to many, he's a heavy hitter with a heart.
What I hope for and what I work for is a society and set of networks by which we make each other better.
But you don't dominate in Silicon Valley without having an edge.
He's super sweet. Do not underestimate him because he's super sweet.
The brave ones. Reid Hoffman. CNBC.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
GameStop has been on a wild ride amid the retail trading surge, and those investors are now about to learn another tough trading lesson. Robert Frank here with that story. Hi, Robert.
Hey, Willful. Accountants getting flooded with business from all these new stock traders who are now getting their 2020 tax bill. So here are the three most common and costly tax surprises. First is gains on stock held less than a year are taxed at ordinary income rates. So that's as high as 37% rather than the 20% for the top capital gains rate. Lots of mistakes made around wash trades. That's where you sell a stock at a loss, buy it back to get the tax loss. The rule says you gotta wait a month for the buyback. Those that didn't, they can't claim the loss. Now, lots of traders use multiple brokers, but they didn't combine all their statements, so their actual tax bills are often higher. Now, one piece of advice, this could save you a lot of money. Don't forget to elect mark-to-market option on your tax forms before April 15th. That will allow you to claim more of your trading losses against any income this year. Wilf, back to you.
I'll take it. Good advice, Robert. Thank you. Up next, another big week for earnings on tap. What we're watching when Disney, Uber, and many more names hit the tape. Closing bell. We'll be right back.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Pre-COVID time, our biggest tourists came from India. That was our number one. Then Chinese were number two. So even in China, today's situation is, we are talking to them, but there are no finalization of travel bubbles. But we are hopeful, right? We are first looking at India. Once India is done, that may be that we will hopefully, with the approval of Chinese government, that we will look at, to finalize the air bubble between the two countries.
The airlines are still burning through tens of millions of dollars every single day. And it's fascinating watching the moves they are making to come up with the cash so they can be in business 6 months from now or a year from now. When you watch CNBC, you hear directly from the airline CEOs. What's their next move? Will we always be wearing a mask? CNBC has been the place where people turn for information covering the COVID-19 impact, about how business will survive coming out of this coronavirus.
Looking ahead, another big week for earnings on tap. Monday, numbers from the likes of Hasbro, the toy maker, and SoftBank. On Tuesday, Lyft, Twitter, and Cisco are set to report. Wednesday, results from Coca-Cola, Under Armour, Uber, and more. Disney is the big report to watch on Thursday, along with PepsiCo and Kraft Heinz for a fresh read on the consumer. I'll be watching for all clues from the consumer on some of those names. But also, Mike, just what's happening in Washington and how the ball, if at all, moves forward on the $1.9 trillion stimulus, whether they can get bipartisan support or whether it gets cut into pieces, and how that's going to flow into the markets and the economy. Because the economic data, it's in some ways better than expected, but if you look at today's jobs report, for instance, an economy that still could use stimulus.
Yeah, without a doubt, it doesn't really weaken the case for what the Democrats at least think they want to do. And also when it might come together. I think that actually does matter in terms of market psychology if there's wait for this extra fiscal push. But really, it seems like the market is very secure in all the recovery forces that are already in play. It almost seems as if investors are treating this as we don't necessarily need a tremendous amount of help, but boy, it'll be a great little boost once it comes. And that includes really for what the Fed's doing right now. So I'm not saying that's correct, but that's mostly the investor posture right now, is if things are already going right, and that would only be kind of an afterburner.
Mike, it's been kind of one-way traffic for equities, for commodities like oil, and for the yields this week. But the dollar and gold just showing a little bit of a turnaround as we closed out the week today.
Just today, exactly, at the very end. We'll see if that builds into anything, but gold's been quite weak right along with bonds.
We are out of time here on Closing Bell. Have a wonderful week.